The European space on that front. VW also in focus. We had numbers out from VW and some of the commentary coming through from the likes of JP Morgan saying their guidance looks conservative is the name what they say the outlook looks, even if the results look fairly strong. HelloFresh could be interesting. That could be weak. Morgan Stanley talking about the weakness there. JP Morgan also talking about weakness in those numbers, Guy.
Yeah, let's look at defence stocks as well. Tom McKenzie's interview with the Greens, really significant this morning. Let's give you a market open. It's time for the opening trade. Let's show you some figures, give you an idea of what is going on. As Credit's been highlighting a little bit of underperformance over the last few days from the FTSE 100. It opens in negative territory this morning. I think the next few minutes are going to be really interesting. We obviously need to wash out the back end of the US session, what we've seen overnight maybe, and get a more clear picture of where Europe is going. And the initial indications are quite negative. But look, we don't have other markets open yet, so the IBEX opens negative as well. So this turnaround Tuesday narrative doesn't appear to be there, but the CAC opens positive. That maybe changes the narrative a little bit for the stock 600. So we pick up a little bit, so we're flat. But flat enough, I think, is the key question this morning, really, to kind of change the sentiment, which was so negative yesterday. The IBEX is struggling a bit. The CAC has opened positive. We'll see what the component parts look like there. We're going to wait, I suspect, for a few minutes for the DAX to get going this morning, the SMI as well. We'll see what they bring to the table in a few minutes. But at the moment, a very, very flat open from a European perspective this morning, with airlines under significant pressure, Chrissy.
Absolutely, and you are starting to see that show up. IAG, for example, right out of the gates, lower by about 4%. Let's talk about the upside, though, and where we are seeing those spots of green. A lot of it, you mentioned that kind of outperformance in France. You're seeing it, a lot of it driven by Schneider Electric. I'm seeing a lot of tech names outperforming this morning, which is interesting, given that the underperformance of yesterday's session, a lot of that was driven by the tech space on both sides of the Atlantic. So, Anna, seeing a little bit of that, perhaps, element of turnaround Tuesday this morning.
Yeah, a little bit of a turnaround. As you pointed out, Chrissy, underperformance in London. We do see the CAC up by 0.6%. The stock 600 overall, then, net is flat, but we're waiting for the Xetra DAX to open. I suppose it's worth remembering that we were driven a bit by some of these US themes yesterday, but we were also driven by nervousness around the German deal and the ability of a new, or rather legacy German administration to get through some of the defence and infrastructure spending plans they have. Maybe that looks a little more likely this morning, given that conversation with the Greens, and so maybe that helps us make some gains. Having said that, though, the stock 600 now down 0.1%. So, yeah, travel and leisure is certainly one of the things we're watching on the downside. That sector down by 1.3%.
So, IAG, owner of British Airways, Iberia down by 6%, EasyJet's down by 3%, which is interesting. It doesn't have any US exposure, but it's a kind of broader narrative in the space. Lufthansa's under a little bit of pressure as well. Lufthansa is down 2.8. This is Ed Bastian's work over at Delta, downgrading forecasts yesterday. There is a conference taking place in New York today, an airline conference. I suspect it'll be interesting to see whether we get others coming out and telling similar stories in terms of the US consumer, maybe just becoming a little bit more cautious, particularly maybe at the front of the plane, which I think would be really interesting. But Ed did talk about the fact that it was transitory. He sees this hit at the moment as being transitory. I wonder whether it's too early to tell whether it is going to be transitory, Chrissy.
I'm a little triggered by the use of that word
three
times in one sentence. I'm having a little bit of PTSD there. The DAX is officially open, higher by about 0.3%. Interesting, though, it is lagging the French index this morning by a decent margin. A lot of the outperformance in France driven by one name, and that, of course, is Schneider Electric. So we're going to keep an eye on what those tech themes do to the broader markets. In the meantime, let's get a true expert kind of a take on what's going on. Peter Oppenheimer, Chief Global Equity Strategist and Macro Research Head of Europe over at Goldman Sachs, joins us around the table. Peter, pleasure to have you on the program.
Thank you.
Do you buy the dip?
Not yet. I think this is, we had very extreme positioning and really quite a significant degree of optimism running into this correction. And I think probably that has a little bit further to go. Essentially, though, economies are growing, albeit perhaps a slower pace than people were expecting at the end of last year. And we are going to get some interest rate cuts, and that will, I think, limit the extent of a drawdown. But I think we still probably have some more volatility to come.
You talk about extreme positioning. There is a question that around a lot of the outperformance in Europe that we're seeing, it's really short covering on the European positions, not actual fundamental outperformance. To what extent is that narrative true?
Well, I think there's more of a shift, an inflection point that favours Europe relative, at least, to the US. And this is a topic that we've been discussing really all year. And part of that, I think, comes from the slowdown that we're seeing in the US economy at the margin. It's still growing, but at a slower pace. Our economists have downgraded their forecast for the US. We're now below consensus for the first time in 2.5 years. We're expecting a growth rate of about 1.7 in the fourth quarter, year over year. And that's below trend, but still okay. But in addition to that, of course, we've seen some real pressure coming in the biggest tech stocks in the US. And they have such a big weight in the US market, is dragging the US down more than other markets. And of course, on the other side, European growth expectations have been edging up from a very low base, partly triggered by optimism over increased defense spending, as you discussed earlier. So I think there is a genuine fundamental inflection point that's happening that's supporting Europe, at least in a relative sense.
And just lingering on that inflection a little and sort of dissecting it a bit then, Peter, thinking about the US and where the pain is, where the pressure points are. We were talking to our colleague Mark Cudmore earlier, and we were joining the dots between various retail favourites, Tesla down 15% in one session, Coinbase, MicroStrategy, lots of these stocks that tend to go together, attract the same kind of crowd. Is that where the pain is? Is this a retail pain story? Is there a lot of will there be institutional pain from the selling that we saw yesterday in the United States?
I think it's both. I mean, it's true that there have been favoured retail stocks and they've been down quite sharply, and that will have an effect of tightening financial conditions and raise the concerns that are being reflected in market pricing about a slowdown in growth in the consumer. But also, if you look at favoured positions from hedge funds, they've taken quite a lot of pain as well. And we have to also recognise that context matters here. There was a huge amount of optimism, not only about the US economy, the leading tech names in AI, but also the whole concept of US exceptionalism and animal spirits. And those are really being, I think, tested right now, and that's triggering this pain, and therefore I think some forced selling as well, which is exacerbating some of these moves.
Yeah, and what kind of volatility are you bracing for? I was reading Morgan Stanley yesterday talking about in the first half of this year, they think the S&P could be down 5%, but then there could be a rebound. I mean, do we have any visibility about where this seeming uptick in volatility is going to take us?
Well, we've already seen a correction of more than that, and let's be clear, it's been a long time since we've seen a correction of 10% or so. I don't think that would be at all surprising, given the extent to which markets have risen. Bear in mind, in the last 2 years, the US equity market has seen a return well in the 90th percentile of two-year distributions over a century. So it's seen extreme upside without a correction. And I think it's normal, as people begin to question some of the confidence and assumptions that underlay that strength, that you get a correction. 10%, I think, is perfectly reasonable. Will it be a lot more than that? I would doubt it, because fundamentally we are still seeing economic growth and rates will come down. And that combination is not typically conducive to more serious bear markets.
What happens if that economic growth is questioned, though? I bring up Delta this morning. Delta is highly exposed and has real-time information related to the US consumer, particularly the high-end consumer that is spending on travel at the moment. It's just downgraded its forecasts. Right. It is telling us that the consumer is becoming more cautious. The consumer, he or she, doesn't know kind of what the outlook looks like. If that is seen elsewhere, does that call into question that economic certainty that we've had that has underpinned this market?
I think so. So again, when you look at the period going into this year, the confidence in economic growth, particularly in the US, was unshakable. There's a very, very strong consensus that the US economy will continue to grow at a rapid rate, rates will come down. And really, markets react to changes at the margin. So if you start to see some evidence that the economy is slowing, that the consumer is tiring, then, of course, some probability of recession has got to be priced in. That means that from the starting point of valuation, some degree of adjustment has to happen.
What is a S&P? What is a level that is consistent with a recession?
Well, in terms of multiple or in terms of...
Just in terms of just overall level.
Well,
where would we get to in a recession? Where do you think we would end up?
Well, in typical recessions, and again, they vary in terms of magnitude and length, you would expect the S&P to be down at least 15 to 20%, and other markets typically more than that.
Right.
But we also have to note that, of course, the US equity market came into this correction
from a very high
level of valuation.
So we would assume that that number would be greater?
It could well be greater than that, yeah. But I think it's also important to say that when you look at the distribution of the composition of the US equity market, the biggest stocks also are unusually defensive, given that they have so much cash and they have very strong balance sheets. So I don't think valuations are going to normalize to long-term averages. But again, the sort of correction we're seeing at the moment is not at all surprising as you start to see some degree of adjustment downwards in the confidence of US growth. And that also feeds into, of course, other markets as well.
Peter, where does the currency impact fall in this? Because when we see technical corrections like this in the States, usually the dollar correlation is pretty high, and that creates this kind of fund flow from Europe, from China, et cetera. We're not seeing that this time around. And as we speak, by the way, we should mention the euro dollar has retreated after testing last week's highs. It's now at 108.88. There is a euro bounce in the currency market. How does that affect the equity market on both sides of the Atlantic?
Well, I think that's a reflection, actually, of the degree of consensus coming into this year. That, you know, we had our own survey of investors at our strategy conference, which we do every year, and the highest proportion ever thought that the US would outperform, that the dollar would go up, that technology would be the best performing sector. And by the way, the lowest proportion that we have surveyed in the number of years expected Europe to be the best performing market. And I think, again, that reflects the degree of consensus coming into this year. And many of these are unwinding at the margin at the same time. And it's understandable that if people start to question the strength of US growth, then at the same time the dollar's going to weaken a bit, and and I think that's again a consequence of this sort of inflection point we're seeing in expectations.
And in Peter, then if what we've seen is a questioning of US growth and questions about that US exceptionalism, and a lot of that does seem to be attached to the tariff conversation, but maybe not all of it. Is it right then that US tech should be punished quite so much? I appreciate they rallied a long way, so they're vulnerable in that sense. But are we in danger of overselling US tech if actually the tariff pain is going to fall elsewhere?
Yeah, I think fundamentally US tech is in a very strong position. We expected, along with diversification broadly in assets, that you'd see diversification benefiting technology itself. So a little bit of a spread outside of the biggest hyperscalers, and that is beginning to happen. But the other thing that sort of changed in the last couple of months is that the competition in the AI epicenter is starting to increase, and that again is sort of raising questions about the dominance that these companies have and the validity of their ramp up in capex spending. So I think fundamentally they're very strong and they have very good longer term opportunities, but the confidence in their dominant position had got too high. And alongside that, their valuation's a little bit too extreme. And that adjustment is what I think we're seeing at the moment.
Peter, the question that a lot of people watching this programme this morning are going to be asking, listening to you is, where do I hide? Where do I go next to protect the gains that I've generated over the last few years?
Well, when we talked about the benefits of diversification, which has been a big theme of ours this year, partly because of those extreme valuations in equity space, we also talked about diversifying across asset classes, and we've been overweight of equities and bonds. We wanted to be overweight of equities because they typically do well if economies are growing and rates are coming down, but we felt that bonds would be a good diversifier.
And that's working.
If those growth expectations were tested, and that's working. So I think spreading across asset classes makes sense. Within equities, spreading across regions and indeed across sectors is paying off for the
Is that a relative trade? Like if I go to Japan, is it am I going to outperform but still have a negative number on my P&L at the end of it? Give us the...
If you get a correction and it's led by the US and it's 10% plus, it would be very unlikely that other equity markets would be going up.
Right.
So it becomes a relative trade. I think that's right.
Fair to say.
But it's still true that diversification would help in that context. One of the other ways of diversifying, of course, is looking at low-vol stocks, and low-vol stocks are outperforming sharply. So strong balance sheet, high cash generative, relatively defensive parts of the market are actually seeing some relative benefits.
Cash?
And cash is also yielding a reasonably attractive amount in most places, and it's a very changed world in that sense as well, and that becomes part of a diversified portfolio strategy, I think.
Peter, always great to see you. Thanks for spending so much time with us
Thanks.
this morning. Peter Oppenheimer, the Chief Global Equity Strategist at Goldman Sachs. Quick look at what is happening with the Core 6 this morning. As we've already mentioned, Schneider looks like it's a significant outperformer, and what we're watching at the moment is certainly some outperformance coming there. It's interesting, you've got a left and a right to your screen this morning. It's a game of two halves out there. Novo, LVMH, Ferrari under a little bit of pressure, ASML and Schneider in the tech space actually both doing relatively well, but there's some other big movers out there this morning that are worth focusing on. Joe Easton's got the details of those.
So we are seeing some big drops in the airlines here in Europe, guys. Significant underperformance feeding through from that disappointment around Delta Airlines and also the drops we saw in the US and Asian peers overnight. So IAG among the worst performers, and take a look at Air France down 5% on that one, and even the short-haul airlines with not much UX exposure getting a bit of a negative read-through. EasyJet declining, Ryanair looking a little bit weak as well. Then over in autos, VW was a little bit stronger, and I actually saw a bit of a trading halt coming through on that one a few moments ago. We'll see if it's still moving. It is ticking higher, up 3.5%, extending the gains, reassuring on some of those numbers in terms of the sales outlook for the German automaker. Then here in the UK, we've got those home builders. Been a brutal couple of years for that sector, but we are finally seeing a bit of positivity. We're seeing Persimmon today talking about better than expected orders and potentially even house prices starting to stabilise. We've got the Bank of England next week, of course. That'll be crucial for the sector given the potential outlook for rates, so that's going to be key. But Persimmon boosting its own stock and peers today. Then a couple of big German decliners. HelloFresh still not selling enough of those packaged meals. Now that has another sales warning. It's had a swathe of sales warnings over the past couple of years, and we're down 12% in the German mid-caps today. Really hit hard for HelloFresh. And in the larger cap German space, Henkel, a massive company, around a 30 billion market cap in terms of one of the bigger stocks moving today. This is exposed to the household products. I looked up their brands. It's Right Guard deodorant and also some of the washing powder as well, but a warning on their margins today, hitting that stock pretty hard. One of the worst points decliners today. Then a couple of rating changes. Prysmian, this one has been caught up in the sell-off in data centers, exposed to data centers. It's electrification. Probably completely pronounced that wrong, but it's similar to Schneider Electric, Siemens Energy, sold off recently. UBS today says you should be buying into that sector. And finally, Burberry going back to its British heritage, according to Exane, under the new CEO, and they reckon that is the most successful period, or it has been in the past, when they focus on the traditional British scarves, those tartan scarves. They recommend buying Burberry. We're rising 1.6% on the luxury goods maker in London this morning.
Joe Easton from our equities team, we thank you so much walking us through some of those early movers in the European session. It is the most wonderful time of the year in that there is daylight savings, which means we get to do a little bit more of the U.S. pre-market as well. If we're talking for elements of Turnaround Tuesday, here's maybe where you might find some, specifically in the tech space. You're looking at Tesla shares higher by about 2%. Now remember, Tesla's been down 45% year to date. Donald Trump also in the last 24 hours saying he might just buy a Tesla. So we'll see how much of that sticks into the U.S. Open. NVIDIA shares higher by 1% as well. But Palantir, which has been part of the AI trade, not getting in on that rebound, down about 1.4%. A couple of earnings stories we've got our eye on as well. Guys been mentioning Delta quite a bit in terms of the consumer read-through, that warning from Ed Bastian as well. Delta shares down a whopping 10%. And it's not alone. Oracle also missing their earnings yesterday after the U.S. fell, down about 1.2%. We're going to dig into the outlook, the consumer story, the business investment story, and some of these other U.S. movers shortly. Stick with us. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Tuesday morning, how are you feeling? Let's take a look at the markets and get an idea of what is going on. As you can see, it's a mixed picture in Europe. The US is bouncing around all over the place. We're trying to get an understanding of kind of where we are going to be taken today. There's a lot of data coming out today, which is also interesting too. You've got NFIB coming up a little bit later. A little later, you're going to get jolts as well. Corporate profitability is a big factor in all of this as well in terms of what we're watching. So US futures, a few minutes ago, negative. Now they're positive. Who knows what's going to happen over the next couple of hours. It's only 4 hours difference between London and New York right now. Look, the other story you've got to fold into the narrative this morning, I think the Delta Airlines story is really significant. Ed Bastian out last night cutting profit expectations for the first quarter. He's citing weakening traveling demand. He's talking about economic worries. He's talking about uncertainty. You've got a conference taking place today. Are others within that space going to be saying a similar thing? Oracle also slipping in after hours, like not as much. The tech giant reporting disappointing corporate results. Sales profit forecast for the current quarter, a little short of estimates. Again, what does that tell us about what is happening in the tech space? Let's try and get an understanding of what is going on here. Valerie Totel is sitting nervously next to me.
She has an understanding.
Does she? Excellent. Cool. Wow, tell us more. The earnings. So I'm slightly obsessed with Delta, which I always am. I think Ed Bastian is telling us a really interesting thing at the moment. He's saying that there is clearly a hit to confidence. Yep. It's showing up already in terms of bookings. He's saying it's transitory, but transitory is a kind of fuzzy word to me.
No, I think what we heard in the after-hours earning reports out of the U.S., it just goes to almost double onto this narrative about the U.S. consumer pulling back. Delta being that one. It's adding to what we've heard from big box retailers already, where fourth quarter was okay, but they gave cautious guidance for the year ahead. Given Target, Walmart, Home Depot, Lowe's, even add Macy's into that, all given this cautious guidance. So we haven't heard, I guess, anything from the earnings reports that would necessarily buck that trend. If anything, Delta just added to it yesterday. And then with Oracle, that's also, again, aligning with the recent narrative that if you want earnings growth in tech, it's not going to be in the U.S. It's going to be in China. China. So again, earnings growth coming from the East instead of from the West. Again, Oracle kind of aligning with those recent narratives. We haven't seen anything necessarily to buck the recent narrative about worries about a U.S. consumer. I mean, what could spur a reversal? I think we're still asking ourselves these kind of questions.
Yes, and I wonder, what does a reversal look like? Because we see U.S. futures up just tentatively this morning, and they have, to Guy's point, been all over the place in the past hour or so. I mean, do we have any sense of what is going to draw any kind of line in the sand, or is this just the new normal? We just get used to these, big moves.
Well, look, I think there's two sides to what could spur a reversal. We do have CPI tomorrow. If it comes in soft, maybe we're more confident about a Fed cut in May, and that gives some bounce to the equity market. But then you also have to take into account the politics side. If Trump is not backing down on this tariff narrative, we need to hear more about these promised tax cuts that are going to come. I don't think the market is going to want to wait until the fourth quarter of this year to have more certainty on these tax cuts.
And he is meeting business today, so maybe, as you were saying earlier, maybe that's a line he pushes hard to try and counter the negativity.
Yeah, exactly. Does he have the Republicans on his side when he pushes for that, or does he have to show that he has tariff revenue in his back pocket before pushing for that as well?
The irony is that aren't corporations supposed to be lobbying the government? It kind of feels like it's the other way around at the moment. But to your point, a lot of that tariff story has been showing up in the FX market, specifically now this morning. Perhaps it's not a tariff story, but certainly some FX volatility when it comes to euro dollar.
Well, I think this is more, again, this narrative that fiscal spending is in the back seat, right? We're seeing continued outperformance of the rest of the world, be it here in Europe. European stocks continue their outperformance. Euro reaching 109 just in the last hour. Add to that, China is still stimulating as well, driving equity gains in Asia. The one outlier is the U.S. The U.S. is not pushing a big fiscal spending package through.
That was the last few years. That's where we are now. We've had that.
Now it's the Biden data.
Precisely. I think we can blame the euro move partly on Tom McKenzie this morning. I think he has some degree of responsibility.
I'm always game to blame Tom McKenzie
for most things. This morning, I think it's the euro dollar.
That's a credit, Tom McKenzie, for that strength. I'm sure a lot of Europeans are grateful to him this morning. Bloomberg's Valerie Teitel walking us through a little bit of everything, from the earnings story over in the States to the bond market to the currency market as well. Coming up, we're going to stick to the corporate story, stick to a little bit of what's going on in Germany as well. Volkswagen shares rising after reporting their earnings. It comes as the German automaker positions for worsening trade conflicts. We're going to hear from the CFO of the company shortly, and followed by a really interesting conversation on the auto story, the tariff story, perhaps a little bit of the currency impact as well. Those conversations coming up next. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Welcome back to the program. Let's have a quick check on what's happening with the Volkswagen share price this morning. It is up by 2.5%. We see the market responding quite positively to what we've heard from Volkswagen in terms of their earnings story. The Volkswagen CFO, Arno Antlitz, spoke with Bloomberg's Oliver Crook. That conversation about US policy a short time ago.
We feel already like an American company. Look, we operate a huge factory in Chattanooga with thousands of people there. Volkswagen Group of America employs more than 20,000 plus people, create safe and well-paid jobs. We invest in South Carolina. So we think these should be taken into account when talking about tariffs and Volkswagen and talking about the U.S.
But if you were to get 25% tariffs, and I know that it's too early to say, but again, it's not a zero. It's very far from a 0% chance. Would it mean a bigger footprint of manufacturing within the United States for you?
Well, let's not speculate. And as said before, we want to grow in the U.S. And we set up some initiatives already, like Scout Project, like more projects to come for brand Volkswagen, and this is what we've been taking off.
And trying to look a little bit further into the future, I know it's sort of hard to determine right now. When do you think you could get, for example, margins back up to, say, 7%? Is that a 2026 project? Is that a 27 project?
Yeah. Now, I've told you some of the initiatives we launched. We launched 30 new projects, 30 new vehicles last year. We will launch 30 new great vehicles this year, and I think you drove yesterday some of these great vehicles. And we are up to a significant positive trajectory towards 2027. It's too early to say. We decided to give you an update on the German AIA.
And then in terms of sort of, because this is something that's very interesting to me as a CFO who's really in charge of allocating capital in a time of radical uncertainty, where is it for you certain to allocate that capital? Where, in terms of, because we have all this unknown about global growth, tariffs, where are you certain that those investments are going to pay off, and where are you putting that money?
Our capital allocation strategy focuses a very clear strategy. Look, we want to keep our market share in Europe. We are the biggest player in Europe, 25% market share. We want to re-engage in competition in China, 2026, 2027 onwards, and we want to grow in the US. And our capital allocation follows these strategic topics, and we have a very clear path behind that.
And then you've lost some market share in China. You've guided towards that about 2%. Are you confident that you will not lose any more market share? Are you now, do you think, stabilized in China for 2025?
The good news about losing market share in China in 2024, it's exactly as predicted and as we discussed that the year before.
Yeah.
So I would say we gave up market share because we tried to find a good compromise between prices and margin on one hand and volume on the other hand. And you should expect some more market share loss in 2025. And then 2026, I would say second, third quarter 2026, when we have all the technology in place, tech partnerships, autonomous driving, in-car infotainment, LFP battery, then we re-engage in the competition, let's say second half 2026.
You were so accurate in predicting how much market share you would lose last time. Do you know how much you would lose now? Is it another 1%, 2%?
1% is not a bad estimate.
And I'd like to get your sort of a reaction to some of the developments we've had here in Germany. We have not quite a new government, but we have one in the process. When the chief financial officer of Volkswagen wakes up and sees the headlines that the government is looking at reforming the debt brake, pumping potentially up to €1 trillion into the economy, what is your reaction to that? And how do you think it will impact sort of consumer sentiment and the broader economy in Germany?
First and foremost, I'm not in a position to give the German government advice.
No, but you have to adapt to what they do.
Yeah, exactly. If I look at the initiative, for example, for defense and the initiative for infrastructure, I think these are the right initiatives to the right time, but I would sleep much better if they would be accompanied by some structural reform, by also some savings in other areas to finance these projects.
Yeah, go on.
No. Look, I feel a little bit reminded like Volkswagen worked in the past. Look, we always, we had fixed cost problems in the past, and Volkswagen tried to outgrow these fixed cost problems with spending. And from my experience, you have to do your homework on the cost base first, or at least in parallel. Do structural reforms, as we did with Volkswagen, and then you can grow profitable. And this should be the way forward for our economy as well.
You can't outgrow your problems. You need to do the hard work of structural reform. So says Arno Antlitz, Volkswagen CFO, talking about Volkswagen, but also suggesting that might be good guidance for the German government if they're listening. Guy, really interesting conversation there. And Volkswagen telling Ollie Crooks then that they already feel like a US company. And you wonder how many others in the sector are having similar thoughts or wanting to express similar sentiments.
Yeah, it makes life easier, doesn't it, if you are a US company and you don't necessarily face the tariff story that maybe others will face. It's a tough line to walk, though, when you're looking at a European story that maybe is recovering. Let's stay with the space, figure out what is happening a little further down the supply chain, but an important part of the supply chain, literally where the rubber meets the road. Andrea Casalucci is the CEO of the Italian tyre maker Pirelli. The stock is up this morning, circa 0.5%. Good morning. Nice to see you. The proposition from Pirelli over the last few years has been go up the value chain. You are targeting a higher value end of the tyre market. In an economy that is starting to see jitters and concerns, and a global economy that is slowing down, does that make your business less cyclical? Does that protect you in some way from some of the volatility that may be coming towards the global economy?
Yeah, you are fully right. Look, 77% of our sales in Pirelli are concentrated in the high-value segment. Pirelli is leading the high-value segment in the tire industry, and high-value is a much less cyclical business. And so we feel more protected against the high level of volatility we have in the market today. And we have a strategy that looks for value, really, and that's what we focus on.
Does the higher value segment also protect you from the tariff story? Does it mean that your products are more sought after, consumers are more willing to pay a higher price, potentially post-tariffs? How are you thinking about how tariffs could impact Pirelli?
Yeah, of course, tariff will impact in case it will come, but we have two important elements. First, we have a mitigation plan to protect our supply chain flows against the potential tariffs. And second, as you correctly said, the high-value segment is more protected because we will be in the position to increase price in case and to protect the final value. Also because in the tire industry, the production capacity installed in the United States is far below the total demand of the market. And so this is creating the risk of inflation in case, but on the other side, the opportunity to rise price in case of tariffs.
What does that, you talk about the capacity there, what do plans for the future investment in the United States look like?
Yeah. Look, United States for Pirelli is the most important market. Today represents 20% of our sales. And we invested a lot to support the growth in the United States in the last years. We invested in terms of new products dedicated for the US consumers, in terms of growth with the American car makers, where today we have the same market share we have with the Europeans or the Chinese, but also we invested a lot in terms of distribution and brand. We partnered since 2011 with Formula One as sole supplier, and the popularity of Formula One in the United States is growing. They're doing an amazing job, and this is also supporting brand consideration and brand awareness. What we still miss is more capacity installed in the United States. And this was part of our industrial plans since years. And we have a small plants in Georgia, and we want to grow more. This was part of our plan before, and today, with the risk of tariffs, is becoming even more important and urgent. So we are accelerating in this direction.
To what extent, though? You're talking about Georgia, but you're also talking about partnering with some of the American car makers, largely based in Detroit and in other parts of the country. When you talk about accelerating that plan, talk to us about, first, the margin of expansion and perhaps the diversity of location within the United States.
We are evaluating. Today we are open. We are accelerating the evaluation with the local authorities and with the local institutions. And I'm confident that very soon we will be in the position to announce an important investment in production capacity in the U.S.
Andrea, your vice chair recently talked about a material investment in the United States. And Kriti talked about, the operations in Georgia and then other operations in Detroit. Help us get a sense of how material are we talking here?
Look, I said 20% of our sales comes from United States. Out of these 20 today, no more than 10% is produced locally. And so let's give you the feeling of the gap where we can grow. Of course, we will never arrive at the 100% produced locally because we have a global supply chain. We produce tires for United States in Mexico, in Brazil, in Europe, and this will remain the case. But we need to grow. And how much this is too early to tell you, but we are in the direction of having a very material investment in the United States.
So growing, maybe not quite doubling then, not...
It's early to tell you.
Too early to say.
We will come back very soon.
We're talking a lot about volatility in markets these days, and one of the areas we see quite a lot of volatility is in the euro. The euro is a lot stronger once again this morning, headed up to 109. Tell us how that figures on your radar. How much impact does this have on a business like Pirelli?
Look, we have been negatively affected by the Forex in the last 4 years.
By strong dollar.
Yeah, because of that. But to be honest, we have been able to grow in profitability and cash conversion year after year. So I feel that we will be in the position to deal with the volatility of the exchange rate.
You're still the sole supplier in F1. You're going into MotoGP bikes 2027. Talk to us about the effect of that. What does going into MotoGP, what does that deal done from 27 mean? How does that translate into what you do, the evolution of the product, but also the evolution of the bottom line for the company?
But look, being Pirelli the global leader in the high-value markets, and let me say, we just do this. This is what we do. We are the only tire player in the industry 100% focused on the consumer business. It means motorbikes and cars, leading the high-value market. And so staying in the motorsport for us is of paramount importance because of two reasons. First, we learn a lot from the competition, the track racing, because it's an open-air laboratory. Every day we learn something, and then we transfer the technology into the day-by-day activities on the normal tires. Second, powerful marketing tools to communicate, position the brands all around the world. This is the case of the relationship with Formula One, where we are sole suppliers since 2011. And that will be also the idea on the MotoGP. We still need to finalize some details in the contracts, but has been announced by Dorna that from 2027, Pirelli will be the supplier of the MotoGP, the sole supplier.
What needs to be sorted out? What needs to be sorted out?
Details.
Details. It's going to happen.
It's going to happen. It's going to happen.
I want to circle back to the relationship in the United States. You talk about how it's such an important market for you. You also talk about increasing some of that kind of exposure with the U.S. automakers. In those conversations, what have you heard from those clients when it comes to that supplying relationship? What are they worried about? What are they asking for?
Yeah. Look, the feeling I have is from all around the world, the car makers today, they need support in terms of innovation and capability to help them in managing the transition into new powertrain, electric vehicle, plug-in electric vehicle, and also the new software-defined vehicle concept. And so what Pirelli can provide to our partners is capability to innovate. Connected tires for us is of paramount importance. The introduction of digital and connectivity into the tire becoming smart and being able to communicate with the control units of the car and becoming a protagonist into the vehicle dynamic. That's a way. Sustainability is another way. Reduction of CO2 emission, percentage of bio-based materials.
Andrea, forgive me, that's an expensive prospect for especially American car makers, I'm sure German car makers as well, that are looking to launch cheaper models. How can you help them with that goal?
Yeah, Pirelli is not really targeting cheaper models or the synergic segment. We really focus on the high end, and what we can do for our partners and customers is really to support them in innovation, because at the end of the story, innovation and technology will provide also efficiency or pricing power to our customers.
So you're focused on places you have pricing power. What do you make of what's going on in Germany? Big change, big fiscal spend. You're focused on the consumer, the high-end consumer. VW CFO gave a little advice to the German government. What do you see in front of you in Germany?
Well, it's a big change. It's really a transformation. But I'm really confident that the European car makers, the German car makers, will recover the pace of growth. We are with them. We'll do all our best to support them. But in Europe, we have nice cars, sustainable, driving pleasure. I'm fully confident that they will be able to recover speed in terms of transition into EV and, again, innovation, technology, and connectivity on the cars towards the journey of the autonomous driving. Nevertheless, is a tough momentum, and they lost market share in China. This is a matter of fact, and this will be more complicated to come back to the previous market share. But I'm fully confident that they will recover speed and in Europe as soon as possible.
Okay, recovering speed seems a good place to end it on. Andrea, thank you very much. Thank you very much for joining us. Andrea Castellucci, the CEO of Pirelli. Let's have a quick look at the Volkswagen share price. We started this part of the programme with a conversation with the CFO of Volkswagen, and we've had earnings out from Volkswagen this morning. The share price moving higher, up by 1.6%. We're joined now by Bloomberg's Oliver Crook, who was speaking to VW CFO earlier. He's at VW's headquarters in Wolfsburg in Germany. Oliver, let's start with the earnings story. Something in there pushing the stock higher today then?
Yeah, so listen, I think that overall what we got from the earnings, and this is what sort of the market is pushing the stock higher about, is that basically a beat on a number of different metrics. This was never going to be a standout, exceptional year. The bar was fairly low going into it, and at the end of the day, Volkswagen was able to outperform, and they're starting to buy in a little bit to this idea of their turnaround, and really investors buying into the theory, because really last year was about making a lot of difficult reforms. It was about those job cuts, about the reform over and all those negotiations with the union, and in terms of what we got in terms of the actual figures themselves, you know, the operating result was down 15% last year. Revenue was basically dead flat. Volumes were down quite a little bit. And the operating margin came in at about 5.9%. That's down from 7% the year earlier. And they've guided this year to about 5.5 to 6.5 percentage points. But again, that is with a huge amount of uncertainty on the horizon, everywhere from tariffs to a sort of global slowdown. And also, of course, they still need to spend huge volumes of money to get this transition into the electrification, but also huge outlays in terms of the software and sort of recapturing market share over in China. Overall, what you saw in every single segment, from the cheap cars to the medium-range cars to the expensive cars, was margin erosion. But again, what they're really sort of trying to pitch to investors here is that they're at the starting line in 2025, and they're really sort of gathering pace going into next year.
Does that include China, Ollie?
Unfortunately, it does not include China. I think this is going to be another year of sort of Chinese pain for Volkswagen as far as they're concerned. And you think about the different challenges that they've got there. Obviously, there's the big macro picture in China. Overall, the market not doing very well. We should talk about also the luxury recession that's happening in China. That's not just in the auto sector. That's, you know, for the likes of LVMH and others. But they're really feeling it at the Porsche side and the higher-end models. But really, it's an overall story in China. The other thing that they're really needing to do here, and you saw I sort of demoed some of these sort of internal parts of the car that are basically designed just for the Chinese markets. Driving a car in China more and more feels just like driving an iPhone around, right? It's an entertainment system. It's not all about the sort of performance. This is something that, you know, for a German automaker that's really been historically concerned with performance, is a sort of uncomfortable territory for them. But they've got this Xiaopeng partnership where they're sort of really trying to build that out, and they're really wanting to hit those models and those concepts to hit the ground. And when I was speaking to the CFO a little bit earlier, they said that they lost basically 2% of their market share last year. Remember, Remember, they had about 15% of the Chinese market a few years ago. A couple years ago, it was down to 10. Now we're going to say they're about 8, and they said they're going to expect to lose another percentage point this year. So again, they're not going to have the uplift quite yet, but they're hoping that that will come in 26.
Bloomberg's Oliver Crook walking us through some of those uncertainties around the world for Volkswagen, joining us out of Wolfsburg this morning. We thank you so much. Coming up, we're going to stick with that German theme. Germany's Greens are ready to negotiate with a prospective next ruling coalition led by Chancellor in waiting Friedrich Merz over defense spending. Now, the party's co-leader tells Bloomberg she's hopeful of a deal by this week. We're going to dive into the details. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with, right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Only on Bloomberg.
Germany's Green Party says it's ready to negotiate with a prospective ruling coalition led by Chancellor in waiting Friedrich Merz over defense spending. Now, the Greens are demanding tougher rules for defense spending and criticizing the current proposal as too narrow and lacking in ambition.
We're not ready to just give a blanket check and a hand-free for just government spending without any structural reform, without any ambition, without any help for Ukraine. That's not what we are there for.
Okay, but you are, it's clear you are ready to negotiate.
Of course, we have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously, even though it has been obvious that we are needed for a majority. But we have been, signaling from day one that we are ready to negotiate.
Do you think at this point, do you think it's possible, given what you heard from your counterparts and your colleagues in those discussions yesterday, do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense spending, but we also need to realize that cybersecurity, there are new attacks on our security, and we need to be in a modern phase of security. And we need to make sure that we have all we need for our own country in terms of infrastructure. We in Germany, we have crumbling bridges. There's a lot to be done. And we need to do this now. And it's unfortunate to see that the new coalition is not ready to tackle the challenges, but just to pour over more money without really tackling the root causes.
The co-leader of Germany's Greens, speaking with our very own Tom McKenzie earlier today. Let's bring in Bloomberg's Europe executive editor Chad Thomas for the latest on this deal. Chad, we just heard there from the co-leader of the Greens saying that a deal is hopefully in the works. Talk to us about the likelihood of something that the markets are saying is already done.
Yeah, this seems pretty like it is going to move forward at this point. Obviously, there's still negotiating to be done. But what's interesting in that interview with Tom, what she was saying is no one has spoken to us yet. And I think what the Greens did yesterday was to send up a warning signal to say, if you don't negotiate with us, you're not going to receive our votes. And their votes are critical for them to reach this two-thirds majority that they need, because these are constitutional changes that they're talking about doing. But when you look actually at what the Greens then said yesterday afternoon, the proposals they had, they wanted to make sure that there was specific spending for Ukraine. That is something that the current government and the government that's coming in was already looking at. That seems like something that they should easily agree on. And they wanted to change a little bit where the money was spent, whether it's part of the regular budget or part of a special budget when it comes to defense. But it seems like now things are moving forward. We're hearing that there will be negotiations today between the Greens, between Friedrich Merz's Christian Democrats and the Social Democrats on a way to move forward on this and try to reach some sort of agreement, as she was telling us this week still.
Yes, just briefly, Chad, what does the process, how does it play out from here? I was reading some Deutsche Bank research that talked about the possibility of a constitutional court getting involved if it really went down to the wire. But do we have a sense of how it plays out?
Yeah, well, Anna, they have basically 2 weeks now to get this deal through. That's because the new parliament will start sitting in 2 weeks, and because of the election results where parties on the far right and far left won significant seats, they would not have the two-thirds majority needed to make those constitutional changes, because those parties on the far left and far right have said they won't support this. So really they're coming down to the wire, and any sort of constitutional court challenge then makes it all the more difficult, which is why they feel they have to get this through as quickly as they can.
Thank you very much, Chad. Bloomberg's executive editor for Europe, Chad Thomas. NFIB data, that's a focus for markets.
NFIB jolts, this meeting between business leaders and the White House with Trump involved. Fascinating. Yep. German the day ahead looks packed.
Ukraine, Greenland even. We'll see where the headlines come from. That is it for this program. The Pulse is next. This is Bloomberg.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning from our global headquarters in New York. I'm Manish Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Crawling back from the worst day since 2022. Futures rebound after a sellout wipes out $1 trillion off the NASDAQ 100. Prepare for concessions. Secretary of State Marco Rubio outlines what's his roadmap for peace in Ukraine. And Delta warns on the economy and cuts its profit forecast in half. Good morning, Manis.
Danny, good morning. The very essence of U.S. exceptionalism may be on pause, and that's that narrative everywhere from Delta through to Ed Yardeni. Don't panic yet. Citi say exceptionalism in U.S. equity markets, which are trying to find their feet this morning, is on pause. The S&P on the brink of a correction. Consumer discretionary is the only sector which is fully corrected. The NASDAQ, the worst day since 2022, again, trying to find its footing this morning. The Mag 7 is off 6% yesterday, down 16% for 2025. To the bond market, 24 hours ago, we looked at these bond markets. They were down by 5 basis points. The 10s collapsed by 10 basis points. And suddenly, we're pumping up a much earlier and more aggressive Federal Reserve. 83 basis points of cuts potentially this year, 40% probability of May. So suddenly, Danny, even after the New York Fed inflation, steady as she goes numbers, this market at the moment is definitely looking at a risk reward towards 4% rather than back at 450 at the moment.
Yeah, that move in equities is a rebound. We opened in the pre-market session down by nearly 1%. Part of the souring attitude also came in the form of earnings. Here's what we saw yesterday from Delta. And the pain continues this morning, down nearly 10%. It cut its profit forecast, lowered its guidance for revenue growth and operating margin. Most notably, and maybe this is why it upset wider markets, it cited weakening travel demand with consumer spending and consumers in general under pressure.
And Tesla rebounding after the worst day in more than 4 years. It came after growing concerns on Wall Street about demand for the company's electric cars.
And by the way, Trump said that he would buy one to support Tesla. So if you want to know where the Trump put is, it's with Tesla stock. Meanwhile, Oracle down 1.8% in the pre-market trade. Sales and profit forecast for the current quarter fell short of estimates. Still, it did point to a surge in bookings and also said that its growing cloud infrastructure business will boost revenue.
In just a few moments, we will address some of those market concerns. Ella Hodja of Newton Investment Management. Later in the hour, Laurie Calvasina of RBC Capital Markets. That is a brilliant image. I've got this image of this gold Cybertruck, Donald Trump in it with Elon Musk on the other side, doing a victory lap down Pennsylvania Avenue. There's an image for you this Tuesday morning.
Yeah, but it's kind of the point that, like, he'll step into the market for Tesla specifically, but not the wider market. I thought it was really telling that White House officials yesterday were asked about this market sell-off. Their response, we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, and the latter is more meaningful. So they're saying business leaders are still okay, and notably, Trump is going to be meeting with business leaders for a roundtable today. We'll see if they can throw him off some of this idea that he shouldn't be stepping in, or maybe make him enact tax cuts quicker.
Yeah, well, we've got Jane Fraser, Jamie Dimon going to the White House. What are they going to say? There was a hurrah moment that these deal flows and deal tickets were going to come piling in. That simply hasn't happened. On the IB with Tim Graff over at State Street, and he says, calm down a little bit. Put this in perspective. The S&P 500 is back to where we were 6 months ago. Your risk is the CPI tomorrow. We were talking about vol and vol shocks. He said, just restrain the language. The biggest risk is that you go into tomorrow, and that's where you have a much bigger risk on the CPI, and that could give you a risk parity moment.
Yeah, the economists are seeming worried, though. Mohamed El-Erian writing in the FT this morning saying, essentially, even if the journey, the destination is a good one, the journey could be a problem, that a bumpy journey could shake confidence in the U.S., and that will undermine one of the greatest strengths of this country, which is that confidence in our institutions.
Absolutely, but of course that takes the consumer. Let's talk about this volatility. It's driven by recession fears. It's cutting through the market. Citigroup downgrading their view on U.S. equities to neutral, citing expectations of negative U.S. data. For the White House's reaction to the recent sell-off, we're joined now by Kevin Whitelaw. Kevin, I want to pick up on what Danny said, which is you got the business leaders going in there today from banking to Cisco. And there's a great line from Neil Dutta over at Renaissance. Powell is not ready to pivot, and Trump has no reason to turn the dial back. Do you think that those voices from business will be pushing for a switch in the dial today? Good morning.
Yeah, good morning. Look, the businesses have a complicated sort of message that they want to, go in there. They came in very excited about elements of Trump's agenda. Many were very much in favor of the deregulation agenda. They're looking for ways to free up the ability to do business more quickly and more with more flexibility. They're also looking at particularly this tariff fight, which is emerging, and that is really alarming a lot of them. And just the unpredictability of it is making it incredibly complicated for companies as they try to figure out how to do some medium to long-range planning. And so, they are going to try to figure out how to calibrate that message to Trump, understanding that, he's often not receptive to criticism to his face, as I think the Ukrainian president found out recently.
Yeah, but at the same time, Kevin, it was the automakers who convinced Trump to step back or at least give a delay in auto tariffs, so maybe business leaders can do the same thing. Trump has a lot of influences coming in right now, along with the business leaders. He constantly has Musk in his orbit. Yesterday, Musk was on Fox talking about entitlements, saying most of federal spending is entitlements, so that's like the big one to eliminate. How is that going to go down on Capitol Hill, Kevin?
Well, in any other previous political era, that's what we would call a gaffe, to come out and say the thing that your opponents have been accusing you of wanting to do. While you're denying it. President Trump, in his campaigns, had always talked about protecting Social Security, but obviously with Elon Musk using the word eliminate anywhere near that entitlement spending, that's red meat for Democrats who are obviously extremely worried about what that's going to mean and what that's going to mean for obviously the millions and millions of Americans who depend on that money, and with sort of the access that Doge has had to some of those accounts, with the lack of transparency over what exactly is happening there, and all of the changes in leadership, there is a lot of concern about this, and this is only going to feed that. So that is going to concern lawmakers, not just Democrats, but also a number of Republicans.
Kevin, the momentum to some kind of a cessation of hostilities between Russia and Ukraine is building. Rubio, on the way back from Saudi Arabia, made it very clear that Ukraine's going to need to make some territorial concessions. So what is it that the Russians are going to want before they go for that cessation of hostilities?
Well, the real question here is, what is Putin feeling any real pressure to come to a peace deal? He's obviously been feeling like he's got a somewhat stronger situation in the way the war has been going, been gaining bits and pieces of ground, been able to inflict some damage in Kyiv, and seems to have a much more sympathetic voice in the White House, someone who's much more critical of Ukraine. And so in that sense, the real question is, what is Trump going to do, if anything, to force Putin to the table and to really actually make some deals? He's going to be looking for guarantees that there won't be a real NATO presence in Ukraine. He'll probably be looking for restrictions on the size of the military, and obviously looking for as much territory as he can get. In that, Ukraine, meanwhile, is going to try to figure out how it can come up with some kind of situation that will not simply allow Putin to regroup and then launch another attack in a year or two or three.
Kevin, we really appreciate the update this morning. That is Bloomberg's Kevin Whitelaw. Let's get you some other stories now that are trending on the terminal this morning. Volkswagen expects profitability to remain roughly flat this year. The car maker bracing for lots of challenges, from trade tensions to declining sales in Europe. It's also under pressure to stabilize China performance, where it's been losing market share to local manufacturers like BYD.
Germany's Greens are hoping for an agreement in the dispute over defense spending. The party's co-head spoke to Bloomberg on how likely a deal could be.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
Elsewhere, YouTube star Mr. Beast's company, Beast Industries, generated $250 million in sales from its chocolate business. Feastables, that was last year. Over the same stretch, his media business, which includes his YouTube channel, his reality TV show, produced similar sales but lost almost $80 million. Beast Industries is currently looking to raise a couple $100 million to expand its existing divisions. So chocolate, that's the moneymaker, not media. Anyway, we are going to cover the market sell-off, bond yields falling 10 basis points yesterday. Newton's Ella Hoja will be joining us next on Your Brief.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's your Bloomberg Brief. Danny Berger and Manus Cranny here in New York. A couple things, Manus, yesterday upset markets. For one, Trump saying that he's not denying that a recession might happen, but then concerns about the consumer. We got this from Delta yesterday in their earnings. They put out this statement that the outlook has been impacted by the recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. Even before we got that, we had the New York Fed survey of investor expectations. And in that, you had investors, consumers rather, growing more pessimistic about their finances. About 27% expect their year-ahead financial situation to be somewhat or much worse off, the highest level in 15 months. Joining us now is Ella Hoja, head of fixed income at Newton Investment Management. Ella, some of the sentiment readings continue to sour. Some of the businesses are telling us that consumers are worried. How much of what we're seeing in markets is just vibes, is just a retrenchment of things that might have gone too far, versus an actual change in economic fortunes?
Well, we had to price out quite extreme consensus coming into markets this year. As we like to say, a contrarian approach actually has paid off quite well, particularly over the last few years, and we believe it's the same this year. So you take out some of that steam from whatever was priced coming into this year. But then on top of this, I think you're adding quite a bit of uncertainty, which is warranted in the sense that we have a policy backdrop ahead of us that we have to process and digest in a very different way. So you take away some of that optimism, I guess, and give way for uncertainty around what might be happening with short-term inflationary pressures, what's happening to growth, what's happening to jobs, because there's been a deterioration trend there in place for some time now. And so I think that's kind of fair and warranted, I guess, to have a bit of uncertainty going up and therefore sentiment souring down because of that.
Ella, in 2 very short months from whence we were in Davos to where we are now, there's exuberance around exceptionalism in the US. That is now being questioned. But a lot of people are very hesitant to throw in the towel on US assets. We're not at that point by any stretch. So where are we in the recalibration?
I mean, look, I think my view at least is that we probably need to tone down expectations further over the short term. And what we've heard from the policy put element that the markets have got accustomed to, let's say, at least over the last 14, 15 years, that there should be a pricing out at least to some extent of this put option. Therefore, I think at least from an equity stance, a lot of the darlings of the trades that we've seen over the last couple of years, as you see, are getting dented. But this is also where a lot of concentration has been in markets. And we've talked about this level of unprecedented concentration in certain sectors in equity markets. And so I think you have to at least price some of that away and then maybe give way for an increase in probability that there is a risk here. I'm not going to say, a certainty, but there is an increased risk that you might be facing a recession potentially in the US in the months ahead of us. I think we have to at least put a 50 to 60% probability to that, in which case then probably the risky assets will be hurt further over the next few months.
Wait, Ella, just to be clear, you see a 50 to 60% odds that we're going to get a U.S. recession in the next year?
Yes, I've tried to stay away from the R word, as they say. But I mean, look, we operate in financial markets. I like to think in probabilities. It's important to do so as your landscape is changing, as we were saying. So has your view, right? And so it hasn't been our core case for this year, I will admit, but it's certainly been increasing in probability. And therefore, the way we assess credit markets as a result also has evolved in the sense that you probably need a bit more premium, I guess, to own, particularly the riskier parts of credit, such as high yield.
So if you're at 60%, give or take, on a recession, that presumably makes the bond proposition, sovereigns, a lot more attractive, perhaps relative to high yield or to investment grade. So what does that do to treasuries at 60% probability for a recession?
Well, look, first and foremost, before answering that question, I want to say this remains a trader's market, right? So this is great for macro. It's great for people who can be active. And therefore, as a result, I think with this increasing odds, you probably have to trade that rallying for rates. So as you say, sovereign bonds look attractive here. Bonds have looked attractive to equities for some time now. And, as you've seen year to date, we've certainly outperformed. And I think that trend can continue. But, and this is an important emphasis, I don't know that that's the case for the rest of this year, because I do believe that policy responses will follow. That's number one. And second, on the fiscal setup, we are looking at the possibility of extending tax cuts in the US. So maybe that that will buy us some breathing room. And last but not least, I don't see that if indeed this, let's say 50 to 60% odds of recession play out, I don't believe that we're looking for a deep recession. It's probably more nuanced in the sense of a shallow recession as balance sheets remain healthy, at least on the private side. And so I think with that in mind, I would probably say that you trade away from that. So initially we trade the rally in bonds, but I suspect later this year we might be flipping that view around.
Ella, just quickly, because we have seen some investment grade and high yield bonds waking up. Some of the spreads starting to widen yesterday, the biggest jump for high yields since August. Is credit finally waking up? Because spreads have been so tight even in the face of equity selling off.
Yes, and it's probably the most complacent view out there is that perhaps a little bit of widening, but no drama in credit. Look, in recession, credit moves, no doubt about it. So your excess returns look less attractive. And so you, as a bond manager, you have to give yourself some space here. Either increase your cash holdings, hedge some of your bets, or reduce some of your holdings which are looking rich. So I would say yes, absolutely. And I think credit is pretty well held in general. So if there is a surprise in bond markets this year, maybe it will come from credit. I don't want to be, very dramatic or dogmatic about it, but I'd certainly play the risks the other way.
No, you've made it very, very clear. This is a trader's market, and perhaps to a certain leg lower in this bond market is already in that price. Ella, thank you very much. Ella Hodja of Newton Investment Management with her calls on the market. Waking up credit. Good morning from Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry,
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back to your brief. Let's take a look at some of the front pages this morning. The Washington Post leads with this. on reports that the NIH will cancel or cut back dozens of grants related to vaccine hesitancy and uptake. People at the NIH and HHS did not immediately respond to requests for comment from the Washington Post.
Next up, on Bloomberg, Russia says its air defenses downed 337 Ukrainian drones. This was overnight. It seems to be the largest attack on its territory over the 3-year-long war. Now, the attack occurred as Ukrainian and U.S. delegations are preparing to meet in Saudi Arabia.
And the Financial Times has this, that Delta has cut its profit expectations for the first quarter roughly by half on weakening travel demand. It also lowered its guidance for revenue growth to reflect a $500 million reduction and for its operating margin. Let's get more on the story. Joining us now is Bloomberg's Benedict Campbell. Benny, just how weak is domestic travel in the U.S.?
So according to Delta, it's considerably weaker than they previously expected. The big takeaway from this is really that a couple of weeks ago, early in January, the company came out and said things are looking really strong, really robust demand. The visibility into the spring quarter is great. And here we are, sort of 6 to 8 weeks later, and we're faced with a very different picture. As you said, it's domestic travel. It's the leisure part of the market that is at risk here. Delta does a lot of domestic travel. About 50% of their business is on that side. So they're really quite uniquely hit by this. It's the transatlantic and the international business and the corporate travel that is still doing reasonably well. But this was a bit of a shock to the market. They said this ahead of a conference that's happening today in the US. It's a big aviation conference with a lot of executives speaking. So you might get similar comments from other airlines coming out of this. So Delta certainly set the tone, and it was a really negative one.
Benny, good morning. They keep the full year guidance the same, and that takes some of the analysts to the view that this is a transitory moment. Do the capacity that's been taken out of the system create some kind of a flaw in terms of the overall earnings for the industry?
Yeah, you're probably right. If you look back into last year, we had a lot of overcapacity, and that was taken out of the market step by step. And you saw some really good numbers. If you look at companies like United last year, they had a really cracker end of the year. They did well. Delta, again, as I said at the start of this year that things are looking good. But for a lot of domestic passengers, flying is also, there's a little bit of psychology built into that. It is, do I have enough disposable income? Do I really need to take this trip? And then don't forget, we did have a number of really scary events in the US aviation market in the last couple of weeks. We had the mid-air collision in Washington. We had that Delta plane that landed on its roof in Toronto. And again, that contributed to it. The CEO came out yesterday and said, look, flying is still safe, but a lot of people, alongside looking at their wallets, might think, do I need to take this flight? Might I stay at home? I just don't feel very safe at the moment. So that also contributed to that.
Delta having a very painful reaction this morning, down nearly 12% at the lows of the pre-market session. Benny, thank you so much. That is Bloomberg's Benedict Campbell. Now, coming up, we're going to be catching up with Lori Calvasina as equities attempt to stage a rally. Will it stick? We're up 0.4% on your S&P 500 futures. Your 10-year yield, a little change this morning at 4.2%. This is Bloomberg.
To succeed in Wall Street, What skills do you need? Do you need to be somebody that claws people in the back, people that you have to be tough, you have to be fighting people all the time? What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
Crawling back from the worst day since 2022. Futures rebound after the sell-off wipes out $1 trillion from the NASDAQ 100. Prepare for concessions. Secretary of State Marco Rubio outlines Ukraine's roadmap for peace. And Delta warns on the economy and cuts its profit forecast in half. Danny, good morning.
Good morning, Manus. Delta down sharply in the pre-market, but you might feel a little bit better looking at this. We are moving higher in the futures session. It is a NASDAQ 100 that's up more than 0.5%, but can it hold? We are now at a peak-to-trough loss of 8.5%, making it the biggest sell-off for the S&P since 2023. Tech was by far hit the worst. NASDAQ falling a whopping 4%, its worst day since 2022. Tesla saw its worst day since 2020. Citi cuts their view on stocks. HSBC cuts their view on stocks. You also had a bond market rally yesterday, the front end rallying by as much as 11 basis points. But we are calm, cool, collected this morning. We are little changed. We are under 3.9% for your 2-year yield and at 4.2. Basically on the dot for your U.S. 10-year yield, Manus.
I love that, Danny. We're calm. That is like a paddling, duck underneath there.
I don't know how long that lasts.
And we've just had a conversation with Ella Hodger, and she said, look, this is a trader's market. She's not calling a recession, but the probability of a recession has risen in her view, 50 to 60%. How much of that is not in the credit market, but is in the sovereign bond market? That's the kind of dislocation, perhaps the next dislocation in these markets to come.
You're finally getting credit markets that are wakening up. Yeah. You're finally getting credit spreads that are widening. For high yield, it's their most since the summer of last year, but it's not really yet enough to ring the alarm bells. I think that's the interesting dynamic to watch. At what point does it move from a repricing to something that looks more panicky?
And I think you made a good point the other day. We were chatting to another guest about credit, and as Danny said, look, the credit markets are something a little bit different to what they were under Trump.
They're higher quality.
They're higher quality, perhaps a little bit of a moat in the financing there. One word of restraint from State Street, which is calm down. The S&P 500 is only back to where it was 6 months ago, but it's the speed with which we have repriced, and perhaps that's the more virulent point. So let's just bring that to Laurie Calvasina. She is the head of U.S. equity strategy over at RBC. Laurie, good to see you. If anything, you've been absolutely stoic and on the button with your calls from the upside and U.S. exceptionalism. Here we are. In the break we were talking about, you said, it feels like a little panic. My question to you is, it feels like a little bit of a panic. When does it morph into something much more significant on the downside risk?
So look, it's a great question, and I think, unfortunately, we're at the battleground. So 5 to 10% drawdowns are not out of the ordinary, and we're getting close to that 10% mark. And what we've seen historically is when you do kind of get to that 8, 9, 10%, you get little hints of panic, and that's where something needs to change. If I think about my kind of bottoming indicators, things I've used over the course of my career, I would say AAII net bulls, you're hit GFC lows. Unfortunately, you do tend to get stuck there, so you can't just sort of say we've kissed that low, we need to rebound. I really want to see the CFTC data on Friday, which will tell us what institutions were doing yesterday and what they continue to do today. That indicator on U.S. equity futures positioning has been like first, maybe second inning, if I'm being generous, in terms of unwinding from peak. So, but when it falls, it does tend to fall pretty fast and pretty sharp. So I want to see where that is. And if I think about earnings revision trends, that's another one that tends to be a good bottom indicator. And we're still sitting at like 42% upward earnings revision. So we haven't really downward adjusted earnings yet. So, and then I'm not going to try to predict the news flow, right? Yeah. But that has certainly been a big part of this. And I'll tell you, Manus, 2 weeks ago, I was on the road seeing investors. I'm not going to tell you which part of the country because I'll give too much away, but I was talking to investors, and it was the first time all year that I saw equity people say, maybe there's not a Trump put, maybe these tariffs are for real. Up until that, it had been insistence, this is just a negotiating tactic, and there's a Trump put, where is that? Let's debate that number. And and I think the administration, right, has been sending various messages over the last, kind of week and 24 hours, 3 days, whatever, and they're sort of sending that same message. So we kind of have to go through that, and we do need to see if some of the messaging changes.
Yeah, again, yesterday, a White House spokesperson saying we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, and the latter is obviously more meaningful. I have to say, Lori, it almost rhymes with people who say the earnings are what's important. To your point, the earnings are important. We haven't seen a change. But considering what we heard from Delta yesterday, saying that the consumer is starting to look weaker, you and the team are really good at looking at corporate statements. Yeah. Are you starting to see the first glimmer of a change in corporate sentiment?
So I'll tell you, I wasn't doing a lot of reading of transcripts last week, but I was at the RBC Financial Institutions Conference, and they do a fantastic job every year of getting a lot of the banks together. And so they've got the big investment banks everybody looks at, but they do a great job of also getting the mid and smaller cap banks, which really have their pulse on the economy. And there was one company, and again, I can't talk about companies on live TV, but there was one company that said something that was echoed by a number of others. And and by the way, this bunch was pretty bullish on the new administration and the regulatory backdrop, okay? So it was a pretty friendly audience. But they were saying, look, all the stuff we're seeing, all the noise out of Washington, all the uncertainty that's emerged, it's having an impact on day-to-day conversations. And a couple of companies use the word pause. And I think this idea that we are undergoing a sentiment shock, we see all the different categories of vibes breaking down: political vibes and the net approval and polling data, investor vibes and sentiment and fund flow data, corporate vibes, have probably been the most resilient if you look at the consumer, the CEO confidence survey from Conference Board. But even there, they've taken a bit of a dent, and they're noticing that there has been an impact. And so we can talk about animal spirits all we want, but the reality is that consumer vibes, investor vibes, corporate vibes, those all end up potentially having an impact on business activity. So just because we haven't seen a massive deterioration yet, number one, doesn't mean that we won't see it. And number two, what I heard from the banks last week is that it may be starting. That this whole idea of, kind of the surprise, the confusion, the shock, it's at nothing else starting to cause some people to pause.
Well, certainly in the New York Fed, unemployment, delinquencies in credit, access to credit. I know it's New York as opposed to Michigan, talk about the politics of Michigan. Tell me this, what we have is we've had essentially a blue collar recession. We are now, the prospect is that a white collar recession gaps down and meets the blue collar. So that is what is ahead of us, potentially ahead of us over the next 9 months. What is the consequence of that, the risk of that, and the consequence of that for how you invest?
So one of the things I've been very concerned about is that if you look at the Michigan survey in particular, and they do a beautiful job of sort of breaking out the different income cohorts, you could see this dominance and this kind of better vibe, so to speak, of the high-income consumer. And the low-income consumer was feeling worse, and then post-election, the low-income consumer moved up and the high-income consumer moved down. And now actually they're all stalling, so you're not even getting that recovery in the low-income consumer anyway. But the problem with that is that if you look at the S&P, GDP. It's really, if we think about those retailers and those consumer-oriented companies, for the last year, they've been telling us the low end was weak and the high end is strong. And so the overall consumer picture looks pretty good because that high-end consumer has felt great and they've been outspending money. And so the question is that going to hold up? It is the math of GDP. The math of GDP works differently than the math of elections. And that math of GDP, what I'm seeing in that sentiment data, is at risk. Now, again, we don't know, and I'll give the person who made that statement yesterday credit, we don't know to what extent that's impacting actual activity yet. We need to be very vigilant on that. But that is the risk in here, that we're taking this thing that has propped up consumer spending and propped up earnings and hurting it.
Well, maybe it makes sense then that the banks have sold off so hard, if that's kind of the vibe that's changing. Tech has also been hurt really hard too. We're entering something that looks kind of like a tech bear market. In that kind of wreckage, is there anything attractive to buy, or would you hold off for now?
So, we've kept our overweight on financials on, and we've said, there's going to be some short-term pain there, right? Because the financial sector does tend to trade closely with the University of Michigan consumer sentiment data. So it is the plumbing of the economy. It is going to get hit by those vibes. But what I did hear last week at the conference was a very calm and confident set of management teams, and they're not seeing any kind of cracks underneath the surface. So I think they can manage through this, and there's probably a buying opportunity in there. And we have even noticed in our weekly this week, they were starting to get a little expensive and the valuations have started to improve. Now, tech is something different. We've been more cautious there. I think you've got international investors selling their U.S. stakes, and all the time I spend in Europe, and as I'm sure you know this well, like they want to talk to me about tech every time I go over there. It's tech, it's Mag 7, it's the growth trade, right? And that's how they've been expressing their U.S. bets. We are seeing in the PFR data, they are starting to move into Western Europe. They are starting to move into Germany. We are hearing from this administration, Europe needs to spend more in Europe. That doesn't sound to me like an argument for buying the U.S.
Really interesting. Lori, it is so great to have you on. Thank you so much for joining us this morning. That is Lori Calvasina of RBC Capital Markets. Let's now get some other stories that are trending on the terminal this morning. Volkswagen expects profitability to remain roughly flat this year. It's bracing for many challenges, from trade tensions to declining sales in Europe. The company is also under pressure to stabilize its performance in China, where it's been shedding market share to local manufacturers led by BYD.
Germany's Greens are hoping for an agreement in the dispute over defense spending. The party's co-head spoke to Bloomberg on how likely a deal could be.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
YouTube star Mr. Beast, his company, Beast Industries, generated $250 million in sales from its chocolate business, Feastables, last year. Now, over the same stretch, his media business, which includes his YouTube channel, his reality TV show, produced similar sales, but it lost almost $80 million, so he makes more in chocolate than YouTube, basically, is the read on that. Beast Industries is looking to raise $200 million to expand its existing divisions.
That story actually makes you smile. There you go. Makes everybody smile. A little bit of chocolate. Coming up in the show, top of business executives, they're heading to Washington today to meet President Trump. That business roundtable, what is on the agenda? We'll give it to you right here on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's your Bloomberg Brief, Danny Berger and Manus Cranny in New York. Now, a rough ride for stocks yesterday. The NASDAQ falling the most since 2022. Downgrades abound. U.S. downgrading U.S. equities, saying U.S. exceptionalism is, quote, at least pausing. You also have HSBC saying that there are better opportunities elsewhere, also downgrading their view on U.S. stocks. In large part, some of that was in reaction to policy uncertainties and fears that President Trump's comments mean that he will not be stepping in to save this equity market. Let's get now to Washington, D.C., where Bloomberg's Tyler Kendall joins us. Tyler, we had a very large sell-off, and in Trump point 1.0, this might be the type of sell-off that people would say, surely Trump will step in and do something to save this equity market. Has there been any indication at all from the White House that they're willing to do something along those lines?
No, Danny, at this point, it does appear that the White House has sort of a higher tolerance during this term compared to the first term, giving us no indications that they even have plans to change how their policy rollouts have come out, and but so much uncertainty that we know that the market would like to see and has contributed to this change in market sentiment. Now, we did get a statement that hit our inboxes yesterday right after the markets closed from a White House spokesperson who told us reporters that they want to emphasize, quote, that we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, appearing there to blame emotions rather than fundamentals for this sell-off. And I can tell you that officials keep trying to point to us to recent investments that have been made under this administration. For example, TSMC last week with a $100 billion pledge as evidence that their policies might be contributing to some longer-term growth policies here. But the question really remains, at what point would the White House step in to provide some sort of assurances here? Or are they going to continue to double down on what has been their recent messaging, which is that this is part of a broader macroeconomic agenda and that consumers and investors alike have to be a little more patient? We could get some more answers potentially later on today. President Trump is expected to address the Business Roundtable here in Washington at 5 p.m. Eastern. It's a coalition made up of some top Wall Street executives. We're still chasing exactly who will be in that room, but no doubt, Danny, they are going to be looking for some firmer guidance from President Trump.
Tyler, let's just extrapolate that a little bit further. You know, the tech community or the billionaire community are $200 billion lighter in their pockets since the inauguration. That's the kind of number that's being bandied around. Jane Fraser and Jamie Dimon are going to go in there. The deal flow is lighter than they had expected. What is it that this roundtable will talk about? What do you think the show and tell will be in the press conference?
Right. Well, they're going to be looking for firmer assurances about President Trump's tariff plans in particular going forward, what sort of uncertainty we can see or what sort of reliability we could expect from this White House moving forward, because there's been a lot of conversations about how this policy perhaps has been going out of order here, right? That instead of first pushing forward perhaps tax cuts, we've seen so much uncertainty around that tariff agenda. But importantly, on those tax cuts, you have to remember that the last time President Trump addressed the Business Roundtable here in Washington, Washington right before the election. That was when he had floated that he was going to cut the corporate tax rate. That was the pledge that he made during that meeting. That is probably something that they're going to want to know whether or not he's going to make good on that promise, as Congress continues to have disagreements already on how to get President Trump's tax agenda through. We know that right now they're considering the stopgap measure to fund the government through September 30th. That indicates to us that Republicans know that this is going to be a fight that is going to take many months to accomplish.
Tyler, elsewhere, we had Musk on Fox Business yesterday talking to Larry Kudlow. Let me just read you what he said. He said, most of the federal spending is entitlements, so that's the big one to eliminate. Tyler, how is that sentiment going to be received on Capitol Hill?
Well, it also goes directly against a pledge that President Trump has made, which is that he will not touch Medicaid or Social Security. And this is going to be a very politically fraught issue for Republicans, but it is something that they already were grappling with before Elon Musk made his comments. We have to remember that the budget blueprint that they are working for in order to get President Trump's spending cuts and tax cut agenda off the ground currently allocates $880 million to the committee that oversees Medicaid to find those spending cuts. How the reconciliation process works is that committee is going to have to find those cuts somewhere. They could go to other programs, but the bulk of their jurisdiction oversees Medicaid. And just for example's sake, if $880 million in cuts went towards Medicaid, it would slash their annual budget by 10%. I was pretty struck by some statistics that came out by a database kept by NYU. 37% of House Speaker Mike Johnson's constituents in Louisiana are on Medicaid. This is going to be a very difficult vote, but at the same time, you have to balance it with fiscal hawks in Congress that are going to be looking for those deeper spending cuts, particularly to try to find these pay-fors, find these savings in order to get President Trump's tax cut agenda through, which brings us back to the beginning of the conversation, which this is really a big pillar of that macroeconomic plan, that fiscal agenda that this White House is banking on for long-term growth.
Yeah, in that interview, he says $500 to $700 billion worth of savings, but he calls it a money magnet for illegal immigrants. Definitely one to watch. Tyler, thank you very much. Tyler Kendall there, tracking the political stories. Let's pivot to the corporate side of the U.S. narrative. U.S. airline stocks slumping this morning. Delta slashed its profit forecast. You can see that Delta down almost 11%, and the rest are being dragged lower. Delta's sharp reversal from the start of the year when the CEO, Ed Bastian, gave an upbeat forecast. Let's get to Benedict Campbell. He's got the story. Benny, this is a dramatic reversal of optimism, clarity, and a roadmap at the start of the year. How much of this is to do with the political and economic uncertainty?
Well, if you listen to Ed Bastian, the CEO of Delta, speaking yesterday, actually quite a lot has to do with this. You've got to remember leisure travel in particular, domestic leisure travel, there's an element of psychology behind that. You know, it's discretionary spending. People might think twice where they put their dollars right now. We are in a phase of real uncertainty in terms of where the economy is going, where the stock market is going, where people's savings are going. And in that kind of phase, more people are halting their travel plans, or at least reconsidering them. And that is the sort of thing that is poisonous for the aviation industry. Delta was first out of the block with this one yesterday. There's a big JP Morgan conference this morning in New York with all the major airlines presenting, and you could well imagine more dire comments, particularly warnings coming out of that. So watch this space. As you said, we saw this trickle through the entire industry yesterday. Even over here in Europe, you look at big companies like IAG, like Air France, like Lufthansa, all down because that has a real chilling effect on the industry.
Benny, but how much of this, and we've seen this happen before with corporations, is just using it as an excuse versus a strategy pivot, strategy hole, something like that, that maybe is also affecting Delta?
Yeah, there is always that element. As you said, we've been there. You have these big external shocks, you know, be it the pandemic, be it, you know, the financial crisis, and then companies come out and say, oh, this was because, you know, issues that were beyond our control. Difficult to say this time, but the timing does give a sense that maybe they are onto something here, because just a couple of weeks ago, Ed Bastian said, things are looking great, the demand is there, the spring quarter's strong, we've done our homework, we've taken capacity out of the market, pricing is solid, and here we are now. So really, there does seem to have been an external shock One of them, as I said, the concern about the economy, the tariffs. The other one, not to be underestimated, is the crashes that we've had in the US, the dramatic, mid-air collision in DC in January, then the Toronto plane crash that involved a Delta plane, and more people anecdotally asking themselves, is this still the mode of transport that I would choose? Might I put off a trip right now? Do I really want to get on a plane? So these things do contribute. We'll get back to normal on that front, and if the economy does bounce back, or at least the sentiment, then people will start flying again. But right now, we're in a bit of a toxic mix of people worrying about the safety of flying and worrying about their bank balances.
As I say, a really dangerous combination. Benny, thank you so much. Bloomberg's Benedict Campbell. Delta shares down more than 11% in the pre-market. Should that stick, it will be the worst single day for Delta since 2022. Okay, coming up, retail earnings and data on deck will set you up for your day ahead on your Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Let's get you set up for your trading day on this Tuesday. We have some retail earnings. We're going to get Kohl's and Dick's Sporting Goods, all that before the bell. We're also going to get JOLTS. Those job numbers come at 8:30 a.m. Eastern. And finally, President Trump is set for a business roundtable of CEOs, JP Morgan, Citi, Cisco, among others. Will they encourage him to speed up some of the good stuff like tax cuts, Manus?
Yeah, well, the deal flow that they've had hasn't been up to par. A couple of stocks to watch. Tesla leading the Mag 7, stock rebounding after tumbling the most since 2020. That was a brutal day yesterday. Maybe the message from the president ready to buy one helped. Oracle down over 1%, extending post-earnings decline, Danny, after weaker than expected results, and Kohl's dropping ahead of their earnings. They're going to hit before the bell. Danny.
Meanwhile, just want to leave you with an image of the euro this morning. It is trading at 109. It is at the strongest level versus the dollar since November. Some signs that the Greens might indeed reach a deal with the German party in order to get more spending and deficits higher. All right, that is it for your Bloomberg Brief. Surveillance will take it from here.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday following the biggest one-day loss so far this year. Equity futures just about stabilizing after getting hammered in yesterday's session. The sentiment shift has been absolutely wild, and the cuts to corporate guidance begin. Delta Airlines first out of the gate. Big declines this morning after slashing its outlook for the first quarter. The airline pointing to, quote, recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. That stock is down. The other airlines are as well. The question we've got this morning, Who's next?
And the question here is, how quickly is this moving? To your point, earlier this year, in January, Ed Bastian, the CEO of Delta, said the supply-demand balance is as good as I can ever recall it being as we look into 2025, saying they had visibility. And suddenly, something shifted dramatically, and they said, we really do believe this is a domestic issue. It's not just who's next. It's just how quickly this is moving and how much the sentiment data really is going to be the key driver.
And later this afternoon, President Trump will be sitting down with a number of executives, and he will get a grilling about what is going on in terms of why you have this uncertainty. When you look at what corporate executives are saying, when you look at some of the survey data, the write-in statements, people are concerned about the direction of travel when it comes to tariffs. Chuck Robbins, the Cisco CEO who leads the Business Roundtable, had this to say in January: we won't always agree, talking about the Trump administration, but I feel confident that we'll have an opportunity to have that discussion. Well, that dialogue, Jonathan, will happen tonight.
Coming into 2025, as you know, sentiment among corporate leaders was sky high, and we wanted to see that translate into better hiring, into better investment. Small business confidence rocketed higher. This morning, small business confidence drops to a 4-month low, and plans to expand move in the wrong direction.
And it's exactly the wrong mix. It goes back to this stagflationary light type of mix, because not only is confidence going down, but the share of firms in the NFIB Small Business Confidence Survey say that they plan to raise prices. That level increased to the most since April of 2021. So what you can see is price pressure increasing at the same time that they have less confidence that the customers are going to be spending as robustly. This is on the margins. This is fast moving. But right now, because it is so quickly moving, hard data is less important on some level than the soft data that indicates the speed and the direction.
If you're a CEO sitting down with the president today, your number one issue right now has got to be clarity. You just want clarity on policy. And at the moment, we're facing what looks like maximum uncertainty. At what point, as an investor, this is what you'd be asking, I think, as well at the same time, at what point do we pass peak, maximum policy uncertainty?
I wonder if Donald Trump sees this as maximum uncertainty. When he was in the interview over the weekend with Fox, he talked about how actually he's being very clear about his goals, and that his goals have been laid out in terms of how he wants to rearrange the U.S. economy. My question is, does he recognize the sort of in and out tariff strategy that he has and what the consequences could be on business? Or is this a feature, not a bug? And is he saying, you know, this is part of what's going to happen in order to rearrange some of the structure?
Well, we're not at peak uncertainty yet, because we haven't even have the entire menu when it comes to tariffs. We're going to get that on April 2nd. We also have 25% on aluminum steel coming into play tomorrow. And guess what? Retaliatory measures already coming from Canada when it comes to Ontario and what they're putting on electricity coming into the United States. This story, this is just the beginning. It is not the end.
Equity futures this morning just about positive. We are bouncing back by just 0.25% on the S&P 500. Coming up later on in the program, Brian Levitt of Invesco following the worst day for the Nasdaq 100 since 2022. Rob Casey of Signum Global Advisors ahead of Trump's meeting with bank CEOs, and Alistair Pinder of HSBC after downgrading U.S. equities. We begin this hour with stocks looking to recover after growth fears drove the S&P 500 closer to correction territory. Brian Levitt of Invesco writing, tariffs are likely to lead to a more volatile investment environment rather than result in a bear market for equities. I would not expect a broad decline in risk assets or a recession in the economy. Brian joins us now for more. Brian, good morning. Good to see you.
Nice to see you too.
Where does that more optimistic view come from? What underpins that?
So what underpins it is ultimately a belief that we will start to see a move towards greater clarity, but that gets called into question the longer that this persists. So my view in writing it was ultimately the administration will provide greater clarity around this. Look, tariffs result in less optimal outcomes, but as long as we know the rules of the game, businesses will get through it, and of the belief that, you know, the Federal Reserve, given the recent inversion in the yield curve, will start to sound a more dovish signal. But the longer it takes for us to get there, we're at greater risk of these things happening.
When things like this do happen, they happen often, we have these growth scares, you're waiting for that cathartic moment. Peter Chi of Academy said, this is the first day that feels like a real washout has been occurring. Mr. Krinsky over at BTIG, Jonathan saying, if you were hoping for an entry point, this is your chance. Have we had that cathartic moment yet?
I'm not sure we've had the full cathartic moment. I mean, I went back yesterday, though, and I looked. Yesterday was the 93rd worst day of the NASDAQ in 30 years, so let's put it into some perspective. I went back. I'm not the best at Excel. I'm almost 50 years old, but I brought up my Excel spreadsheet, and I looked at the other 92 worst days and said, well, what if I added money on each of those days? What if I withdrew money on each of those days? And obviously, you were better off adding money on each of those bad days, right? So I think most investors don't think that way. So you don't necessarily need the cathartic moment. I don't think we're there yet. I think there's more to go in terms of a bottoming process. But even if you're investing and you're halfway through a correction, historically, that's been quite good for investors.
More to go. What needs to happen for that cathartic moment? And then, frankly, for a steady climb upward, what kind of information do people need to see?
Well, we need clarity. I think Jonathan said the exact right word, which is we need policy clarity. And I go back to 2018, thinking about what was going on then when we were dealing with the U.S.-China trade war. So what ultimately led to a bottoming in the market? The United States and China got together and said, okay, 90-day truce. Well, that doesn't fully eliminate uncertainty, but 90-day truce. Federal Reserve came forward and said, all right, we're done raising rates. We may even be lowering rates in 2019. And that type of policy clarity is how you start to move forward. So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
Right now, the bulls on the street are basically coming out and telling us it doesn't really matter if we have ongoing policy uncertainty. On the fiscal side, as long as the Fed comes out and rescues markets, as long as they cut rates by enough, then you end up with a rally and a supported market. Do you agree?
Well, it can't hurt, but I think you're going to need it beyond just the Federal Reserve this time. You can't be making the cuts that you're making on the fiscal side and creating the uncertainty you have on the trade side and think that the Fed or Reserve alone, just bringing rates to neutral, can solve this. I mean, the reality is most Americans have fixed rate mortgages anyway. Most Americans didn't recognize the move up in rates. They're not necessarily going to feel it on the move down either. So you're going to need more than that. You're going to need trade and fiscal policy get to a place where we understand where it's going.
When it comes to trade, though, that uncertainty is why Donald Trump thinks he can have this negotiating power. How long do you think the market could sustain this uncertain period? Because it could be months.
Well, it could be months. I mean, we can, I don't know. So the word sustain, I mean, we can fall further from here, right? I mean, we're used to 5 to 10% corrections. They happen every year. Greater than 10 are less frequent, but they're almost always the result of policy uncertainty. And so the market could continue to feel pressure from it until you finally understand what the rules were going to be.
Do you sense there's a pain threshold within this Trump 2.0?
We certainly hope so.
Right.
You know, I mean, the idea of the Trump put is being called into question right now, but ultimately, I don't think this is an administration that wants to see the markets moving the way they are. Now, they may have an ideology around trade that they want to pursue, and they're not going to move away from it, but let's get with it. Let's figure out what the tariff rates are going to be, and let's move on.
In 2018, they tolerated much more than this, didn't they?
Yeah, 2018, we were down 20%.
Is that what you're looking for now?
It seems like you're moving towards that. I mean, right now the S&P's down 8.5%. I mean, we were down 8% when the Bank of Japan raised interest rates once last year. So this seems a little bit more challenged of an environment than that. Again, I come back to the fact, though, if you're an investor and you invest halfway through a downturn, you should be okay. So let's not try and get too cute with this, but it doesn't feel like the bottom is in yet.
Consumer discretionary is down 20% from the recent highs, led by Tesla, of course, but the airlines have started to participate. Dow to this morning, down by something like 11%. What do you do with consumer-exposed names? When you hear Ed Bastian, the Dow CEO, say things like mid-February, consumer, business, purchases, activity just started to stall. He says it's going to be transitory. Do you think it's going to be transitory?
I do think it'll be transitory because this was an economy that came in with fundamental strength. Right? A consumer where household net worth was at all-time highs, where the unemployment rate was near all-time lows. So it's a consumer that's coming into this in good shape. It's a consumer that's not over-levered. It's an economy that's not over-levered. We were in a good backdrop. The consumer right now is tightening their belt a little bit because they don't know You know, if they work for the federal government, you're not sure what your employment picture is going to look like. If you're in the market, you're not entirely sure what where your household net worth is going. So you tighten your belt a little bit, but it doesn't feel like a recessionary environment. Now, could you get there with a prolonged period of uncertainty? Sure, but when you look at the usual indicators on a path to a recession, big leverage, big excess, corporate bond spreads blowing out, none of that exists today. And until corporate spreads really start blowing out, I'm not ready to think of this as a much more meaningful downturn, severe recession. It's just not what the picture is telling us right now.
Initially, a lot of Wall Street firms agreed with you, but the downgrades have started to pour in. We've seen it from HSBC, we've seen it from Goldman Sachs and JP Morgan, Citigroup coming out, downgrading the U.S. Equities to neutral and upgrading Chinese equities. Yeah. At what point would you agree with them and say that actually, at the very least, to quote Citigroup, U.S. exceptionalism is at least on pause?
Well, we're upgrading European equities as well. I mean, we've increased our exposure to European equities earlier this year, and why? It's not complicated. Leading indicators in Europe were climbing. The economic indices were surprising to the upside. The European Central Bank was easing. It was a better mix versus sentiment in the United States declining in a period where valuations were more heightened. So you're getting these cyclical bounces. I always say these markets, everyone's waiting for things to be good in Europe. No, markets move on better or worse. By the time you wait for good, it's already happened. The bigger question on Europe now is not just the cyclical bounce, is this something more structural? And with the investment that you're seeing, the borrowing that you're likely to see out of Germany, is this more structural? They have a chance. Now, can we get 27 countries to agree on it? We'll find out. But there is certainly a chance. And yeah, I mean, sometimes it's real simple. If you're easing policy, it's a better backdrop. If you're pursuing tighter policies, it's a worse backdrop, and it behooves investors to think about those parts of the world that are being more stimulative right now.
A Citi making the point that the better news will come from elsewhere over the next several months. It won't come from here.
What's interesting is that Citigroup thinks that better news is going to come from China, whereas HSBC thinks that better news is going to come from Europe. It's sort of like pick your poison. Where in the world you think that it could potentially have better information coming
on that call, that downgrade to U.S. equities, HSBC joining us a little bit later this hour, so look out for that. Small business confidence came in about 12 minutes ago, and small business confidence came in lower, 4-month low. There is a nugget in here, though, that got my attention, and I think it got Lisa's too. The share of owners who said it would be a good time to expand declined by the most since April 2020, and a gauge of capital spending plans matched an almost 5-year low. That is not what we want to see coming into 2025. Brian, thank you. It's good to see you as always, sir. Brian Levitt there of Invesco. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. First, I wanted to give you some of the details on that Citi downgrade you mentioned. So it did downgrade its view, as you said, on U.S. equities to neutral from overweight. At the same time, they upgraded China to overweight. They cited valuations, government support for the tech sector specifically, and more generally, a tech breakthrough. HSBC similarly cut U.S. stocks to neutral yesterday while upgrading Europe. Volkswagen shares surged after it reported a strong result and encouraging guidance, up 3.3%. The German automaker expects to maintain profitability this year despite muted demand in Europe and rising trade tensions. Volkswagen is also under pressure to stabilize its performance in China, where local manufacturers like BYD are taking market share. And to the downside, Delta shares plunging in the pre-market trade, down 10.6%. If it sticks, it would be its worst day since 2022. It cut its profit expectations for the first quarter roughly by half on weakening travel demand. Delta's CEO blamed a drop in consumer confidence for the decline, but believes that the impact will be temporary. And that's your brief. John.
Danny, thank you. That stock down double digits in the pre-market. One to watch going into the opening bell. Up next on the program, losing hope for the Trump put.
The strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
Rob Casey of Signum Global Advisors joins us next, live from New York City this morning. Good morning.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Check out shares of Delta down 11% in the pre-market. The guidance was only 2 months old. They came out and slashed it by almost half. In mid-February, consumer spending, business spending stalled out, reinforced by some air safety events. They acknowledge that. They also say this is going to be transitory. As we work our way through the rest of the year, at least we'll get a rebound.
We'll find out, of course, as the weeks go and policies start to get decided upon. They basically said that this is mostly a domestic issue and that uncertainty was creating a real paralysis when it came to travel, but their full year forecast stayed the same. We'll see. There is a sort of expiration date on how long paralysis can continue before there are potential consequences.
The first big company out of the gate on the S&P 500 to really slash expectations. Equity futures elsewhere bouncing back by 0.4%. Ugly session yesterday. We're up by 0.5 on the Nasdaq 100. Out of surveillance this morning, losing hope for the Trump put.
The Powell put, the strike price on that is lower than we thought, and we learned more about that last week. But also, I think the strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data and what that means for the outlook going forward.
So here's the latest this morning. President Trump meeting with top CEOs and Wall Street bank executives today as markets face uncertainty and recession fears. Bloomberg's Tyler Kendall joins us from the nation's capital for more. Tyler, this could be box office later this afternoon.
Right. Well, John, we are expecting those members of the Business Roundtable to try to seek some firmer guidance from President Trump as this White House continues to not give us any indication that they plan to change their policy rollout, which has been marked by so much uncertainty and contributed to this remarkable shift in market sentiment in only 50 days. We have to remember that is only how long President Trump has been in office. And just yesterday, a statement hit our inboxes right after the markets closed with a White House official appearing to blame this on emotion instead of fundamentals, writing, quote, "We want to emphasize that we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses." We've repeatedly been pushed towards by officials recent examples of investment under this new administration, such as last week, for example, TSMC pointing out $100 billion in new investment as sort of evidence that these plans that the White House is starting to put into will have longer term impacts. But at the same time, the question becomes, will the White House make any assurances of any kinds as we try to seek more certainty from this White House, or whether or not they will continue to double down that this is all part of a broader macroeconomic plan and consumers and investors alike need to be patient. I actually had the chance to catch up with NEC Director Kevin Hassett at the White House yesterday, who told me that until President Trump's full policy plans are implemented, there's actually only so much they can do to counter what this White House has been pushing as structural issues left behind by the Biden administration. But John, how long that argument can go on for remains to be seen, and we could get some answers later on today. 5 p.m. Eastern is when President Trump is set to address the Business Roundtable. We're still chasing exactly who will be in that room, but no doubt they're going to want some firmer guidance.
Tyler Kendall of Bloomberg. Looking forward to your coverage later on this afternoon. You know the cheat guide, Biden data, right? So it's Biden data.
Biden data, Biden mess? We need to come up with policies to fix it all?
I think it's a stretch to suggest that the small business conference read this morning is Biden data.
Which raises this question of how seriously is President Trump going to take it when he meets with this business roundtable later today?
Rob Casey of Signum Global Advisors with us around the table. Rob, good morning. Morning. It's good to see you. Chuck Robbins leads that business roundtable of Cisco. Reportedly, we could be expecting JP Morgan's Jamie Dimon, Citi's Jane Fraser a little bit later on. What do you think the message is going to be to those guys?
Well, I think the message is going to be have a little patience, have a little faith, right? And maybe look through a little bit of the uncertainty that we've seen over the past couple of weeks. Now, that's probably going to be the message. I'm not sure it lands.
When it comes to Chuck Robbins in January, when he talked about the wild card, he called it, in terms of trade policy, he said he wanted to see a surgical approach. Are we seeing anything of a surgical approach when it comes to what they're doing right now on tariffs?
No, I think so far the threat of tariffs has been a blunt instrument, right? It's not the scalpel approach that Trump has talked about. Going forward, could it be, sectoral? Could it be pulled back a little bit? Yeah, honestly, I think so. We don't think we're going to see universal tariffs. I think that's baked in. We also, frankly, don't think that on April 2nd, we're going to see a snapback of 25% on Mexico and Canada. So maybe it gets, a little bit more targeted, or at least broadly targeted towards Europe, I think, generally speaking. But it's a blunt instrument, and we haven't seen the sort of, I think, very Scott Bessent preferred, very targeted approach that maybe we could have.
When it comes to the market sell-off, is that enough to push the administration to hold back on the 25% we're expected tomorrow on aluminum and steel?
On aluminum and steel, no, we don't think so. Frankly, that is a domestic industry that President Trump really wants to protect. It's a domestic industry that has asked for these tariffs. So unlike autos, et cetera, that have been pushing back on the threat of tariffs, aluminum and steel want to be protected, right? U.S. aluminum and steel want these tariffs on, so we expect that they will be on as of tomorrow.
To build on what Anne-Marie was getting at there was this theory heading into 2025 that there was a Trump put, that ultimately that would be the ultimate check on the Trump presidency. If the market really did tumble, there would be a response. What are we saying now is the check?
Well, I think there still is a Trump put. It's just a little bit lower and maybe a little bit more painful than we would like, right? But when, as we go back over the course of the past 50 days, the vast majority of tariff threats that Trump has made, he either hasn't followed through on or he's reversed the next day in the case of Canada and Mexico.
Maybe so, but that hasn't given a boost to markets that are still grappling with a great deal of uncertainty. And we haven't even seen the bazooka, the big one that's coming on April 2nd. Some people have suggested that maybe it's the polls, and that right now polls are hanging in there. That frankly, Donald Trump's support is a little bit lower than where it was at the beginning of the presidency, but it's still significantly above where it was the last time around. So do you agree with that idea?
Yeah, I agree with it, but not in the sense that Trump is looking at polls day to day, right? He's never going to run again. A couple of clients every once in a while will push back on the idea that maybe he will run again in 3.5 years. I would not expect that. But I think the mechanism for the Trump put, or at least the Trump concern around polls, is not Trump polls, they're congressional polls, right? If I'm running in a red or purple district in a year and a half, I'm going to President Trump and saying, please, please, please allow me to run on something positive, right? And we haven't seen that so far.
Well, he lashed out last night at one congressman saying, I'm going to primary you if you don't sign up for my continuing resolution that's going to hit the House floor today. Does it pass?
We think it passes the House. Or potentially could pass the House. We don't think it passes the Senate, frankly. I mean, Democrats have to take a stand somewhere. This is really the only place that they can take a stand, right? When it comes to reconciliation, they can't do anything to stop it. But when it comes to this CR, as much as Speaker Johnson wants to call it a clean CR, it's really not. And so we think, even if Republicans can get it over the line in the House, it doesn't pass the Senate.
So they rather take the blame potentially for shutting down the government?
I think so, honestly, and we're hearing Democrats go back and forth. But yeah, I mean, listen, this is not a clean CR, right? And so I think Democrats will try and message that. We haven't seen much messaging from Democrats over the course of the past 50 days at all. But that's assuming that Republicans in the House can get this over the line. And frankly, it's not only Massey who is a no as of now, right? We've heard that Trump has made calls over the course of the past 24 hours to get Kat Kamik and others over the line. They have obviously, I mean, we've said it every day, they have a very slim majority in the House, maybe a little bit wider because some Democrats are staying home, but it's going to be really tight.
Rob, good to see you. As always, thank you, sir. Rob Casey there of Signum Global Advisors. If you are just joining us, equity futures are bouncing back by 1/3 on the S&P. Yesterday, the biggest one-day loss on the S&P 500 of the year so far. On the Nasdaq 100, the biggest one-day loss going back to 2022. There have been some downgrades out there, including this one. In just a moment, we'll catch up with Alistair Pinder of HSBC after downgrading US equities in the last 24 hours to neutral and upgrading The rest of the world, we need to talk about Europe with HSBC in just a moment. Live from New York City this morning. Good morning to you all. This is Bloomberg TV.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Let's check out the scores this morning. Equity futures on the S&P 500 bouncing back from yesterday's losses, but it's not much of a bounce. Up by 0.4% on the S&P, on the Nasdaq up by 0.5. Yesterday, the biggest daily loss of the year so far for 2025, taking the losses to about 9%, almost 9% lower from the all-time highs of only a month ago. Those all-time highs feel like a lifetime ago.
Let's put that into market capitalization or perspective. Since February 19th, the Nasdaq is down $4.2 trillion worth of market capitalization. This is a massive amount of wealth that has been removed from this equity market.
It's not just tech either. Discretionary stocks, led by Tesla, of course, but beneath the surface, other names as well have been hammered. They're down 20% from the highs of December. The banks, the KBW Bank Index, wiping out the gains from the post-election rally.
Since February 18th, the KBW Bank Index is down almost 16%. That is traumatic. And you have to wonder how much this is reversing some of the trade from the end of last year and how much this is looking at exactly what that NFIB survey pointed to, which is stasis when it comes to investment and when it comes to deal making.
The only good news I've got for you from the last 24 hours is bonds did what bonds should do, and they rallied, particularly at the front end of the curve. Yields dropped by double digits, down by about 11 basis points on a 2-year this morning, up by 2. The 2-year at the moment, 390.60. 10s right now at 421.87. Lisa mentioned a small business survey coming through at a 4-month low. Plans to expand, dropping as well. Everything just moving in the wrong direction at the moment in the survey data. Want to finish on foreign exchange and take a sneak peek of what's happening with the euro. Euro dollar shaping up as follows in the FX market. The euro at about 108.88 and positive by 0.5%, getting closer and closer to 109. On our radar this morning, shares of Delta Airlines falling in pre-market trading after the company delivered a disappointing forecast. Delta cutting its profit expectations for the first quarter roughly by half on weakening travel demand. That stock down 11%.
The problem here is the pace of the decline. The fact that in January, Ed Bastian, the CEO of Delta, came out and said that demand is about as strong as it's ever been, and that, frankly, the demand-supply picture is very balanced and very good. All of a sudden, people aren't traveling anymore, and it was mid-February, and he said that this is a U.S. domestic issue. He does expect it to subside. But the speed of this is what's going to get people's concern. The reason why soft data right now might be more important to people than backward-looking hard data that tracks an economy that might have looked very different, say, a month ago.
You can make up a lot of excuses for this. You can say that seasonally, the first quarter for the airlines is not great. It's difficult to predict. You can say this was reinforced by the air travel safety events of the last month as well that made people nervous. And maybe as the year progresses, we'll work our way through this. But I think there's some obvious things to point to that could stick around. If you're a federal worker right now, I wouldn't be booking a vacation. I'd probably be cancelling my vacations. And a whole load of people around those people, these things can unravel and bleed out through the rest of the economy pretty quickly.
It's not only the threat of potentially losing your job. If you have lack of conviction, how do you go out and pitch business? How do you go out and try to make deals? These are some of the things that we have seen trickle into the soft data. Delta's still seeing the same full-year forecast. At what point does that materially shift the trajectory versus just being a short-term uncertainty blip?
And let's see if the other airlines follow. We'll be looking out for them throughout the next couple of days, that's for sure. Let's turn to this story. Canada slapping a 25% surcharge on electricity it provides to Minnesota, Michigan, and New York in retaliation for President Donald Trump's tariffs. The move coming ahead of fresh U.S. tariffs on steel and aluminum set to take effect tomorrow.
This is really the first blow of the whole tariff agenda. These retaliation in terms of energy Ontario provides to a number of states in the U.S. Donald Trump late last night came out and said, we don't need your cars, we don't need your lumber, we don't need your energy, and very soon you will find that out. Well, I think a lot of businesses, and even anecdotally, I spoke to a board member of a lumber company in Maine. Anecdotally, they'll tell you all of our energy is coming from Canada. We ship our product to Canada, and then they bring back the finished material to the United States. This is going to get tough, and Doug Ford yesterday spoke to Kaylee and Joe on Bloomberg TV and was saying Trump has created this chaos, and he says this has unleashed patriotism in Canada they have not seen.
Elisa talked about this a few times over the past weeks, the potential for that to start happening. It's very difficult to forecast to see the consequences of increased tariffs, primarily because of how others might respond to it, but also for how the market responds to it as well. One thing that surprised us all, tariffs up, dollar weaker, not stronger. The euro stronger again this morning, 108.83. We're up by 0.4%. I want to talk about the latest out of Germany. Germany's Greens saying they are ready to negotiate a defense spending deal and are hoping for an agreement this week. This coming after the party rejected a debt finance package that would unleash hundreds of billions of euros in spending. I want to stick with Europe. The EU looking to boost investment and prepare for expected tariffs from President Donald Trump. Bloomberg's Ollie Crook joined us from Germany in the heart of German business. Ollie, walk us through what you're hearing from the likes of VW about the latest push in Europe.
Yeah, so Jonathan, I mean, you talk about the sort of uncertainty that's been thrown up by the Trump administration on the question of tariffs. I mean, this is a sort of front and center for here, Wolfsburg, Germany. This is one of the biggest manufacturing sites in the world, probably the biggest factory in Germany. This is where Volkswagen really made all of its cars historically. This is, got huge assembly lines and absolutely massive in terms of generating output of cars. And this is sort of in the sort of center of the discussion here because Volkswagen has had to face the reality of a sort of much tighter squeeze in China. They've had to have a much slower situation here in Europe. They've had to cut down assembly lines. This used to put out 4 lines. They're moving this to 2. What they've had to focus on is their growth market, and that is the United States, right? And that is what is coming into complete sort of disarray now. I spoke to the CFO a little bit earlier. Nobody really wants to give you a sort of scenario of what 25% tariffs looks like. They all say wait and see, but have a listen to what Arno Antlitz, the Chief Financial Officer of Volkswagen, had to say to me earlier.
We feel already like an American company. Look, we operate a huge factory in Chattanooga with thousands of people there. Volkswagen Group of America employs more than 20,000 plus people, create safe and well-paid jobs. We invest in South Carolina. So we think these should be taken into account when talking about tariffs and Volkswagen and talking about the U.S.
So you can hear it there from the executives, the kind of the pitch to Donald Trump of why they should be sort of exempt from tariffs. But it's not just about tariffs between Europe and the United States. A huge part of the Volkswagen strategy has been establishing a battery factory in Canada, establishing the VW Gulf factory over in Mexico. All of these things are being caught up. And listen, I spoke to a number of executives over the last 24 hours, really pressing them on what tariffs would mean. Nobody wants to give you a whole lot. But what I can tell you is that this is a market, the United States market, that they want to double their market share in. It is the only major market that grew last quarter, and they will hold on to it to the bitter end. So if that means augmented capacity in the United States, I suspect they're ready to do it.
Those plans have been totally upended in many ways over the last month or so. Ollie, appreciate the breakdown. Bloomberg's Ollie Crook there, the latest from VW, and some of the automakers and some of the challenges they face right now. These are some of the challenges that investors face too. And what are they doing? They're fleeing into European markets and downgrading US equities. Alistair Pinder of HSBC writing, prior to the US elections, we assumed a Trump victory would reinforce US exceptionalism. We are upgrading Europe, excluding the UK to overweight. We are downgrading the US to neutral. Alistair joins us now for more. Alistair, good morning. Good to see you.
Thank you very much for having me.
Let's talk about the reasons behind that call. Start of the year, you were thinking what a lot of people were thinking, US exceptionalism. What changed?
So what did we underestimate? We underestimated the potential for governments to essentially retaliate to tariffs and, retaliate to the wavering support to Ukraine and also defense spending from NATO with their own fiscal stimulus. And we saw this in China with the NPC, and we're now seeing this in Europe with Germany embarking on what seems to be pretty sizable fiscal stimulus, almost 1 trillion euros split between defense spending and infrastructure spending. Again, for me, the real catalyst is the infrastructure spending here, because I think that's going to what has the real repercussions for economic growth. And we're starting at a place where actually Europe looks very cheap. It had been completely disowned by investors. It was trading at a significant discount to US markets. And we're now seeing the stars kind of align. And you mentioned the euro, it's 108. But, for the majority of the year, it had been depreciating. It's still below its highs. That's also a modest tailwind for earnings as well. So the backdrop, in my view, is turning very favorable for Europe at this point.
We've been talking about whether it's the U.S. pushing money out of the domestic market or if it's the rest of the world sucking money out of the United States market. Where do you fall on that question at a time where it's less, at least according to your note, about U.S. policy and more about better opportunities elsewhere?
I think it's definitely the latter, as you mentioned. I think, one of the things that we're seeing is that what gets you excited into going to other markets internationally, you have to see investment opportunities. And I think, the two biggest conviction calls that we have at the moment has been China and has been Europe, and both of them have been driven by their own catalyst. In China, it has been fiscal policy and DeepSeek, and that's been driving the internet sector. In Europe, it has basically been the shift in mindset of governments, which is going to basically unleash fiscal spending and support, economic growth. And I think that, for me, is what's going to drive people into Europe rather than the other way around.
What's the risk that this is all good? You get this incredible rally, as we've seen in European equities, until April 2nd. And then Donald Trump comes out with the big one, and it's the reciprocal tariffs. And all of a sudden, people start thinking about what the financial repercussions are for places like Europe. And suddenly, the fairy tales are over, and you're dealing with fights in different legislative bodies over what kind of spending you could have. How big of a risk is that?
So let's put some numbers into context here. So 25% of European equity markets revenue comes from the US. That's a lot. But actually, a lot of that is not exposed to tariffs at all. So services, like software and services, don't get tariffed. And actually, there's a lot of companies that produce in the US and sell in the US. That's avoidant of tariffs. So actually, net-net, what do we think is, exposed to tariffs? Less than 10% of revenue. So much less than what people, I think, assume. And it's very specific in certain sectors. It's the consumer staples, some consumer discretionary, and also the autos, of course. But outside of that, I think in the industrials, I think in the tech, I think in the financials, I think they're going to be much more resilient to the tariff risks than people believe it.
So right now, would you advise avoiding those tariff vulnerable sectors?
Yeah, I think that's, that would be our policy is 100%, be more sheltered into areas which are resilient to tariffs. And, that's, again, on a global basis. I think that's a theme that we see in the US, where, again, we would be more cautious on the consumer discretionary consumer staples sector, where they import a lot. And so, therefore, they're more vulnerable to tariffs from an earnings set. But it's also the case, again, I keep highlighting China here, but, China's equity market revenue from the US is just 3%. It's negligible. It doesn't make a difference. So again, I actually think China, despite all the tariff headlines, is actually more of a defensive play from an international context.
Do you think there's a point at which the administration steps in? The so-called Trump pill has been talked about a lot. Do you think there is a pain threshold for not just the Trump administration, but also for the Federal Reserve as well? And in your mind, I imagine we're not close right now, but how much closer are we?
I mean, I don't think we're at that point, but I do think we're getting to the point where if you look at what markets are pricing, we talk about a lot about these recession risks. I think we're pricing in a lot of recession risk at this point. We have a probability of what equity market's implying that's jumped up 10-15% over the last week alone. If you look at the typical equity market performance during recessions, it's around 10 to 15% downside. We're pretty much there. For me, I feel like we're pricing in a lot of downside. Can it go lower? Yes. But at that point, you're going to see bond yields start moving lower. You're going to see that Fed put come in. And so again, I think you're completely right. I mean, going to your point earlier, we do have this risk event on the 2nd of April. But beyond that, I actually think the outlook is much more favorable.
Just out of interest, do you think that view about the growth scare in equities is being confirmed by fixed income? We saw high yield spreads blow out just a little bit yesterday. Do you think it's being confirmed by what you're seeing in high yield?
I mean, I think it's being confirmed by what we're seeing in the 10-year bond yield, right? Which is that you're seeing that roll over pretty sharply. And again, that's seeing this underperformance of cyclical stocks versus defensives at this point. So yes, I think we're seeing that reflecting across most asset classes at this point.
Alistair Pinder of HSBC, thanks for joining us. Appreciate it. Downgrading US equities, saw something similar from Citi in the last 24 hours. Lisa, that view on a high yield's one to watch. Yes, spreads have started to widen out, but if you look at absolute levels of around 300 basis points, people might sit here and say that's still pretty tight.
Yeah, some people might also argue that it isn't necessarily the canary in the coal mine that it used to be because of the dampening effect of private credit, and that's the reason why Alistair went to the 10-year yields. There is this question, and the reason why I'm actually very curious to get CPI tomorrow, a question of if it comes in hotter than expected and inflationary pressures are still there, how much does that force the Fed's hand and actually raise the bar that much higher for them to really provide that relief valve on the other side with potential cuts?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
That's the fear, and that's the reason why, if there is an upside surprise in that CPI report, people might actually take notice. It's just one to watch at a time where that is one of the concerns out there.
So bearish, just kind of...
Okay, well, I mean, the market yesterday was pretty... Okay, what do you want to do?
Take a shower. Equity futures on the S&P. That's what I want to do. It's not a suggestion. We're up by 1/3 on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some breaking news earlier in the hour. Shares of Southwest down 2.7% in the pre-market. It is ending its free bag policy. Customers will be charged for their first and second checked bags unless they hold top-tier loyalty status or are traveling on a business fare. The changes apply to flights booked on or after May 28th. Oracle shares also lower in the pre-market, down by nearly 2%. It had disappointing quarterly results. Its sales and profit forecast for the current quarter also fell short of analyst estimates. Oracle did report a surge in bookings, though, and said its cloud infrastructure business will boost revenue over the next 2 fiscal years. Elon Musk has blamed what he calls a massive cyber attack for widespread disruptions on his social media platform X. Tens of thousands of users globally reported intermittent outages on the app, with new posts failing to load for users. Darkstorm, a pro-Palestinian so-called hacktivist group, took credit for the attack via its Telegram page without providing proof. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding.
but I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
Tesla stock having great difficulty. Joanne Feeney of Advisors Capital Management joins us to talk about that and a whole lot more from New York City. This is Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities a little bit firmer, up by 1% on the S&P. On the Nasdaq 100, terrible day yesterday, up by 0.4% this morning. And the surveillance this morning, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding. But I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
But there's no turning back, you're saying?
I'm just here trying to make government more efficient, eliminate waste and fraud, and so far we're making good progress.
So here's the latest this morning. Elon Musk Tesla facing its worst day in more than 4 years in the last 24 hours. The stock looking to recover this morning after tumbling 15% yesterday. The Nasdaq 100 posting its worst day since 2022 with more than $1 trillion in value wiped out. Joanne Feeney of Advisors Capital Management joins us now for more. Joanne, it's been too long. Welcome back to the program. Let's talk about this correction we've seen in big tech, how you view things, what's driving it, and whether now's the right time to step back in.
Yeah, good morning, John. There's obviously a lot of fear out there in the market. We've seen the VIX spike up, and the fear is centered on the uncertainty that investors and businesses now face because of the back and forth we're seeing on the potential tariffs that we're going to see not just on Canada and Mexico, but Europe, and then on specific industries, whether it's timber out of Canada or aluminum and steel. So that level of uncertainty, creates a lot of challenges for businesses. They tend in these moments to want to pull back on things that have an irreversibility component to them, capital investments, and even hiring. It's not so easy to fire people once you've hired them. And so we see the businesses in some sense freezing in place. And I think the Delta results kind of, helped, confirm that. Business travelers are down, even consumer traveling is down. And I think that's a sign of businesses tightening their belts and saying, let's wait and see what happens.
Let's look on the bright side. Do you like that, John? Is that
Nice.
good? Yeah, let's look on the bright side. A lot of people were really optimistic about U.S. dynamism, and now you can get it at a discount. Why not go in now?
Well, there's good reason and good opportunities out there right now, Lisa, and that's because there are still pretty good growth drivers in some areas of the U.S. economy. And the U.S. as a whole doesn't have to be exceptional for there to be good opportunities. I mean, the AI revolution is still ongoing, and there's really not a lot that's happening now that's likely to disrupt that. We're still seeing major investments in data centers, and even after the DeepSeek scare, right? Companies that are putting their money where their mouths are saying there's still a lot we want to be able to do with AI, and we're going to continue to invest to make that happen. So those companies in the middle of that are still, in fact, better opportunities now than they were a few weeks ago.
So are you buying?
We have pretty full positions where we want to. We've owned NVIDIA for a long time. We've owned Broadcom for 10 years. And we've owned a few select others in the software space, in particular, like a ServiceNow, for example. We don't think that it's wise to try to time this market. We don't know when sentiment is going to change. Obviously, there's been a risk-off trade. Investors that weren't diversified are trying to get diversified. So we're seeing other stocks in the market do relatively well. But it's always tricky to try to say, well, uncertainty, we know there's a lot of it. Maybe we should back off of growth. But if you're a long-term investor, this might be a time, if you don't have a full position in names like the ones I just mentioned, it might be a good opportunity to get in there, even though these things could still go down for a while this uncertainty plays out.
Jonathan kicked off the conversation showing how bad of a day Tesla had yesterday. Do you think there's going to be political blowback, not just when it comes to Tesla and you see some of the registrations plummet when it comes to those cars being bought in places like Germany because Elon Musk and backing the AFD, but also places like Canada? Will there be a boycott of American goods?
Anne-Marie, we're starting to see that. In Canada, they're taking American liquor off the shelves. We've seen surveys that show that Canadians are buying less goods out of America, whether that's from Amazon or others. So, we're seeing that certainly. And if you look back historically, we've seen this sort of thing before. Whether it was the 2018 tariffs or all the way back to Smoot-Hawley, we did see other countries respond either with retaliatory tariffs or simply with protests. And that caused, in some cases, back in the Smoot-Hawley era, exports to those countries drop as much as 23%. So those are real concerns that one has to watch out for. That's why, you can position away from some of the products that are in the, squarely in the headlights of this sort of risk. I mean, invest in more domestic companies, McDonald's, Altria, things where demand is less elastic. These kinds of companies are likely to do better in this kind of an environment.
Joanne, you mentioned 2018. How useful is that period as a playbook? Because the drawdown back in 2018 was far more substantial than the one we've seen so far on the S&P 500.
Yeah, it's hard to tell, Jonathan. I mean, clearly the tariffs that are being bandied about now are much bigger than those in 2018. So if they were to go into effect, the economic effects would be larger. But, now we have something we didn't have back in 2018. We have this AI revolution. It's not just for the picks and shovels providers like NVIDIA and Broadcom, but it's also for those that could adopt AI to make their businesses more productive or to create new products. So we have a growth engine that's real, that's identifiable, and that's multi-sector that we didn't have back then.
Joanne, appreciate your time, as always. Breaking down some of our stock picks this morning. Joanne Finney there of Advisors Capital Management. One name that was mentioned, let's talk about Delta. Delta down in the pre-market by close to 10% at the moment after slashing their outlook for Q1. So much of the soft data is about feelings. I feel this way, I feel that way. This is more than that. They're telling you what consumers and businesses have actually been doing since mid-February. And those companies, those people have been pulling back.
What they've been doing is nothing, and nothing has a cost. Nothing is a choice, as you've pointed out. So there's a question of how long this can continue before it starts showing up in the hard data and has some lasting effects. Right now, Delta is saying there still is a reversibility to this. What does President Trump have to say today at that business roundtable to get the confidence of business CEOs?
He's going to get a bit of a grilling, you have to think. When you have the Delta executives coming out and saying consumer spending started to stall. They're saying they're not telling us they're going to do this. To your point, Jonathan, they aren't booking the flights. What I thought was interesting about Delta is they're seeing this more domestically. I wonder if this puts a cap on U.S. exceptionalism, because they're still seeing people buy some flights when it comes to international travel.
The President and Secretary Besson have been pretty consistent. Is the message really going to change today? That we're going to end up in a better place? We're rebalancing the economy. There might be some disruption, but bear with us.
You know, you have to imagine they're going to stick with it.
It's the message so far. Let's see if it changes. Up next on the programme, we'll catch up with Scott Linscomb of the Cato Institute, Holly O'Neill of Bank of America, Kelsey Barrow of JP Morgan Asset Management. The second hour of Bloomberg Surveillance. Up next.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
the focus has shifted dramatically to the downside growth risks for the U.S. economy.
We've had a weaker view of the economy, going into this year already, and I think we've seen that in the data.
High inflation is going to be what it becomes more problematic for the American psyche.
Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears.
I don't think it's a United States recession. I think it's a Washington, D.C. recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now, and your day ahead looks a little something like this. 3 things to watch. Later on this morning, some more economic data. Look out for jolts. Job openings. Another read on the labour market coming later this morning. Look out for the press briefing from the White House later on this afternoon. And then this one, 5 p.m. Eastern Time. The President of the United States sitting down with business leaders for the Business Roundtable. Cisco's Chuck Robbins leading that, and reportedly we could see JP Morgan's Jamie Dimon, Citi's Jane Fraser in the room down in Washington, D.C. at the White House at a time when we came into 2025 with business confidence sky high, that business confidence slowly being eroded on the back of the policy uncertainty over the last month.
You asked last hour, is there any reason for them to change the stance that they've had already, which is essentially this is by design. Stick with us, have faith. We are going to have a grand plan. It just is going to take some time. Is there any reason for them to change that tone right now within the Trump administration when they talk to business executives at a time where there is a wobble in the stock market? But they have said they're okay with that. There is a transition period. There is a detox period. And so that is really going to be the tension this afternoon.
It's coming at a time when we've seen a series of downgrades from economists and from investors alike. I'm thinking of Mike Gapin over at Morgan Stanley, who downgraded the growth outlook for America, upgraded his inflation forecast. Investors doing the same thing. We spoke to HSBC about 25 minutes ago. They've downgraded U.S. equities. Citigroup has done exactly the same thing. Citi pointed to the idea that better news will come from elsewhere. That better news won't come from the United States, at least for the next several months. Why? Because we want some policy clarity around things like tariffs, and maybe for the next several weeks, we won't get it.
We might not get it, but that is the one question I think all of these executives that are going to have a chance to speak to the president today at 5 p.m. at this business roundtable are going to ask. They want to have a dialogue, and they want some sort of clarity when it comes to the tariffs and trade headlines. Also interesting, when you see advisors that are close to the president, maybe outside the administration, something else you see a lot of people pushing for now, and potentially this shows that the administration is concerned about the market downturn, even though they've doubled down on their language. They want to bring up the tax cuts. The sequencing is key here, and I imagine all these executives want to know when that bill might get signed.
Up until recently, this has just been talk and feelings. In the soft data, we feel like things aren't going so well. We feel a certain way. Now I think it's action. With the move from Delta Airlines over the last 24 hours, after the close yesterday, slashing its outlook, the stock down this morning by 9% in the pre-market, and the company coming out and saying this: a recent reduction in consumer and corporate confidence caused by increased macro uncertainty driving softness in domestic demand. Ed Bastian, the CEO, saying that in mid-February, companies, consumers, activity started to stall. Now, they're making the case that maybe that's transitory and it bounces back in the next several months. The fear is it won't.
And the fear is it is happening so quickly. Ed Bastian, in January, said the supply-demand balance is as good as I can ever recall it being as we look into 2025. And now, just 2 months later, it is a completely different story. They still are maintaining full-year forecasts, but the speed, and we keep going back to this, the speed of the shift in tone is shocking, and it has gotten a lot of people attention. And we've asked this question before, John. Who is going to be next at a time where this is really going to be the ongoing theme?
The answer to that is American Airlines, right on cue. They say the revenue environment was weaker than expected. The outlook for the first quarter, Lisa, adjusted loss per share of 60 to 80 cents. They had seen a loss of 20 to 40. They say revenue environment weaker than expected. They say this also. They cite Flight 5342, softness in domestic leisure. Now, this is the issue that Delta brought up as well, and it's difficult to disconnect the two things. On the one hand, you've got a slowdown in consumer spending, one. Two, you've got the why. Is it because people are worried about the economy, or are they worried about flight safety? And it's very, very hard to divorce the two, and I guess we're going to see in the next several months.
Ed Bastian did refer to this in a recent interview yesterday where he said that there was some kind of ramification from that. American Air citing that, as you just mentioned as well. At the same time, we've had flight issues for a while. They haven't seemed to impede demand to a great degree. was this different, or is there something else going on? And whether this is confirmation bias or whether this is idiosyncratic, we have also heard warnings from the likes of Walmart. We've also heard warnings from the likes of Target and Best Buy. So this is a reason why not only is President Trump's stance today, this afternoon at that meeting, going to be very important, but if the guidance continues in this vein, it is harder to dismiss this as an idiosyncrasy related to air flight safety.
The 5-day moves have been brutal. You've got American Airlines down by something like 5% of the pre-market. I mentioned the move we're seeing at Delta. Even before these moves, the 5-day move down 10% on American, United down 15, Delta down by 14. It's a whole lot more than just air safety issues. It's certainly a whole lot more than that.
Well, you talked about this, and honestly, at a certain point, you have to wonder, okay, am I being too gloomy? On the bright side, how do we look at this? But if people are getting laid off, or they feel like their companies aren't going to be getting certain federal contracts, or frankly, there just is a paralysis with respect to business investment, why would you double down on travel? Why would you double down on taking vacations? How many people right now are taking long vacations as they try to deal with the barrage of headlines that's headline roulette at this point? Not many, especially not if they're on Wall Street or in business.
Look, I joked about you being too gloomy. I just think this is the reality of the situation. I've said it repeatedly, coming into 2025. I'm not scared of saying this out loud. I want them to succeed. I want anyone in the White House to succeed. And what I mean by success, I want to see better hiring, I want to see more investment, I want to see higher levels of growth at a time where we've been blessed with pretty decent levels of growth. Confidence into 2025 was sky high. Why? Because this was going to be a business-friendly administration. And we wanted to see that translate into better hiring, better investment. Confidence for businesses, particularly small businesses, has started to decline. We saw that with the Small Business Confidence Survey this morning, 4-month low, and the plans for hiring, the plans for investment. Look at this for the plans for investment. The share of owners who said it's a good time to expand declined by the most since April 2020. Unfortunately for the administration, that is not Biden data. That's Trump data.
That's Trump data, and you see this show up in a lot of surveys when it comes to consumers as well. Not just the fact that more people are concerned potentially about losing their job, you see the Doge effect, but also when it comes to tariffs, if companies are going to put that price hike onto consumers, they're going to have to be paying more for their everyday goods, let alone how can you think about taking a vacation. What is so different, Jonathan, in Trump 2.0 than what we saw in Trump 1.0 was the sequencing. Trump slashed taxes before beginning the trade war. Right now you have this uncertainty, this overhang, this fog of what trade's going to look like before we even get to the tax bill.
There's a chance we work through this. Of course there is. There's a chance we get to a better place. And the strategic anchor of the equity bulls out there remains the same. We understand what they're trying to achieve, rebalance the economy, away from public spending towards the private sector. But they acknowledge, even the president acknowledges, there will be some disruption in between. This is the kind of disruption we're getting right now. The data speaks for itself.
The problem is, what are the relief valves? And we talked about this heading into this year. There's the Trump put, the idea that if the market goes down too much, President Trump would come out and respond. That's been pushed off. There's the Fed put, the idea that the Fed will come to the rescue. That's the reason why CPI data is going to be so important tomorrow, and why on that survey from the NFIB, the fact that companies are looking to raise prices at the highest pace going back to 2021 raises some concerns. Does that push off some of the Fed relief valve? These are some of the questions people are trying to grapple with at a time where there's a lot of uncertainty and people are trying to figure out when's the break point where they can get some more clarity.
The small business optimism retreating this morning is going to get the administration's attention, because the only comment we got out of them yesterday was that they think that there's a divergence between what they're saying, what's happening in the stock market, and animal spirits versus what they see unfolding for businesses and business leaders. They think that's more important. When you look at business leaders today, they're concerned.
If you are just joining us, welcome to the program. Equity futures just about bouncing back, but that bounce fades. We're positive by a little more than 0.1% on the S&P 500. In the last hour, small business optimism falling to a 4-month low in February. Bloomberg's Mike McKee joins us now to break it down. Mike, let's talk about why and what underpins that shift lower. Why that softer sentiment?
Well, I think you can see it in one number, and that's the uncertainty index rises to 104, and that's the second highest level ever. It's not like the economy has fallen off a cliff, but nobody knows what's coming next, and it's very hard to plan. So you see the 10 different indicators that the small business owners fill out, 7 of them were negative. 3 were positive, but the ones that were positive weren't particularly great. More job openings that they can't fill, earnings trends up by just a little bit, and then expecting easier credit conditions up by a little bit, and that would suggest maybe people think things are bad enough that we're going to start to see the Fed cut interest rates again.
Mike, can you give us a sense of how much of an about face this is at a time where, as John mentioned, coming into this year, confidence among small businesses was sky high?
Oh, it's a big about face, not only for small business, but for large business as well. And I think it comes back to the fact that throughout the campaign, Donald Trump said, on day one, I will. And day one has come and gone. This is the 51st day, halfway through the 100 days, and he hasn't yet. We haven't seen much except the turmoil of Doge firings in Washington. And so people are starting to say, well, wait a minute, what's actually going on here? And why all of a sudden are we talking about pain instead of immediate gain?
Mike, do you think this now starts to bring up a different conversation at the Fed, maybe bringing up this idea that we can see Fed cuts sooner?
Well, bring up maybe, but at this point, the Fed is stuck like everyone else in not knowing what's going to happen. And we have tomorrow tariffs on steel and aluminum, and then the first week in April, we have tariffs maybe on Mexico and Canada and China and who knows who else. And so as long as there's that uncertainty, the Fed's going to sit tight because the economy is still growing. And inflation is still coming down very slowly, but still coming down. So they don't have to move. So I think they'll be as quiet as possible about the outlook going forward. And we just have to let the markets divine what the Fed is going to do for the time being.
That meeting a week tomorrow. Mike McKee, thank you, sir. Bloomberg's Mike McKee breaking down the softer than expected small business confidence print we got in the last 60 minutes or so. A week tomorrow, March 19th, the Federal Reserve's got to get together, decide on interest rates based on the communication, the guidance from basically the whole committee. There's going to be no action next week, but then they've got to put out forecasts, Lisa, and putting out forecasts, I think, gets so much harder, and it's certainly harder than it was the last time they did this.
Why don't they just put out some numbers and say, look, these are made up. We have no clue. We're in a black box right now. And essentially everybody knows that. The dot plot has been gaining a lot less relevance over the years as it's been wrong again and again. So at a certain point, do you dismiss that and start to talk about things like what they have been talking about, which is weighing the idea of softening growth with sticky inflation? How do they measure those two things?
Equity futures right now positive by about 0.2%. Let's get you an update on stories elsewhere, including an update on the latest in the airline sector. In your Bloomberg brief, here's Danny Berger. Hey,
yeah, John, another airline, another dour outlook. This time, American Air, those shares falling 3.4% in the pre-market. It cut its forecast. It reported weaker than expected revenue in this environment. American expects a loss of 60 to 80 cents a share, grappling with weak leisure demand and a fallout from a fatal collision in Washington. Elsewhere, the House Freedom Caucus has backed a stopgap funding package to help Speaker Mike Johnson pass the bill without Democratic support. If passed, the bill would reduce and then freeze spending for 6 months. It would add $6 billion to defense and $440 million to immigration enforcement, while cutting IRS funds by $20 billion. And in sports, Manchester United is planning to build a new 100,000-seat stadium in a bid to modernize its facilities. The stadium will be built next to its current home of Old Trafford, where the club has played for the last 115 years. Man U did not say how much the stadium would cost or how long construction would take. It's set to become the largest stadium in the UK. And that's your brief, John.
Got to make sure they don't get relegated first, Danny. Danny, thank you. More from Danny in about 30 minutes' time.
Who's gloomy now? Look at this.
Fans are going to hate that.
Oh, really? Why don't you cheer up, John?
I'm not taking it back. Up next on the program, Canada retaliates.
I always say when the market speaks, you have to listen. The market is speaking. CEOs are speaking. People are speaking out. I don't believe in protectionism with your two closest friends and allies in the entire world.
Up next on the program, Scott Lincecum of the Cato Institute from New York City this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Unwinding just a fraction of yesterday's moves on the equity market, up a third of 1% yesterday, the biggest one-day loss of 2025 so far. In the bond market, yields were lower across the curve, down 11 basis points at the front end. Further out along the curve, the 10-year up today by not even a single basis point. The 10-year yield 4.2225. Under surveillance this morning, Canada retaliates.
There's one person that will put us in a recession, and that's President Trump. I always say when the market speaks, you have to listen. The market is speaking, CEOs are speaking, people are speaking out. Why is he doing this to his largest customer in the world, Canada? No one buys more products off the U.S. than Canada does, including autos. I don't believe in protectionism with your two closest friends and allies in the entire world.
So here's the latest this morning. Canada responding to President Trump's tariffs on the country by slapping a 25% surcharge on the electricity it provides to Minnesota, Michigan, and New York. Trump responding on Truth Social, writing, Ontario just announced a 25% surcharge on electricity, of all things, and you're not even allowed to do that because our tariffs are reciprocal. We'll just get it all back on April 2nd. Bloomberg's Tyler Kendall joins us now for more. Tyler, that relationship is getting more and more tense by the day.
Yeah, John, and later on in that interview, the Premier of Ontario said that he is coordinating closely with Mark Carney, who we have to remember over the weekend in his victory speech said that Canada is now clouded by dark days brought on by a country they can no longer trust, meaning the U.S. We know Canadian consumers have already started to boycott U.S. goods as well as the use of Amazon. But as we look forward here, of course, this administration keeps pushing us towards those reciprocal tariffs on April 2nd as kind of the end-all solution to any of this heightening in rhetoric that we're seeing. But first, of course, is tomorrow, those 25% tariffs on steel and aluminum. We know Canada, for example, is the #1 exporter of aluminum to this country. And at the moment, the White House is telling us not to expect any sort of modifications. That's the word that they use, meaning exemptions or carve-outs, although, of course, all of that can change. And while producers have largely applauded this move, domestic producers in the U.S. wanted to see this, we have to keep in mind that this also applies to those downstream metal products. Think things like car bumpers and wires. We'll be watching closely to see if manufacturers indicate that they will pass those higher costs off to consumers, because while we've been talking a lot this morning of how it appears the White House appears to have this higher tolerance when it comes to a market sell-off, we'll have to see whether or not consumers have a higher tolerance for a tick up in prices, and if that could potentially serve as a check on this administration's policies, since we know that President Trump has been pushing that he will bring down prices.
Tyler, we also know the president will be sitting down with CEOs later today. What are we expecting to happen at this business roundtable?
Well, as you guys have been discussing all morning, it's no doubt that those CEOs are going to want some firmer guidance, some firmer clarity when it comes to President Trump's tariff plans and the uncertainty that has been surrounding them. But we should also point out that the last time President Trump addressed the business roundtable was when he floated that he would put forward a lower corporate tax rate. And there is no doubt that they are going to be looking for any sort of assurances there when it comes to President Trump's tax cut agenda, which Anne-Marie, we know, is already starting to face some pushback in the U.S. Congress. Not necessarily that lawmakers don't want want to see it through, but how it is going to get through, particularly whether or not his 2017 tax cut plan can be made permanent, or whether all those other tax priorities like no taxes on tips, overtime pay, or Social Security can end up being on the table if Republicans can find those pay-fors.
Tyler, appreciate the update. Tyler Kendall in the nation's capital down in Washington, D.C. Joining us now to extend the conversation, Scott Lincecum of the Cato Institute. Scott, welcome back to the program, buddy. It's good to see you, as always. Let's just take a step back. Can you think of a historical parallel that speaks to the moment we're in right now regarding trade?
You'd have to go back a long way. I mean, you're really looking at Smoot-Hawley level tariffs if these reciprocal ones kick in and this everything else we have so far. You know, it really has been that long. You know, one of the, I think, mistakes people make is looking at the first Trump era and saying, oh, well, that didn't hurt, those tariffs didn't hurt the economy that much. But we're talking in terms of both the size of the tariffs and the speed of them. It really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
We also see trading partners react. Ontario putting tariffs on electricity going to certain states in the United States. What kind of retaliatory measures are you expecting as well?
Yeah, the thing that I'm looking at most are asymmetric retaliation. So not tit-for-tat tariffs on goods because from the United States, because, you know, those tariffs are going to hurt Canada or Mexico or China as well. But there are a lot of other ways that countries can retaliate against U.S. businesses that are less painful for them and more painful for the United States. You mentioned, you know, export taxes on electricity, boycotting American liquor in Canadian liquor stores, but the Chinese removing business licenses for certain American multinationals. There are all sorts of ways that governments can go after U.S. interests without just simply slapping tariffs on stuff.
Scott, in Trump 1.0, we saw carve-outs and exemptions, especially from downstream companies, for those companies that maybe make products when it comes to steel and aluminum, which would get those tariffs tomorrow. Are you expecting any sort of exemptions?
I think in the longer term, there has to be, but it really, you know, we just have to wait and see with this administration. You know, we're not just talking about steel and aluminum that's more expensive here in the United States. In a lot of cases, you're talking about steel and aluminum that simply isn't made in the United States. And in some cases will never be made here because it's specialty items, for example. In those cases, American manufacturers are just going to have to eat the tariff. And that's a major cost hit for a lot of companies that produce things that are really reliant on those metals.
There's this ultimate goal of bringing production back to the United States. This is something that President Trump has talked about, which is the reason why I was really struck by an automotive news study that shows that about 1/3 of U.S. auto parts suppliers, they would move production out of the United States if 25% tariffs on Canada and Mexico stick. Can you explain this counterintuitive trend that actually might do the exact opposite of bringing manufacturing to the United States?
Sure. Well, we have to remember two things. One is that there are places that have lower production costs than the United States, of course. But second is that the U.S. consumer market simply isn't driving the global economy bus. And for a lot of companies that have business elsewhere, there isn't an incentive to just move your business that you aren't serving the United States offshore to places that don't have high tariffs on your input costs, don't have all this uncertainty, and don't have the threat of retaliation if you're potentially exporting. So, you know, it's just a numbers game for a lot of these companies. And oftentimes, you know, the economic reality is that numbers make more sense to move your business out of North America, out of the United States, than to pull it in.
Scott, some people have argued that the ultimate goal of this administration is something that everybody can get around, the idea of reducing waste in the government, the idea of broadening out the middle class and bringing certain types of business back to the United States. A lot of people have been talking about that on both sides of the aisle. Is there anything that you see going forward that really does give you hope and optimism that maybe even some of these negotiations will ultimately lead to lower tariffs, or there could be some sort of clarity that comes after April 2nd that gets us closer to that place?
I wish I could be really optimistic here, but the last couple months don't give me grounds for confidence. Yes, I think you could see a few tariff reductions in a few markets. India lowering tariffs on motorcycles, or the Europeans maybe trying to lower tariffs on cars. But the reality is that this shoot first and negotiate later strategy creates intense geopolitical and political problems for foreign countries. It's really difficult for leaders that have to win their own elections abroad to cave to Donald Trump and suddenly liberalize tariffs. And that's why over the years, countries have engaged in free trade agreement negotiations to lower tariffs overall, to not do this reciprocal tit-for-tat thing, but instead kind of achieve a general level of liberalization that matches while protecting certain sensitive industries. That has tended to work pretty well, including for the United States. But this strategy of using tariffs to bully other nations into lowering their trade barriers, it didn't work much during the first Trump administration, and it hasn't worked much in the 80s and the 90s, and I'm worried that it's not going to work very well again today.
Scott, Lisa's trying to be optimistic. You're not helping. Scott Lincecum there at the Cato Institute. Scott, appreciate it. Thank you. Up next, Holly O'Neill of Bank of America on the state of the U.S. consumer. From New York, this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Lisa's mood's turned. Happy. Almost optimistic, constructive.
You asked for
happy
this.
Because the market's down, or happy because you think things should be better?
You told me to take a shower, so I took a shower.
No, I said
washed it off.
Yeah. I said I needed one. That's different. Equity futures right now in the S&P, positive by 1/3 of 1%. If you're just joining us, I'm not explaining. On the Nasdaq, up by 0.4%. Let's get you some movers 2 hours away from the opening bell. Your morning movers with the wonderful Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. This market is the most oversold since 2023, but there's no good news at Delta. What you've got here is a great and fast unwind from clarity and vision at the start of the year on earnings to a knock of 50%. 30 to 50 cents, that's what they're going to earn. We were looking at 70 to $1. This is about lowering the guidance. The question is whether it's a domestic U.S. fissure in confidence, and does it morph into something which knocks the premier front part of the plane on the transatlantic route. Right now, down 8.1%. Tesla down 15% yesterday. You've got that. The worst day since 2020. The halo effect is gone. In other words, that Trump bump by association is now gone. President Trump says he'll buy a Tesla today to show support for Musk. The reality is it's about deliveries. UBS say down 16% in the quarter, down 5% on the year. I leave you with a view on Oracle. This is about a divergence between the numbers and the guidance, down 1.2%. Safrakat's the CEO says more capacity is coming online. Our revenues will grow in 26-27. The market is impatient. Larry Ellison talks about hyper growth. I leave you with a thought. The cloud. Infrastructure, application and revenue, all lighter than the market had estimated. This is about the data and the figures versus rhetoric and the forward guidance. Jonathan, good morning.
Manus Cranny, good morning. And thank you, my friend, for everything. Appreciate it. Thank you very much. On our radar this morning, Ontario, Canada, raising prices on all power exported to Minnesota, Michigan and New York. The move part of retaliation against President Donald Trump's tariffs. The latest push from Canada, the latest tension between the two nations.
And it really points to what people didn't expect, which is the resentment that would set in and the fact that political leaders would have to show force against Donald Trump to really cater to their own populations. This idea that not only that, but they would have to come up with some sort of fiscal plan or some sort of political unity. I mean, it's helpful to have a common enemy, and that's essentially what President Trump is offering, a whole host of governments that he otherwise would like to see come down, but that's essentially what he's done.
Doug Ford, the premier, was on with Bloomberg last night. He was talking about Trump has created this chaos. He said Trump will single-handedly be the individual that brings on a recession. The jury's still out on that, by the way. And he's talking about the fact that this is not going to stop because there's patriotism now running wild in Canada. And you know what? You see that in the polls. Trump almost had it where we were about to usher in a conservative leader in Canada. But now, the patriotism we're seeing, they're rallying behind Trudeau's party, which is now the party of Mark Carney.
Polyev must be fuming. 20-point lead for the Conservatives over the Liberals. What, 2 months ago? That change has just been humongous over the last 60 days or so. There is a meeting later on today, so just keep this in mind. 5 p.m. Eastern Time, a meeting between the Business Roundtable and the President of the United States. That's led by Cisco's Chuck Robbins. And sources are telling us here at Bloomberg that the group could include Wall Street bosses Jamie Dimon and Jane Fraser. This conversation at 5 p.m., I hope we get to see some of it. It's going to be very important.
Up until now, there has been this placating type of approach when it comes to CEOs going down to Washington, D.C., having conversations with President Trump. What can we do for you? How can we rewrap some of our plans and goose them up a little bit and make them look like they're even better? How can you use us as an excuse of the dynamism of the American economy? The tone is going to be different. What do they ask for? And can President Trump give some clarity at a time where he says that he already has, and he has a plan? How does he give clarity without backtracking on some of the plan?
They want clarity, but part of his approach is to be uncertain because if he's negotiating, he wants to have that leverage over allies and foes. I want to see what the tone shifts from individuals like Jamie Dimon, who a month ago said, so far so good when it comes to Trump's use of tariffs. He then went on to say they do get people to the table, they do piss off allies, they're confusing and stuff like that, but they can have negative consequences. So first they were so far so good, but they could have negative consequences. Are we at that point where Jamie Dimon walks out of that meeting and says they do have negative consequences?
I wonder if Elon Musk will be in the room. Elon Musk saying that entitlement spending, including Social Security and Medicare, is next on the Doge chopping block. Musk arguing the federal programs are plagued by fraud. There was a really nice sit-down conversation between Elon Musk and the former NEC director, Larry Kudlow, just yesterday.
The issue with this, of course, is that, yes, Elon Elon Musk is correct when you talk about what is the massive piece of pie when it comes to government spending. It's going to be entitlements, but this runs absolutely counter to what Donald Trump made in terms of promises on the campaign trail and in office. He will not go after Social Security and Medicare benefits. Elon Musk, though, First Buddy, is saying that's something he's looking at. So we need some clarity on that as well.
Is the president buying a Tesla today?
That's what he says, according to his Truth Social. Well, look, it was just after midnight, so I'm thinking he said this morning as in a few hours, because he probably didn't go to bed yet, or it could be tomorrow. I'm just wondering if he's going to buy, the small, model,
He's
or is he
going
to
to
buy
buy
a Cybertruck?
100% I'll drive it up. Of course, drive it onto the
golf
wall.
cart? That would be very Trump.
That would be hysterical.
Drive it around the White House.
And then leave it there?
That would be cool. Let's talk about CPI. The data drops tomorrow. Get another read on the US consumer, a read on the labour market later on this morning as well when we get JOLTS. The Bank of America Institute releasing its latest consumer checkpoint survey. The team writing the following: the consumer is still demonstrating underlying forward momentum, though at a more measured pace. I'm pleased to say that giving us some time this morning is Holly O'Neill, the president of retail banking at Bank of America. Holly, welcome back to the program. A warm welcome to Bloomberg Surveillance. We've heard from a few companies in the last 24 hours, from Delta Airlines, from American Airlines, that maybe the consumer was a bit softer in February. We're just wondering, Holly, whether you see anything of the same at all in your business.
So I think you had it right when you said continued forward momentum, but at a more measured pace. And in February, we saw a little softness mid-month in certain regions in Texas on the East Coast. We really think driven by weather. And in most of those locations, it recovered by the end of the month. So when you look at the February spending data that we have, it was up month over month when you seasonally adjust it. So even though there was some mid-month disruptions with weather, we saw most locations recover from that.
Holly, on what though? Recover in terms of spending on consumer discretionary, on groceries. I mean, we've been talking all morning about the airlines coming out and saying that they really haven't yet seen that recovery in some of the domestic travel spend. Is that really being focused in, say, buying food for families?
Sure. So overall spend recovered. So our total debit and credit card spend was up month over month, seasonally adjusted. So that includes everything. When you dig in underneath on the grocery front, grocery spending was up. And we actually, within those numbers, you saw value grocery spending up, premium grocery spending down a little bit. So overall groceries up, but you saw the consumer adjusting where they were spending their money.
So this goes to this question of, is this a head fake? Are people getting a little too carried away with the narrative that sentiment is deteriorating so rapidly that spending is falling off a cliff and that's going to stymie any kind of American exceptionalism? Would you push back against that and say, actually, what we see is just the same as what we saw before, which is a moderating trend, people looking for value, but otherwise a consumer that's still pretty healthy?
That's right, a moderating trend. And you really do have to separate what sentiment says versus what consumers are actually doing. And so that spend data, the grocery trends that we talked about, the overall spend, that is what consumers are actually doing. And we do at times see a difference in sentiment and their actual behavior. And I think that's very important. So again, continued forward momentum, but at a more measured pace for the consumer. We did not see spend fall off a cliff, as you said.
We've also talked about the fact that delinquencies on credit cards have been creeping higher. We have seen some signs of distress in auto loans. I'm just wondering where fact meets fiction, right? Where stories have gotten carried away from each other, from themselves, versus any kind of true warning signs that you're seeing in any of the trends that you monitor.
So from a credit perspective, we're seeing a very normalized environment at Bank of America. And in fact, we're seeing delinquencies, somewhat stabilize and are expecting them to come down as the year goes forward. So we're not seeing any unusual patterns there. And I would call it a very normalized credit environment from what we're seeing with our clients.
You mentioned the potential tariff impact in your report. What sectors are you seeing that bleed into this potential increase in prices and then potentially what it might be harder for consumers?
So we'll look at the consumer as a whole, right? And we'll look at high-income consumers, we'll look at low-income income consumers and watch what their patterns are. But as we talked about with the groceries, consumers do self-regulate with shifting prices, and I would expect nothing different no matter what tariff environment comes through. So we'll watch the consumers really closely as to how they adjust their spending patterns if prices were to increase.
Do you see any policies out of Washington hitting consumers right now besides trade?
We are not. I mean, again, across the board, we're seeing very normalized, good momentum with the consumer overall. So we're not seeing anything underneath from Washington come through now.
Holly, just to finish on what's been happening with interest rates have stayed much higher for longer at the Federal Reserve, but rates at the long end, something that this administration has celebrated, have started to move lower, which is important for mortgages. What are you seeing in terms of credit access, and are consumers trying to step up, or are they holding back?
I would say consumers continue to borrow. Consumers continue to borrow at a normalized rate, and we see that in our credit card data. So average borrowing from our credit card borrowers is slightly above where it was pre-pandemic. So they still have access to credit. I think from a mortgage perspective, we haven't quite seen the demand really flood back into the market. We're still seeing purchase volume, but again, because of the rate environment, that refi volume is certainly at the lower end. But that's something that we would expect to come back as the rates change.
Holly, appreciate it. This was an important update on a day where a lot of people are concerned about the consumer. Holly O'Neill there of Bank of America, the president of retail banking. What we've seen so far then from the companies, the likes of Delta, the likes of American Airlines, seeing a softer consumer than anticipated only a few months ago. What we've seen in the surveys is things really soften up. Saw that from the New York Fed just yesterday. What you're hearing from Bank of America, which has literally millions of bank accounts for retail accounts in the United States of America, is yes, things have moderated, but you still have that forward momentum.
They still saw an increase that was significant in travel spending, which I thought was interesting when I looked at their recent study, because it just highlights that it's not as clean a story as it may seem. You talked, though, about the New York Fed survey yesterday. Mean unemployment expectations jumped 5.4 percentage points to 39.4%, its highest reading since September 2023. The sentiment is concerning for people because it's happening at all ends. At the same time, right now, you're not seeing it in the hard data.
Not yet, and maybe we will in the months still to come. Equity futures right now on the S&P, positive by 0.5%, with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Western security officials say Russian President Vladimir Putin has no intention to compromise on land, peacekeepers, and Ukraine's neutrality in any peace talks. Those officials said that Putin has made a maximalist list of demands ahead of negotiations and is prepared to continue fighting if his goals aren't met. Greenland is heading to the polls in a general election that will determine the country's path to independence from Denmark. All leading parties favor sovereignty, but the winner will get to define how and when Greenland becomes its own nation and which countries it may align itself with once that happens. Elsewhere, Apple is preparing a major software overhaul. Bloomberg has learned that Apple is planning to transform the interface of the iPhone, iPad, and Mac, aiming to make its operating systems more consistent and simplify navigation. The revamp will be unveiled at Apple's Worldwide Developers Conference in June. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some.
Up next on the program, Kelsey Barrow of JP Morgan Asset Management. Live from New York, you're watching Bloomberg Surveillance.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The airlines in focus this morning. Check out these two names, both American and Delta. Delta is down by 7. It was a whole lot worse than that. It was down by double digits earlier this morning after cutting its guidance yesterday for Q1, slashing the outlook for the first quarter. Who was next? American Airlines was next. That stock is down by 3.6%. Getting an update also from Dick's Sporting Goods. The airlines are telling us that the consumer started to pull back in the middle of February, and businesses did too. The outlook at Dick's in focus here, Lisa, the stock down by close to 4%.
A similar type of tone as the airlines. And there was a question, how much is the airline story idiosyncratic because of safety concerns? Dick's Sporting Goods also gives a downbeat outlook, talking about, quote, the dynamic macroeconomic environment as leading to some of the concerns that they have. You're looking at some sort of earnings per share being as low as $13.80 for the upcoming year versus the expectation of $14.23.
Why don't they just say it? Why do they have to say the dynamic macro environment?
Macroeconomic environment.
Why don't they just say policy?
Well, and actually we heard directly that from Ed Bastian. I think a lot of pause. Take a step back. This is very quickly moving, and we have gone from a scenario, I can't believe you're making me justify this, where companies were concerned about invoking the ire of the White House, to now trying to give a slight suggestion that maybe this is problematic.
And maybe we get an update on that slight suggestion at 5 p.m. Eastern Time. Later on this afternoon, the Business Roundtable sitting down with the President of the United States. Under surveillance this morning, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some. That's great because the world's looking at a period of time right now where you have kind of debt spending internationally and some austerity or restructuring in the U.S.
So here's the latest this morning. U.S. Treasuries rallying yesterday as the S&P 500 nears correction territory. Kelsey Barrow of J.P. Morgan writing, amid the uncertainty, one detail is clear. An allocation to high-quality fixed income is once again serving as a diversifying ballast in investor portfolios. Kelsey joins us now for more. Kelsey, good morning. Good to see you.
Good morning.
Let's pick up on what Steve Chevron said there at the end. Maybe some austerity in America, and I stress maybe. And you put that up against perhaps a real expansion of the fiscal deficit over in places like Germany. What does that mean for treasuries in an international bond market?
Yeah, so I think that you've hit on a really key point. We've been very focused on the U.S., what's happening in the White House, but there are seismic shifts happening outside of the U.S. right now. And the shift in Europe towards defense spending and towards infrastructure spending is really an important shift that we're seeing. And while we're talking about in the US that bonds are serving as a diversifying safe haven, so while stocks are going down, bond prices, you have US Treasuries, agency mortgages, investment grade credit, all up in price yesterday. In Germany, you have essentially the opposite, which is bonds have been hit massively, bond yields are up, but stocks are up in Europe too. One of the biggest trades that's been in place for at least a year has been the investment of foreign investors in US equities on an unhedged basis, right? They wanted the US equities and they wanted it unhedged because nothing's ever going to happen to the dollar, right? That, I think, is the biggest trade that is in the process of being reevaluated right now.
You think we're unwinding that big dollar long we've built up over the last several years?
That is what it appears. It's not going to be a straight line, right? But I do think that what has been underestimated is not what the US is doing, because that's been out there. Trump's been talking about tariffs. Trump's been talking about layoffs. What's been underestimated is the response from the rest of the world. We knew they would respond. The magnitude of the response has been the surprise.
There's a real question embedded in this observation about the shift in the balance of dollars and the dollar long, which is if money is moving away from the United States, do long-term treasuries offer the same kind of ballast, or will there not be the same degree of demand for them because some of that money is diverted elsewhere, say to Germany?
So I think that we can differentiate a bit between the equity markets and the dollar trade and the bond trade. Typically you think about them together, but what we've seen over the past few weeks is you can have periods where the treasury market is getting a bid, long-term yields are falling, and the dollar is softening modestly. It sounds like a bit of a paradox, but I do think it's something that can continue to occur. One thing that will be on investors' minds as we move forward is the deficit trajectory, right, in the two places. In Europe, we're seeing for the first time Germany is considering a deficit, considering more deficits as an advantage to them. At the same time, the US is considering the fact that deficits are not our friend anymore, and we need to be managing them much more closely. As long as those two, that sentiment continues, I think that you can continue to see the support in long-end treasuries, and on the other hand, I would expect Europe, Germany to continue to underperform.
I would love you to have a debate with Ashok Bhatia of Neuberger Berman, who was on the show yesterday. At some point, I would love to witness you guys have a discussion about this. He was saying he actually is getting a little bit more bearish on long-term treasuries. What he sees is this concern that even as people price in Federal Reserve rate cuts, that stickiness and inflation and that real kind of floor under how far the Fed can go, and ongoing deficit concerns that are not going to get fixed by simply cutting on the edges. It will take something more sustainable, is going to really create a problem longer term for the United States and for the Federal Reserve. Why do you disagree with that the term premium is just going to be structurally higher in the United States?
Well, I think the term premium already is structurally higher, right? So if you're a longer term investor, if you are looking at the market over a 5 to 10 year horizon, you're already observing that term premium in the US is substantially higher. Yields are substantially higher than they were before. So I think that that story is already essentially in the price. And what we're looking at now is that there's quite a bit of demand at these yield levels, particularly when you have a Fed that is maintaining an easing bias. Yes, inflation has been a bit stickier than before, but it's our view that ultimately what is going to get the Fed moving more aggressively in terms of rate cuts is if we start to see the weakness translate into weaker labor market data.
High yield spreads wider yesterday by almost 20 basis points, back through 300. Is that a buy yet? What are you looking for?
So it is interesting. This goes back to this kind of question of, is it the spread move that people care about or the price move? So spread buyers are saying, great, okay, we've had a bit of a backup. Maybe this is an opportunity to get in. On a price basis, most of the high quality part of the high yield index those bonds have not really moved down in price very much because the yield movement has offset the spread widening. So I think you could view that in two ways. One, maybe there's a little bit more pain to come, but also I would say it's really credit towards the strong fundamental starting point for investment grade and high yield bonds in this market. And I don't think we shouldn't lose sight of that. Coming into this year, growth was very strong. Defaults continue to remain very low. Margins for companies were at the higher end of their ranges. So companies are probably as best placed as they possibly can be for the difficult times ahead.
Kelsey, appreciate it. Kelsey Barrow there of JP Morgan Asset Management. Corporate America still resilient. It's a message we've heard over the last number of years.
Corporate America that borrowed bonds a while ago and then locked in financing costs in the high yield bond market.
Everyone else, if you haven't done that, might be a problem. Coming up, Matt Miskin of John Hancock, Ben Kellogg of Baird, Lindsay Piegza of Stifel, and Lindsay Rosner of Goldman Sachs. The third hour of Bloomberg Surveillance up next.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures near session highs, positive by 0.5% on the S&P 500. The next stop for this market, just in terms of the economic data, about 2 hours away. In 2 hours' time, the JOLTS job openings read. Job openings in the United States of America, another read on the labour market worth looking at. Then later on this afternoon, at about 5 p.m., the Business Roundtable, led by Chuck Robbins of Cisco, sitting down with the President of the United States. Included in that meeting, reportedly, potentially, Jamie Dimon of JP Morgan, Jane Fraser of Citi, coming at a time when business confidence, and small business confidence specifically, Lisa, is just starting to soften.
We saw it roll over to the greatest degree going back 4 months in the NFIB Small Business Survey earlier this morning. We're hearing from a host of different companies that they are downgrading their outlooks in the near term because of consumer uncertainty. We're hearing that across the board, across industries. At the same time, Holly O'Neill really presenting the opposite view, which is consumers are still spending. Watch what they do, not what they say, and that has been somewhat different.
There is still that forward momentum. Are we losing some of that forward momentum, though, for consumers? So let's go to the airlines. We've heard from Delta, we've heard from American Airlines in the last 24 hours, both of which have cut their outlook for Q1. Ed Bastian of Delta suggesting that maybe some of these issues could be transitory. But what does it mean for summer travel? This is what we're hearing from Delta executives. They're speaking at a JP Morgan industry conference just moments ago, planning to slow capacity growth plans for both spring and summer. That speaks volumes.
It speaks volumes, especially, and I keep going back to this, in January, they said that the supply-demand dynamic was as good as they've ever seen it. Suddenly now, they are cutting capacity in order to keep prices up and keep their profitability up. We're seeing similar tones across the airlines. We heard from American Airlines, we heard from JetBlue, we heard from Southwest, now charging for you to check your bags for the first time in their history. I mean, all of these ways to really drum up revenue. Well, I mean, look, I'm just saying, it's always really fun to fly, but it's going to get even more fun.
Take a beat? I think we should take a beat.
Okay, go ahead.
They've got this totally back to front at Southwest.
You're correct on this.
The most disruptive part of flying right now is the boarding process, because the overhead cabins are full of luggage, and people have to put their luggage in the hold. The convenience is the cabin, not the hold. So charging people for the hold is not the issue at play here. Charge people for the cabin, give the hold for free. You'll make the money because a lot of people want the convenience, and you'll open up the space, and hopefully you'll improve the experience of flyers in the United States of America. Why is that so difficult to get your head around?
It would also improve probably some of the employee satisfaction who are not trying to break up fights for people to get on into the plane first. The whole idea of gate lice, remember that? People who try to pretend that they have a higher status, they can get on first. They wouldn't care if they could just pay to check their...
regulation that I don't know about that prevents them from doing that, because it just makes so much sense. Why not do it?
Well, it's also opening up now, potentially this void for other airlines to fill. Delta now saying that Southwest bag fee change puts customers up for grabs, because they're saying that this might mean customers are saying, look, we'll go elsewhere if we're going to have to pay for it. But I totally agree with you. You want to pay for the convenience. And also, it just goes to show that more people want to actually bring their luggage with them, because when they're at capacity, they just take your bag for free because they have no choice.
Want to make it smoother, reduce the friction. That's what it should all be about. Anyway, there's your tangent. Equities right now in the S&P positive by 0.5%. We begin this hour with stocks looking to rebound from their biggest one-day loss of the year. Matt Miskin of John Hancock writing, there is an equity risk being priced into the US that is going in the opposite direction in non-US. We struggle to see such a divide in global growth being sustainable. Matt joins us now for more. Matt, welcome to the program, sir. Let's talk about that. Why do you believe that some of these trends are unsustainable?
Because at the end of the day, John, we're all together on the same economic cycle. So global growth is actually moderating, in our view, off of a pretty good level in 2024. If this is a macro regime shift, and it's almost like we went into a reacceleration into an air pocket. So we're feeling that turbulence. All of a sudden, the U.S. economy is slowing down a bit here. Might be the weather. We might have to do a little Milli Vanilli and blame it on the rain. But at the end of the day, we're feeling an air pocket. If the macro regime is going back to slower growth, we're not going to likely see a lower quality cyclical rotation out of much of these non-U.S. equities.
So, Matt, you're not chasing Europe here. You're not chasing China.
That's right. I mean, the momentum has been terrific, and it has seen just massive gains year to date. But what we're seeing is really reruns that we saw in the United States. So from Europe right now, we're getting election euphoria. Everything's going to change. It's going to be much better. And European financials have skyrocketed. I can't stop watching them day to day because they're the new meme stock. But after an election, a lot of times there's this cooling after post-honeymoon period, which actually the United States has seen a little bit here. That may happen in Europe. In China right now, they're going after the AI trade. We've seen this trade before in the U.S. And so a lot of these we think are going to be shorter-term phenomenon. We'd be tactical, try to trim into some strength, redeploy capital. We're actually looking at higher quality bonds and actually credit relative to equities. So you can dial back your equities and go in. You're just talking about high yield bonds, yielding around 7.5%. Get income now instead of price appreciation. Income's likely to be a bigger driver of total return going forward. That's what we're focused on.
For a second, Matt, I thought you were going to come out and say, buy U.S. stocks, buy the weakness, and instead you say, buy bonds, which is not exactly raging optimism and talking about high-quality bonds at that. Are you talking about, if it's not necessarily the golden spot in Europe or in China, that we're facing a global slowdown where the United States and duration is really going to be the haven that will protect you at a time where other areas might be getting a sugar high right now?
It's exactly right, Lisa. And what we're seeing is that certain markets are repricing, certain markets aren't. And as a global multi-asset investor, this is what's phenomenal for us because we're looking around and we're saying, what is pricing in risk? What isn't? And actually the 10-year still at about 420 to us is not pricing in that much bad news. I mean, you got to rewind about 5 months in pre-Fed cuts. The 10-year was 360. So you still have a lot of cushion of yield potential that could be evaporated, frankly, if the bond market starts pricing in worse economic data. And then globally, yes, there's capital that is flying around the world looking for the fastest momentum trade. The U.S. momentum factor has hit a wall, and that has yet to happen on a global basis. But we actually don't. The U.S. is actually holding up okay in our view right now. It's just slower growth. It's not the end of the world growth. And it's odd to us that some of these high quality stocks are the ones selling off the most. Actually, we think there's going to be value in some of these tech names that have sold off here, whereas other parts of the market have gotten more expensive in their lower quality equities.
What are you waiting for, Matt? I mean, I ask this because a lot of people are saying, okay, this potentially could be a buy the dip moment. If you liked it 10 days ago, why not like it even more on sale? It seems like there is a level of uncertainty that's making it difficult for people to say with conviction that we're not in some sort of paradigm shift, that we're not seeing a rejiggering of the global dynamism and, frankly, a releveraging of Europe while you still have a pretty big deficit in the United States. What gives you the confidence that there will be that upswing, that there will be that sense that the U.S. is still exceptional?
So we're watching high yield spreads, and as you all have already talked about, they're over 300 basis points. They're going in the wrong direction, so that is making us actually less optimistic in terms of this, potential reacceleration of the economy. But initial jobless claims is another thing we're watching, and they're 220,000. They came back after the prior week. But what we're doing right now is we're bracing, in essence, for the potential slowdown around the government employment picture. This last jobs report, we didn't think was that bad, but the question is, okay, well, is the next one going to be weaker? And are we going to see the Challenger report was actually the biggest shock of last week, showing that the layoff announcements were ticking up. That usually leads initial jobless claims. And then again, high yield spreads. So we are more defensive in the equity positioning. We do have some high quality, but real quality values, things like healthcare, utilities, dividend paying stocks, high quality balance sheets. Those have sold off a bit, but they've held in mid cap, for example, and some of the high qualities holding up the best year to date. And then international, it looks like the world, they're trading on another planet. And in our view, that's going to come together. We wouldn't chase that. We still like quality, but again, income is going to be a better return driver after so much return out of equities. We got to find different asset classes to work into the portfolio. Credit, in high quality bonds are great opportunities to us.
Matt, I hear what you're saying in terms of equity risk being priced into the U.S. and it's basically going in the opposite direction everywhere else in the world. Does that change on April 2nd?
Perhaps. I mean, it can change on a dime, frankly, but right now you could just see it in the commodity trading advisor or kind of the momentum traders, global macro traders. It can change quickly, you know, and we just want to be careful here chasing that, you know, and so much right now is politically driven. This year, 2025, almost everything has been political, influencing the markets. And in our view, that is a shorter term phenomenon. It's not investable. We actually don't use politics in investing. I know it sounds crazy because given everything that's going on, but you really want to focus on the earnings trends. The best earnings in the world still is in the United States. We still like the US vis-a-vis other parts of the world. And actually, for once in a while, they're getting cheaper. That might actually cause a relative opportunity versus a lot of other equities elsewhere.
Matt, you say you don't use politics, but we're talking about policy. The Trump administration is talking about a global realignment when it comes to trade and also changing the way basically the U.S. economy works, trying to reprivatize and also make sure jobs are going more into the private sector. That's not politics. This is policy. You have to start baking some of this in, no?
Yeah, Maria, I'd love to agree with you on that one, but the policy can change on a dime too. You know, yesterday we could have tariffs, today we can't. Next day it could be tariffs, the other day it can. And if you're trying to make a decision on 12 to 18 months or 3 to 5 years for clients, investor portfolios on tariffs that could be here tomorrow or gone the next day, it's just going to drive.
Matt, just to jump in, if you can acknowledge that that's going to be a feature of the next several years, wouldn't you also have to acknowledge that the multiple that people will be willing to pay for some of these names will be lower than it otherwise would be if we had clarity on policy?
I hear you, John, but at the end of the day, NVIDIA or some of these huge tech giants, they've been growing earnings. That wasn't because of fiscal policy. The real earnings trends are because of competitive, it goes back to like SWOT analysis of business school, or it goes back to, you know, kind of the productivity or the executing of the business. We're investing in companies, not countries. It's about the stocks, not the economy. You're not investing on GDP. You're not investing GDP. You're investing on the stocks. And I think that's a big differentiation right now. Right now, everything's getting turned around really fast based on political headlines. You're going to get yourself turned around into a pretzel on that. You want to really focus on the fundamentals. And right now, they're not that bad, but they are diminishing. If that macro regime is changing, you want to actually move up in quality, focus more on income. And we're trying to keep it simple. And that's where we would position.
Sounds like you're buying NVIDIA.
Not go that far, John. We don't talk about it.
That's right. That's right.
We like quality.
That's right. That's right. Just as you're in the flow, just setting your trip up. Matt, appreciate it. Thank you, sir. Matt Miskin of John Hancock Investment Management. Equities right now in the S&P positive by a little more than 0.1%. A small bounce this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Billionaire presidential advisor Elon Musk is calling for cuts to entitlement spending, including Social Security and Medicaid, arguing that the federal programs are plagued by fraud. Speaking to Fox Business, Musk said most of the federal spending is entitlements, so that's the big one to eliminate. However, many Republicans have been adamant that entitlement benefits will not be part of DOGE cuts. Shares of Dick's Sporting Goods falling in the pre-market 5.2%. The sporting goods retailer reported sales and profit that beat analyst estimates, but it did issue a disappointing outlook for the fiscal year. Dick's CEO has been working to invest the company's physical store network and upgrade its e-commerce capabilities. And Mr. Beast's biggest moneymaker is not YouTube, it's chocolate. Jimmy Donaldson's Feastables chocolate business generated about $250 million in sales last year, with a more than $20 million in profit. His media business lost almost $80 million. Sources tell Bloomberg that Beast Industries is looking to raise a couple $100 million to expand its existing divisions. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Up next on the program, the Morning Calls Plus, Ben Callow of Baird on a big move lower in Tesla. That's next. This is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equity futures here just about positive, up by 0.1% on the S&P, up by 0.2 on the Nasdaq 100. You're opening about 1 hour and 13 minutes away. Let's get you some morning calls. First up, Barclays lowering its price target on Delta to 80, anticipating softer demand. That stock is down by 7% this morning. Your second call from Stifel, lowering its price target on Oracle to 150, expecting limited multiple expansion. That name is down by 2.3%. And finally, CFRA upgrading Amazon to strong buy, saying the company is more recession resilient than its peers. Stock just a little bit softer. We're down 0.1% so far this morning. Let's turn to Tesla. Shares looking to bounce back after their biggest one-day drop since 2020. The stock down nearly 45% so far this year, wiping out its gains since President Trump's election win back in November. Ben Callow of Baird writing, we continue to view Tesla as a core holding long-term and see the company as the leader in real-world AI, but a bearish near-term. Ben joins us now for more. Ben, welcome back to the program, sir. You're one of the best, so looking forward to this conversation. Walk me through, just from your standpoint, what's leading this stock lower? Is it something bigger than just the name itself, or is it Tesla-specific?
Well, market is the backdrop, but Tesla specific. It's the delivery numbers. It's as simple as that. For Q1, the stock can't go up until the consensus numbers come down because there's this narrative that Musk is destroying demand out there. Whether that's right or wrong, they're doing a Model Y refresh across all 4 factories, and so a Model Y typically has 300,000 deliveries in a quarter. So let's just take out 2 months of that. So 200,000 cars that aren't being produced or just now being produced. And that's going to be compounded with all the backdrop of protests and all the bad stuff going on with Tesla. And it's going to extend that narrative around demand.
But Ben, deliveries have never really mattered, right? I mean, it doesn't seem to matter how much they sell or how much they don't sell. It's always about this faith in longer-term robo-taxis and autonomous driving. Has that belief shifted? Has there been a narrative vibe shift among retail investors that could mean a longer-lasting dip?
I think so. I think that over time we've seen the lens where Tesla's value be longer at some points, and when things get bad, it tends to refocus very short term, and that's where we are right now, very short term focus. And I think that when we get a delivery number that's worse than people are expecting, it's going to be carrying on that narrative of demand being bad because of demand destruction, and that affects the long term story.
Yesterday, Elon Musk was asked on Fox News about how he was running his other businesses while he was engaged in right-sizing the government. And he said, with great difficulty. At what point do people get concerned about the fact that their CEO is distracted and doesn't really have time to manage the company, forget day to day, but even week to week?
Well, it's a good question. It's come up a lot because of SpaceX and his other businesses that he has. Now that he's at Doge and he's spending his time in Washington, D.C., I think it's harder to defend what he's doing on a day-to-day basis and how much he's being involved. And you have pundits out there, people that would normally be like on his side saying, like, hey, send me 5 bullet points of what you've done. I'm not saying that's right or wrong, but when you have someone that is well-known in the media saying, hey, why don't you send me 5 bullets about what you've done at Tesla lately? That raises eyebrows.
Ben, yesterday we had, or last night, the president come out and in a truth post say he's going to go out and buy a Tesla in the morning. He talked about the fact that Elon's, quote, baby is under attack and people want to do harm to Elon. If Trump comes out and buy a Tesla, is that bullish or bearish for the shares?
I think that it's good that he supports it, and I agree that Musk is an important person in the United States globally, but I think there's a lot of people that are indifferent to Musk at best. And one point that I'd like to make when we're talking about demand is if we read about people's cars getting keyed or in worst case scenarios set on fire. If I'm indifferent or even a Musk supporter, I might pause before I go buy a Tesla. But our call is not that. Our call is that numbers are too high because of production issues in Q1, but that's going to extend the narrative of demand destruction in longer term.
But it's not just demand destruction potentially in the United States. When it comes to Musk and his political involvement with the president and Doge, we're also seeing this in Germany and people pushing back because his support for far-right German party. How do you pinpoint potential political erosion of the shares?
It's difficult, and that's where uncertainty is, and that's why the stock can't go up until, I hate to keep repeating myself, until numbers come down on the street, because it's going to continue that narrative. But I think that, Europe counts for about 25% of sales. I think the demand destruction is actually happening there versus the United States. Now, those numbers get kind of iffy because they are having production issues right now. But I think in Europe, people take this a lot more seriously when they're buying a car than the Uber driver, in New York City.
Potentially more than political threats or political boycotts is the idea of China competition and the fact that BYD has overtaken Tesla as by far the biggest seller of electric vehicles in China. And you have this increasing production in that nation as well as lower costs. At what point does that become a real headwind that becomes harder and harder to ignore, especially with all of the other challenges that are facing this name?
Anecdotally, I was in Europe for 2 weeks visiting clients over the last 2 weeks ago. And I see BYD stores and, talking to clients. Someone brought up a good point. Like a year ago, no one would have bought a Chinese car. Now with the alternative of being a Tesla and Musk, this was their opinion, not mine. That it's an easier sale for a BYD. But I think it just compounds, the uncertainty in the stock right now.
It's certainly a tricky moment for the stock. Ben, appreciate your time, as always. Ben Keller there of Baird. The stock this morning attempted to bounce back from the big one-day loss yesterday, the biggest one-day loss since 2020. If you just go to the analyst community this morning, check out the ANR page on a Bloomberg terminal if you have access. The average 12-month price target right now is 362. So you're talking about 60% upside from where we closed yesterday. And if you ask those analysts why are they so bullish, they won't talk about car sales. And this is the tricky moment with Tesla, to be honest with you, because there are market regimes where auto sales and deliveries drive the stock. There are other times when it really doesn't at all. You're talking about the future, full self-driving, what's going to happen with AI, that big futuristic stuff. That's going to be what underpins a lot of those really bullish calls.
This is a storytelling market. This is a storytelling market that really points to the idea of a future where we don't have to drive and we can send our kids in cars with no drivers and they can get anywhere that they want safely and in an orchestrated manner. And the chief storyteller is not available. And that, I think, is important. And the fact that the chief storyteller is now a polarizing figure in American politics makes this a much more difficult story for a lot of people to buy into.
Market backdrop doesn't help. People don't want to hear nice stories. They want to see evidence. They want to see the real deal. They want to see the data. And at moments like this is why I think deliveries matter that much more.
Yeah, it also matters what point we're coming from. I mean, we're seeing a 55% retracement in the shares after a huge run-up after the election, giving up all of those gains. So are we back to where we were before, or is this the beginning of something more protracted? And that's really the ultimate question.
Tesla this morning bouncing back by just 1% in the pre-market. Up next on the program, we'll catch up with Lindsay Piegza of Stifel. We'll get her thoughts on what's happening with the economy, the latest small business conference confidence read and what we're hearing from the airlines. We'll speak to Lindsay about that. Then Lisa Rosa at Goldman Sachs. As we look ahead to the economic data through the rest of this week, CPI tomorrow, and some of the moves we're seeing in fixed income. From New York City, this is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Equity futures on the S&P positive by 0.25%. The open about 60 minutes away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. This morning, I had a little bit of an airline special for you. I know we're also just getting some breaking lines from United about them seeing a drop in government-related travel. Delta, though, kicking it off with that. This really started it off yesterday with their earnings cutting basically in half their first quarter expectation. Delta shares falling some 4 1/3%. It's the worst of all worlds. It is a consumer that they say is less willing to spend because of macro uncertainty. That's hurting domestic travel, plus the mid-air collision of American Air and a crash landing for Delta. Speaking of American, another airline that we heard from this morning, a very similar picture, seeing a wider loss for the first fiscal quarter. Those losses aren't as bad. I should say all these airlines are starting to pair some of the worst of their losses. American Air down about 1%. Now, Southwest, also a similar warning from them. Their forecast is going to look weaker with that demand. but a difference in fortune for the shares. Those shares up 10 1/3%. And John, I know you have some feelings about this one. Part of the reason that the shares are up is because they're doing a change of strategy. No longer will you get free checked bags. Your first and your second one, you're going to have a fee paid unless you're part of their loyalty program or have a business flight. All of this part of Elliott, some of the Elliott management changes that's come in. So those shares up nearly 10%, John.
Danny, thank you. Appreciate it. That's the latest on the airline front. Just want to throw in this additional headline. Danny mentioned United Airlines. If you're just joining us, welcome. This is quite a headline, saying it's seen a 50% drop in government-related travel. That's the headline just dropping from United.
I'm not surprised about this at all, because anecdotally I did hear potentially some departments and agencies were pulling back on who they were letting go travel to conferences or meet people around the country or internationally. So when you see this, I'm really not surprised, given the Doge effect and how they want to really rein in spending at these agencies and make agencies more efficient. But 50%, that's huge. That's half of government travel.
Yeah, it's government travel and all related. And we keep talking about the idea of what kind of contractors and contract work is also going to be put on ice as they wait for that. And just to give you some commentary from the JP Morgan Airline Conference, Ed Bastian, Delta CEO, saying the first quarter has been a parade of horribles. That has been his discussion point for the airline industry.
So how much of this, and this is the key challenge, I think, how much of this was about the accidents we've seen, the flight safety events of the last several months? How much of it is truly about a slowdown in the consumer and business-related stories connected to what we're seeing with the Doge effort down in Washington?
Look, we can't say with any precision, but what we can say is it's not just the airline industry that's giving the same type of sentiment shift. We're hearing from Dick's Sporting Goods. We heard from Kohl's. We've heard from Walmart. We've heard from a whole host of other companies. At a certain point, it's no longer anecdotes when you have a holistic tone shift.
Get more data later on this morning, about 90 minutes away. You'll get JOLTS job openings at 10 a.m. Eastern time. Tomorrow, you'll get CPI. The day after, you'll get PPI. Mike McKee, our economics and policy correspondent, joins us now for more. Mike McKee, what are you looking for in that data later?
Well, we're hoping not to see a parade of horribles in the data this week. JOLTS comes in with supposedly more job openings, but it's kind of irrelevant at this point, given the fact that people aren't really hiring that much, according to what they're telling officials at the Fed and other places. So look at the quit rate. Let's see what people think about their ability to get a new job. And of course, CPI, everybody's going to be watching to see whether inflation progress continues or goes the other way, because we've gotten some not so great news this morning. We were talking in the 7 o'clock hour about the NFIB survey. There's also the New York Fed survey from yesterday showing the highest number of people expecting worse financial conditions in the next year in 15 months. And the share expecting higher unemployment is at its highest since 2023. That NFIB survey, as we showed you earlier, the second highest level ever for their uncertainty index, and a 10-point drop in small business confidence. So people are looking at the data, they're looking at the headlines out of Washington, and they're not feeling really great. I'll leave you with one chart here that might be important for the viewers right now. This is the New York Fed's question about what do you think is going to happen to stock prices? Kind of speaks for itself.
Not a pretty picture, that's for sure. Mike McKee, thank you, sir. Appreciate it. Here's the take from Lindsay Piegza of Stifel, reining in and weighing in on the U.S. economic slowdown, saying the following: the clear rise in hiring hesitancy has some investors raising the probability of a downturn or even a domestic recession and increasing bets of further Fed policy relief sooner rather than later. Lindsay, I'm pleased to say, joins us now for more. So, Lindsay, let's talk about that. We have seen a major sentiment shift. The soft data, the survey data, has cratered in some places. Lindsay, when you see those kind of moves this quickly, is it inevitable? Is it even avoidable? Do you expect to see it in the hard data?
Well, it's not necessarily inevitable. What we're seeing right now is anxiety over the uncertainty of the realized impact of policy. Now, this was a large campaign promise in terms of the international tariffs in particular. So businesses we saw responding in anticipation at the start of the year, building up inventories, moving to the sideline, curtailing investment and employment plans. From a consumer standpoint, we saw consumers pull back. Again, all of this uncertainty really hitting the pause button for both businesses and consumers, but it will take a few months to see how these policies pan out and the actual impact on prices, on relationships with international providers. And at that point, we'll be able to mesh between near-term uncertainty and longer-run realized impact on the economy.
And Lindsay, we kind of got a reality check from Holly O'Neill of Bank of America earlier this morning where she said consumers are still spending. I mean, they might not be spending as much on flights, but they're still spending, and it's a gradual slowing, but it's not some sort of catastrophic falling off a cliff in terms of what they're seeing in credit cards. And one thing that we keep thinking about is the economy moves pretty slowly. It takes a long time to really hammer an economy that otherwise has quite a bit of momentum. How quickly could we see it really show up in some of the hard data in a way that could be concerning? Or realistically, is the U.S. still a behemoth that is moving pretty slowly and still has quite a bit of momentum?
Well, when we look at the consumer, we did see a pullback at the start of the year. So we've already seen the hard data reflect the uncertainty in part of the consumer. That being said, it has been a second derivative decline, meaning a slower pace of still positive expenditures. So consumers are still out in the marketplace buying goods and services, but they're doing so at a noticeably reduced pace. That being said, we're also looking at how the consumer is affording these purchases, and they are increasingly reliant on buy now, pay later options, ramping up credit card usage with outstanding balances over $1.2 trillion. However, when we put that in perspective of the overall household balance sheet, we still see that the ratio of debt payments relative to disposable income is at a multi-decade low, or at least near a multi-decade low, suggesting there's still a good amount of spending and borrowing power left on part of the consumer to continue to support at least positive growth. Maybe not a robust economy, but if the consumer could gain some confidence and be willing to continue to move into the marketplace, I think the economy could maintain this positive pace of about 1.5% to 2%. But it all comes back to instilling that confidence back into the consumer, not necessarily the ability for the consumer to continue to spend.
This is kind of a mind-spinning moment, Lindsay, and I keep thinking about how soft data and anecdotes are going to be more important right now than the hard data that is going to be backward-looking. The fact that people are looking at the University of Michigan sentiment survey more than JOLTS or even initial jobless claims, because maybe that'll give them an edge onto what's to come. How much can we lean on soft data that has been messy and non-correlated with what people end up doing quite often?
Well, that's exactly it. Consumers often say one thing and do the exact opposite. And so while we are hearing from consumers that there is this anxiety and amid this massive amount of uncertainty, again, consumers are somewhat pulling back, but nominally this is a still positive pace of expenditures. And as long as the consumer, the backbone of the U.S. economy, is continuing to spend right now at an average 3% pace, that's still very indicative of a top-line GDP pace, holding all other variables constant, of about 2%. So again, the economy is still on relatively solid footing, but I think what we're seeing in the sentiment numbers, what we're seeing in the NFIB, what we're seeing from some of these anecdotal reports is this massive amount of uncertainty and this unknown from all of these fiscal policies coming down the pipeline, and a big question mark of how is this going to impact the economy as we look out to the second half of the year.
Lindsay, a week tomorrow, Federal Reserve time, a meeting with Chairman Powell, a news conference, new forecasts. How eventful will March 19th be?
Well, I think it is going to be eventful, not necessarily from a policy standpoint. We do widely expect the Fed to remain on the sidelines. However, from a communications standpoint, we want to see where the Fed is falling in terms of are they erring on the side of the economy is still positive, and thus they're going to continue to remain on the sideline, waiting for the data to evolve, or are they starting to identify some of these signs of weakness, suggesting that they're gearing up to reignite some of this further policy relief that the market seems to be bracing for? So it's really going to come down to that communication, that message from Powell and from the FOMC statement.
Lindsay, appreciate it. Lindsay Piegza of Stifel there. Looking ahead to the Federal Reserve a week tomorrow, March 19th, for an update from the FOMC. New forecast as well. Updates coming from the airlines this morning. United Airlines saying it's seeing weakness in travel demand. The headline that crossed just moments ago, a 50% drop in government-related travel. Those stocks initially this morning a whole lot softer, at least in the last 20 minutes or so, recovering, some of which are in positive territory.
Yeah, and some of them have added to some of the cost revenue, like charging for bags that you check, not the ones that you put in the overhead, which might actually lead to a better quality of experience. But there is this sort of question going forward about whether they are the canary in the coal mine in terms of signifying a really rapid sentiment shift where consumers aren't traveling, or is this idiosyncratic? Is it specific to a couple of parade of terribles?
It's an aggressive business, this airline business, eh? United CEO, the Southwest bag fee change is slaying of the sacred cow. Delta came out and said passengers are up for grabs. Pretty aggressive stuff, isn't it? Southwest comes out with a change and they're like, yes, let's go.
First of all,
feels like Hunger Games right now at the airline conference.
If you've ever been lined up to get on a plane, it feels a little bit like Hunger Games too. So just saying, it's not just the airlines that are aggressive, it's also people using the airlines.
Lindsay Rosner of Goldman Sachs joins us now. Not getting into that. Lindsay, welcome to the program. It's good to see you. You don't want to get into that either.
Not aggressive on the airlines, not me. Thank you. No.
Something you said to us last time, I think, that the data is your friend. What's the data telling you now?
The data's telling you right now that you are paid to pause. And what we mean by that is it makes sense to take a page from the Fed's book. There's nothing we have to do in markets right now to reposition necessarily. So for us, we're just waiting to see how the data unfolds. We need to learn more. JOLTS is not going to give us much information, unfortunately, today because it's really January. But we need to see that, back to your prior guess, has the consumer changed their path? We think not, but all of this data is really going to help us.
This sounds so calm. I mean, I love this. You know, people are talking about slaying of the sacred cow and a parade of horribles. And you're saying we can just stay calm and take a look at what's going on and we don't have to change anything. What are you waiting for? I mean, there's a lot of pretty heated rhetoric out there.
Yeah, I think what we're waiting for is prices that make sense. And so we've been saying that fixed income makes sense in a portfolio. If you look year to date, I think there's a lot of concern right now about what's happened with stocks, off 8% from the peak, down maybe 4% overall. This isn't a massive move, but contrast that, which we think is really important, with what fixed income's done for you. It's earned you in the front end of the curve 2%, in the middle of the curve 4%, back end even more. So I think we're calm because we're bond people, but we're calm because we have a good setup in our portfolio construction overall, with bonds as a ballast.
There's a question about how long-term bonds can really remain a ballast if people start to get concerned about higher overall inflation from a deglobalized world, the idea that supply chains will have more built-in inefficiency. How do you cope with those kinds of discussions? Do you just assume that there isn't going to be price appreciation, that yields are going to sort of stay around here and that that's fine because it's relatively good to be paid to wait?
Well, what will be a problem certainly would be if tariffs are on the maximalist side of things. And what we've seen recently is tariffs on, tariffs off, tariffs being placed out there at a higher level, then brought on at lower levels. I think until we see a full-blown, really aggressive tariff regime, I think you can feel confident in bonds. They have good coupons. We're starting at a good spot there. They will be support, we think, as we wait to find out more. But again, we don't have to day trade our portfolios. And I think that's the important thing. There's been a lot of just frenetic behavior in the markets right now. We were talking before we got on that it's hard to think about even taking a day off from the markets. You can't take a vacation, I think, right now under this administration. But as we learn more, I think we're going to be emboldened that rates are going to help you.
When you're looking at potentially that maximalist approach to trade, it sounds like you're basically waiting for April 2nd. Is that accurate?
Yeah, and we're waiting for April 2nd, just like we waited for March and we waited for February. I mean, I think there's a lot of markers that we keep waiting for. At some point, I think there will be an end to kicking the can a month, and we'll have what is the final here. And that's what really people are waiting for. And I think that uncertainty doesn't do the market well. And so hopefully April 2nd is maybe the beginning of the end of, we know what the permanent state will be.
We're seeing some economic advisors outside the administration, but close to the president, like Steve Moore, saying, you gotta push up the tax cuts. You can't wait for the end of the year. Do you think that's an accurate assumption, that they need to be able to balance some of this uncertainty and bad rhetoric around tariffs with some of the good policy changes they're trying to get through?
Yeah, I think you're bringing up a great point. If you think about what happened post-election, we had this big euphoria bubble. And I think a lot of people have said that, you know, the air is out of this bubble, or the balloon has burst, so to speak, because all the good stuff was thought about, deregulation, tax cuts. Well, we haven't had those yet because the sequencing takes time. Instead, we've seen the more negative things, potentially, like tariffs. And so it's really hard when everybody was banking on really positive things to happen. The negative ones happen first, and we're still waiting for the positive things later on. They are coming. I think they're coming much more slowly. Certainly, if we sped them up, I think people would feel a lot better.
We're getting some policy clarity abroad, and I wonder how you and the team are thinking about the surge we've seen in European bond yields over the past week or so, specifically in Germany, the 40 basis point move last week. These are regime shifts in policy, particularly in Germany, that we haven't seen in decades. How are things changing for you and the team? How do you think about the global backdrop for fixed income now?
Yeah, so what we've said really since 2024 is that there are great opportunities of divergence and that we should be able to take advantage of them in our macro strategies. What's happened in Germany is, to your point, something totally new, large, significant. We actually don't think that the backup in yields is over yet, so we wouldn't hop in yet. Still prefer the US, but I think it's really important to think what that means for a backdrop for credit. So from a credit perspective, Europe has actually outperformed the US. So when we're thinking about how to position our portfolios, we're still leaning into US because we feel like there's more opportunity there. But should that be dislodged, it'll be a good opportunity to shift the portfolios and add back in European credit once we get more clarity on, in fact, if the defense spending will be passed, what will really happen.
What's more compelling to you, the pushing away from the U.S. effect of a potential deterioration in the data, or a potential positive shift, not only with respect to the spending getting passed, but a sense that maybe it could ignite some kind of growth in infrastructure spending on the heels of it in Europe?
Yeah, so this is the big change, and I think you're seeing that with the yields in Europe. This is big spending, and I think now you're starting to see that all the views that there could, in fact, be a recession in Europe or things are looking really, really weak, that's changed a lot because spending is a huge part of GDP, government spending. So that does change the tone out there. But what's important is it is a global environment, and I think what we've seen with stocks, with bonds so far, and the big volatility in performance is that you want to do active management to take advantage of all of these differences and all these movements because they're happening quickly.
Lindsay, it's good to see you, as always. Appreciate the update. Thank you. Lindsay Rosner at Goldman Sachs. Don't take a day off. No one at Goldman takes a day off, do they?
Certainly not this year.
But
this is the reason why people aren't going to be traveling to beautiful, warm, sunny spots that are going to be really nice.
Cheaper flights for you, Bramo.
I know, maybe. You're trying to send me away?
No, not at all.
You're like, yeah, you could go get one.
Not at all, I'm coming with you.
Fabulous.
Futures on the S&P, just about unchanged. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Speaking of airlines, John, United Airlines said that it's seen a 50% drop in government-related travel. Speaking at a JP Morgan conference, the CEO said the company is seeing weakness in travel demand. Reacting to the news that Southwest will be charging for bags, he said it's the, quote, slaying of the sacred cow. 5 of the billionaires at President Donald Trump's inauguration have collectively lost $209 billion since January 20th. The Bloomberg Billionaires Index shows that Elon Musk's wealth has declined by nearly $150 billion as Tesla shares have tanked. Jeff Bezos has lost $29 billion and Sergey Brin has lost $22. President Donald Trump says that he's going to buy a new Tesla this morning. Speaking of the slump in Tesla shares, he said it's a show of confidence and support for Elon Musk. Tesla fell in their worst day in more than 4 years yesterday. In a post on Truth Social, Trump said, "Why should Musk be punished for putting his tremendous skills to work in order to help make America great again?" And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. We'll head down to Washington, D.C. and catch up with Tyler Kendall, looking ahead to 5 p.m. Eastern Time when the Business Roundtable sits down with the President of the United States.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Yesterday, the worst day so far in 2025, down 2.7% on the S&P, and the Nasdaq 100 down by 3.8%. Today, no real bounce at all. We're totally unchanged on the S&P. We're not even positive 1/10% now on the Nasdaq. The opening bell, about 38 minutes away. Let's get you the day ahead. It looks like this. 10 a.m. Eastern Time. JOLTS job openings at 5 p.m. The president meeting with top CEOs and Wall Street bank executives. Look out for that. The Business Roundtable later. Wednesday, CPI plus President Trump's tariffs on steel and aluminum go into effect on Thursday. PPI and another round of jobless claims on Friday. The U.S. government shutdown deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, looking forward to later on this afternoon. What are you expecting?
Well, John, President Trump has said that there will be a short-term adjustment period in order to have long-term growth. I'm sure many of these executives would like to know what that timeline is that the White House is tracking here. Interestingly enough, 1 week ago today, the Business Roundtable put out a pretty lengthy statement about President Trump's economic agenda. It was right before he addressed a joint session of Congress. And unsurprisingly, they touted their support for many of his economic policies, including tax cuts and deregulation. But notably, they said that they were going to push President Trump to protect the benefits of the USMCA, citing that U.S., Canada, and Mexico trade has contributed to more than 13 million American jobs. So no doubt tariffs and the uncertainty that comes with them are going to be a topic of discussion today. We should quickly note that this continues a trend from this White House when it comes to outreach to the private sector. Yesterday, President Trump met with some top tech CEOs. I was there at the White House. I watched them walk in, though they didn't answer any of our shouted questions, but it included execs from companies like Intel, IBM, Qualcomm, and HP, as their industry in particular tries to navigate these tariff threats. John, the official White House schedule says that President Trump will be at the Business Roundtable for 1 hour. We know he's prone to long remarks, but we are expecting that after he gives his public-facing comments, he's going to end up having some private conversations with the execs in the room.
Tyler, appreciate it. Looking forward to that. Some of it might be on camera, so look out for that later on this morning, later on this afternoon. Tyler Kendall down in Washington, D.C. Want to watch a little bit later. It's interesting. This morning, we've hardly talked about the tariffs on steel and aluminum, just assuming 25% on steel and aluminum happens overnight.
That's what everyone is expecting. Those tariffs go into place tomorrow, 5 p.m. I want to know if these executives leave the room feeling uncertain. And 10 a.m. when the Tesla showroom in Georgetown opens up, I want to know if Donald Trump really goes and buys one.
I want to know what President Trump could say that could potentially stave off some of the uncertainty in markets and whether he'll even begin to try, especially because it could be seen as a reversal or a capitulation of some of the current stance that he's taking that's hardliner. That's really the key to me.
They've been pretty consistent. with the message over the past few weeks. Let's see if it stays that way later on this afternoon. Coming up tomorrow, Alicia Levine of BNY, Adam Hodge of Bully Pulpit International, Rick Wurster of Charles Schwab, David Kelly of JP Morgan. CPI tomorrow morning, the main event, live from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. After early exits in Dubai and Doha, Coco Gauff is looking to play herself back into form, and the former US Open champ enjoyed a confidence-boosting win over last year's finalist Maria Sakkari. The 20-year-old closing it out 6-2 in the second on her 6th match point to reach the round of 16.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
30 minutes until the cash trade after the biggest NASDAQ drop since 2022. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, don't call it a comeback. Futures are fluctuating after a sell-off wipes out $1 trillion from the NASDAQ 100. Citi downgrades the U.S. stocks, citing a pause in American exceptionalism.
President Trump says he'll buy a Tesla to support Elon Musk after shares in the electric vehicle maker fell 15% yesterday, bringing total losses this year to 45% and erasing $826 billion in market cap since the peak in December.
And shares of Delta and American wavering right now, but to the downside after slashing their guidance. But then you take a look at JetBlue managing to buck the trend. We'll bring you the latest on the airline industry, all of that and more. Coming up, let's take a check of these markets. We were setting up for a turnaround Tuesday, but you can see that early momentum is fading. The S&P 500 now unchanged, but the color is red. Same story if you take a look at the NASDAQ 100. Small moves, but it's amazing to see this after what we saw on Monday. A big plunge in the S&P 500. As Matt said, the biggest one-day drawdown for the NASDAQ 100 since 2022. So clearly, this pain valve isn't letting up just yet. You take a look at the bond market. We saw that big bid materialize for the long end yesterday, but these levels, we've been hanging out around this place for a couple days now, maybe a week or so, Matt Miller. 4.22% on the 10-year Treasury yield. Feels like we finally maybe settled a little bit.
Talking about 420 there. I want to show you something absolutely fascinating that Dan Curtis, our producer in London, discovered. The only time that we've ever seen a drop of more than 2.5% on the S&P with fewer than 400 stocks falling has been the dot-com bubble other than yesterday. Take a look at this bubble here. This one next to it, this one next to it here, Joe. That was 12/20/2000. So 339 decliners, 3% drop. If you look over here, you'll see also 2001. If you look over here, you'll see 2000. Here, 2002. So the only time that you've ever seen fewer than 400 stocks drop and bring us down more than 2.5% was yesterday when we had a drop of 2.7% and 345 decliners. It's very eerily reminiscent of the tech bubble burst.
But kind of a silver lining, isn't it? In some ways.
In
what way? In that not everything was down on a catastrophic day.
Yes, there were still 155 stocks up.
Silver lining
there. You go.
Matt Miller. Now, some stocks we're watching, Tesla trying to stage a rebound, not doing so hot at it. It's roughly flat on the day. They were up more this morning. Remember, they had led losses in the Magnificent Seven. They've been doing that all year, and it's a much-needed boost because they recorded their worst day since 2020. We're keeping an eye on Delta Airlines this morning as well, down 2.7%. The airline is slashing its first quarter revenue guidance on weakening travel demand. A lot of investors getting a little more worried about the airlines given a weakening data, potentially weaker consumer data. Kohl's also down 16%. Similar reasons, because they joined the growing list of retailers sounding the alarm. They've delivered a disappointing outlook. That cautious consumer taking a bite out of Kohl's right now, Matt. And remember, this is a stock that's already had a brutal couple years now.
Yeah, it's been very bad for a lot of these companies. I thought, Tesla's market cap wipeout since the peak, they have erased more in market cap than Ford, General Motors, Stellantis, Toyota, Volkswagen, Mercedes, BMW, Porsche, Ferrari, Renault, Nissan, Honda, Toyota, all of those companies put together.
Are you sure that's all
of those companies, Aston Martin, all of those companies put together in market cap still doesn't equal what Tesla has erased since December.
It has been stunning, and it's stunning because we heard from Dan Ives in a note last night saying that, of course, he's still bullish on Tesla. He still believes in the future, and he thinks that full self-driving will be a game changer. But he did say this has been a gut punch, I believe is the word that he used, for Tesla bulls, including himself. It's been really, really painful out there.
One thing I think is fascinating about this, you look at all the trades that have been erased since the election. We've been talking about it. The NASDAQ 100 below 20,000. The KBW Bank Index also has dropped below that election level bump that you saw. You also have a lot of interesting moves that did not drop below that level. Can you imagine Tesla lost all of its gains, but Bitcoin did not? I think that's a little bit fascinating given that the exuberance here has still remained in some pockets. You wonder whether they'll lose their bump as well.
Yeah, Bitcoin coming close, though. Let's stick on Tesla, though, because that has been one of the stories of this market. Shares of Tesla really wavering this morning after posting their worst day in over 4 years yesterday. You have concerns about demand for the company's EVs, sending the stock plunging by 15% on Monday. Let's break it down with Garrett Nelson. He is CFRA Senior Equity Analyst. He has a buy recommendation on Tesla with a $440 price target. Garrett, that's just one part of it, isn't it? Because you think about all of these concerns coming to bear that Elon Musk's involvement with the Trump administration has created a brand risk, a reputational risk for Tesla. And there was a line in your note that really made me sit up straighter. Let's read it right now. Quote, we think it might make sense for Tesla to elevate a member of senior management to take on additional responsibilities to keep Tesla on track with its near and intermediate term goals, as Musk's Doge commitment won't conclude until mid-2026, although we don't think this is likely to happen. So Garrett, it's not your base case, but talk us through why you think this should happen.
Sure. I think as Elon Musk indicated in the interview yesterday afternoon, that he is committed to Doge, and that's more like an 18-month consulting gig that doesn't conclude until the middle of next year. And so if that's his plan to remain committed to his Doge responsibilities, we think it might make sense in the intermediate term, just given that everything that Tesla has going on at such a critical point for the company, with the pending launch of full self-driving in the Texas market in June, and an expectation that the Department of Transportation is going to come out with a new federal framework for autonomous driving. It's such an important time in Tesla's history right now that, I think he's at the point where it's very overwhelming. And so we think Tesla has shown it has a very deep bench of talent. They've shown that over time, numerous investor events over the years. And so we think it might make sense to elevate a member of senior management to take on more of the day-to-day responsibilities and make sure Tesla is still on track. Because let's be honest, Elon Musk is spending the vast majority of his time in Washington, D.C. right now.
Hey, I'm interested in the full self-driving potential. My buddy Alex Roy actually set a full self-driving cannonball run record in December. 98.5% of the time, he was not driving the car from New York to Los Angeles. They made it there in, I think, 39 hours and change. Is that really, though, worth so much? I mean, couldn't Alex have done this in a Mercedes? Aren't there other companies that have this kind of technology?
In short, no, not to the extent that Tesla has advanced their full self-driving. Really, ever since incorporating AI and NVIDIA's hardware, NVIDIA's GPUs into their development a few years ago, it's been staggering the advancements that Tesla has made. And so we don't think they're being given enough credit by the market for these innovations. And I think you're going to see it on display. I think once consumers see the capabilities of full self-driving, it's pretty staggering. The cars come right out of the factory and they drive themselves to the loading dock at this point. So, and there have been, these innovations are very well documented. There's a number of YouTube videos out there that investors can look at, and just to track the improvements of full self-driving through version 12 and now on different versions of 13.
I love that. If only they would have a big diesel V8, then it would be perfect.
Yeah, for those folks that still want to drive on diesel. Garrett, anyways, your price target here seems to be more than double what the stock is trading today. And with the sentiment out there in the market, plus any concerns about near-term catalysts, things potentially being a bigger problem in the near term before they turn around, what is the big catalyst you think that can send this stock flying back to where you think it goes?
Well, on the catalyst, I think it's the launch of full self-driving. Ever since their robo-taxi day last October, it became clear that the story is all about autonomous driving going forward. Recent years have been more about electric vehicle volume growth. Now, going forward, it's going to be more about autonomous driving. And showing the market that they have a differentiated product that's much better than the competition. So you have the launch of full self-driving. That will be very closely watched as far as the capabilities and the adoption of robo-taxis in the Austin market. And then what really drove the post-election surge in the stock price was, of course, the Department of Transportation naming the adoption of a new federal framework for autonomous driving. That's really going to supersede a lot of these state-level regulations. So that's really, what drove the run-up in the first place following the election in early November. But I also think it's really important to provide some historical context on this sell-off in Tesla. Since the end of 2018, this is the 8th sell-off that's happening right now, from peak to trough of 40% or more. So volatility has proven to be the rule, not the exception. And I think it's really important for investors to understand that. And every single time on these sell-offs, it's been a lucrative buying opportunity.
Sounds like Bitcoin.
A little bit.
Sounds like a meme stock.
Yeah. Garrett, great to get some time with you. That is Garrett Nelson of CFRA. I just think it's an interesting point because when it comes to Tesla, there's always been an Elon Musk premium priced in, and you can see that kind of getting priced out right now. And listening to Garrett, it kind of sounds like what he's saying is Tesla needs a CEO.
You know, it's funny. I think about what happened with the X debt. No one thought it would get back to par, yet you had people buy it and get a sweetener with XAI as well. So I don't know. If you make that comparison, maybe equity holders have something to hold on to.
I do think that's a slightly different point, though, because you think about Elon Musk. He has been this distracted CEO. It just feels like that narrative is so exacerbated right now.
Right. It's fascinating, and we should have Garrett back because he points out that Tesla has a deep bench as well, and no one's ever heard of anybody else that works for Tesla,
Time
right?
to give other people the spotlight.
Let's talk to Sarah Malik, Chief Investment Officer and Head of Equities and Fixed Income at Nuveen, a very important voice, not just because she's so smart, but she leads a business with more than $1 trillion in assets under management. So, Sarah, you saw a lot of action yesterday, huge drops in the stock market, and we're now down year to date. We're down lower than we were when Donald Trump came into office. Is Wall Street just no longer confident that Trump is going to stick a soft landing?
Well, there's three factors driving this volatility, and that's the impact of Doge, the tariff roller coaster, and the growth scare. So first, starting with Doge, about half of the payrolls created since 2019 have been government related. So people are concerned that the job cuts that we're seeing at the government level will drive down the employment markets. Turning to tariffs, that roller coaster is causing fears of reacceleration of inflation, and that leads to the growth scare that also tariffs are causing. And if you look at the S&P 500, it's off about 8+% from its all-time highs. If you look at history, the last two drawdowns were about 9% and 10% on the S&P 500 over the last couple of years. So the S&P does look oversold, but what we need for investors to not sell the rallies is for a catalyst. And we don't really have a clear catalyst at this point. You know, what markets would like would be watered down tariffs, some signs of tax cuts, perhaps a ceasefire, or signs that the economy and the consumer are not pulling back. And we aren't seeing that yet, which is why I'm not surprised that after yesterday's significant decline, we're not seeing the markets look like they're about to rally on the open.
Yeah, it's interesting to see that because, I mean, for a while, pre-market, it did look like that. And I was thinking about this note that we got from Peter Scheer of Academy Securities yesterday. He said that actually right now, what he's worried about is a rip higher than more of a dip. Maybe that fear isn't as pronounced right now, but it does seem like we've seen a total re-rating of sentiment. You think about Citi downgrading U.S. stocks, HSBC doing the same thing yesterday, JP Morgan, RBC, all tempering their bullish calls, if you will. You could build a case that you just have everyone rushing to the other side of the boat right now, Sarah.
I mean, I agree with you. We could see a snapback, but my concern is that investors will fade that rally because investors have nothing to really hang their hat onto in terms of fundamentals to be bullish about. Now, there are a few things coming up. NVIDIA, tech has been a very important reason for this drawdown. NVIDIA has their investor conference next week on March 17th. Good news out of that could be a positive for the markets. And, you know, tech as a sector is about 30% of the S&P benchmark. And ever since DeepSeek came out and fourth quarter tech earnings were not as exciting as investors hope, tech has been a big reason for the market's drawdown. So we need some stability in tech. Maybe we'll get that in a week from NVIDIA. Markets are expecting 3 rate cuts this year. We're in the 2 rate cut camp because we don't think a recession is imminent. So there are some positive catalysts on the horizon. But for today and for the very short term, unless something comes out around tax cuts or tariffs being pulled back, there's just nothing for the market to say, what's going to prevent us from going into a recession. And remember, part of this recession issue could be a self-fulfilling prophecy. If the consumer continues to pull back and employment markets show increasing signs of weakness, we may get that recession that we're worried about.
Right. It's the first thing I thought of this morning. Are we going to talk ourselves into a recession? One thing I wonder about, you see the market trying to find stable footing this morning, not doing the best job at it, but the VIX is still a pinch higher. At 28, it's interesting. You have not seen the VIX sustainably above 25 since August of last year. It hit above 25 in December, but it didn't stay there. Does this mean that investors have to buckle up for a significant amount of time longer? And how do you play that volatility?
Well, you mentioned August of last year. That was that 9% drawdown on the S&P 500, which is what I pointed to, is that we are close to that levels. But that is concerning that the VIX is not at elevated levels. Also, we are not seeing a broad sell-off on the markets. It's been somewhat tech-focused. So I think that that tells you that even though the market looked like it was somewhat washed out yesterday and sentiment's very negative, we're not convinced that this is the bottom for the markets. I think interesting to talk about, though, is what's going on outside of the U.S. That's not been a huge topic of conversation over the past couple of years because the U.S. has been such a dominant market because of technology. You are seeing non-U.S. markets, they started the year outperforming U.S. markets. The growth issues outside of the U.S., there's stimulus potentially coming in Germany. We're seeing a bit of a tech revival over in Asia. So I think this could be a year when non-U.S. markets actually outperform the U.S. markets on a continuous basis if these issues in the U.S. continue.
Well, Sarah, hold that thought because that's a big call. You're sticking with us. That is Sarah Malik of Nuveen staying with us. But let's quickly check on futures. You can see that now we do have a little bit more movement to the downside on the S&P 500, down about 0.1%. Big tech, that was your big loser yesterday, about unchanged, but the color is still red. Your outperformer, at least for right now, is the small caps. The Russell 2000 up about 0.5% pre-market. Much more coming up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
This AI CapEx story is decelerating. Obviously, the DeepSeek story that came out earlier this year, and all of that is really what's weighed on the kind of U.S. Indices as much as, say, Doge, the immigration enforcement, and tariffs and the like. So look, the growth story has been deteriorating. Markets have quickly adjusted. We've been using 5,500 as the low end of our range for the first half. We're almost there.
That's Morgan Stanley's Mike Wilson speaking with Bloomberg Radio this morning. And we are back here with Sarah Malik. She is Chief Investment Officer and Head of Equities and Fixed Income at Nuveen, looking around the world in privates and U.S. stocks as well, with more than $1 trillion under management here to be overseeing. You were talking when we left off last around the ability for stocks outside of the United States to be outperforming this year, something we haven't seen in a while. You look at the outperformance already this year, and I'm wondering how much room you think there is to run, particularly when you look at the Hang Seng Index outperforming all of it.
Well, one key difference between U.S. and non-U.S., if you start with Europe, is tech versus non-tech. So Europe tends to be more cyclical. So as U.S. tech suffers, that's one reason why Europe could continue to outperform. Particularly, we like European banks, UK banks like NatWest. We think financials are in a very strong position, liquid, promising net interest income. All of that could be reasons for banks to outperform. Going over to Asia, it is the tech story with DeepSeek and tech companies there showing that they can integrate AI into their technologies at a much cheaper price than what the U.S. has been spending on it. So I think those are two areas. Now, back in the U.S. for investors, there's trillions of cash still sitting on the sidelines. So I think there are a lot of people right now going, okay, the markets are down quite a bit. Is this my time to get in? And I think, you can look at some of these non-U.S. markets, and even in the U.S., if you stay higher quality and defensive, I think that's how investors can conservatively get back into the market. So a stock we like in the U.S. is NiSource. It's an Indiana-based utility. It's a AI center, data center build out, and we think they'll increase their customer loads because of that. And it's also part of a sector that we like very much, which is infrastructure, which tends to be economically resilient and tends to perform well even during market downturns. So in the U.S., I think you can stay more selective. And for those looking at technology, a company like Broadcom. Now, this is a company that's bucking the trend in the artificial intelligence sector. Their chips are more customized, which is a narrower, faster growing part of the market, and their non-AI business is doing well. So there are areas that investors can look at who are sitting in cash and saying, okay, I want to start to leg back into this market because I do have a long-term view, and I think we're getting to a good price point to come back in.
What happens if the dollar continues to weaken, Sarah? I mean, you talk about the trillions in cash, and I look at money market funds, and it is shocking how big it's getting. But where is that coming from, and how does the math change if the dollar starts to fall?
I think that is it is a reasonable assumption to assume at this point that being more of a bear on the dollar could make sense. And that would be good for U.S. multinationals. That is good for U.S. large cap stocks, which have suffered under a stronger dollar regime. I think also looking at the 10-year, which has been declining now, getting closer to 4%, that's another tailwind for the markets, and also a reason for investors to keep moving their money out of cash. The returns on cash is likely going to continue to deteriorate, whether the Fed cuts rates 2 or 3 times this year. So that is the time for investors to say, okay, maybe it is time for me to start slowly, dollar cost averaging in, waiting for that catalyst, because we have seen a very significant movement in the markets in a short period of time. So when that catalyst comes, I think the markets will rebound quickly. Now, as I've stated earlier in our conversation, though, I don't think that is happening imminently, in the sense that I don't see that catalyst out there, but it could come anytime, just a change in tone from the administration around tariffs, some kind of tax cuts to come in to help the consumer, or a ceasefire with one of the 2 unfortunate wars still going on around the world.
So I want to meditate on cash a little bit longer and talk about where it's coming from, because I also look at the money market chart a lot. We're close to $7 trillion. Hopefully we'll show it. But a lot of those trillions came in after what we saw with SVB back in March 2023, I believe it was. So you could make the case that that's not necessarily money coming out of the stock market. It's folks coming out of the banking system and bringing their deposits to money market funds. And if that's the case, if that's where it's coming from, why would it leave if you're earning 4%? Because you're probably not getting much in your bank account.
I think it leaves because investors are going to see that 4% could continue to deteriorate over time as rates normalize. I agree with you that money didn't necessarily come out of the stock market, but this is also where one of the reasons we're very positive on fixed income, because we think that people will say, okay, I can earn 4% risk-free, but can I, for a low level of risk, incrementally out-earn that? And the yields that we're seeing on fixed income are much stronger. Again, it's not a duration bet for us. It's more of a credit call. We like higher quality areas of fixed income like senior loans and municipal bonds, where the states still remain in very good shape because of the tax revenues that they've collected. But that's an area also where investors can incrementally out-earn their cash for a reasonable level of risk. And I think that's what people are looking for. You know, given the level of inflation and that it's reasonably sticky, is 3-4% return on your cash going to be enough to out-earn inflation consistently? I would answer not by much.
All right, Sarah, great to get some time with you. That is Sarah Malik of Nuveen. Let's take a check on markets right now. In the pre-market, we are minutes away from the opening bell. The S&P 500 has been wavering back and forth. Hopefully we'll get it up here. You can see now down about 0.2%. The NASDAQ 100, it was fighting to go green. Can't say the same right now, down about 0.2%, which is just stunning when you think about this index, down 3.8% yesterday. Just a total wipeout, the worst day for your big tech index since 2022, and it looks like that selling pressure is going to continue today. Small caps is your outperformer, but we'll see if that bid can hold all the way through 4 p.m. Coming up, it's the opening bell. We'll bring you all the action with Abby Yoder of JP Morgan Private Bank. That's up next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Good morning, good
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading after a massive drop for stocks yesterday, something we haven't seen since the dot-com bubble burst. Such a big drop with so few stocks falling. Only 345 fell, and we were down 2.7%. Today, we're looking at futures that are off as well. We thought we'd see a little bit of a dead cat bounce, maybe some dip buying, but it hasn't really shown true yet. Right now, 0.2% down on S&P, NASDAQ down 0.1%. You've got Trico bank shares. Apparently, they're celebrating a 50-year anniversary, and I looked at the shares. I just do a 5-year, by default, a 5-year look. They're up like 60% with reinvested dividends, but I've started to notice the COVID effect is going to be coming into your charts if you do a 5-year look like I do, because you know, we're right there 5 years from the start of COVID. Capital Group ringing a bell down at the New York Stock Exchange. Let's go over to Katie Greifeld right now and see what's happening in the live cash trade now. Although, Katie, we know that throughout the day this can change depending on which members of Trump's cabinet go on Fox.
Yeah, it could be a wild one. To your point on 5-year charts, you just got to put your hand over the very start and then things look better. But time will fix that. Time will maybe fix this market too, because it's ugly again today. Not as ugly as yesterday where we were at 4 p.m., but you can see that that selling momentum is continuing right now to a lesser degree, but still the S&P 500 off by about 0.2% just in the first minute of trading. Keep your eye, though, on big tech. This index was down 3.8% on Monday. I can't say that enough because it was the worst one-day drop since 2022, and today down another 0.1% or so. We'll keep our eyes on that one. Same thing too with the small caps, another thing to watch, because the small caps outperforming right now. They did get caught up with the selling pressure yesterday. They didn't fall as much as big tech, and the Russell 2000, at least for right now, for this specific moment, up 0.3%. Meanwhile, stocks to watch under the hood. Tesla trying to shake off yesterday's 15% plunge on demand concerns. We're showing some other big tech stocks here as well, but Tesla up about 1.4% right now. We heard from a bull at the start of the show saying that there's a deep bench and there's a lot of things to look forward to, Sonali, but boy, it has been an ugly 2025 for Tesla bulls.
And you know, interestingly enough, also kind of an ugly 2025 for the airlines as well. We're keeping an eye on Delta and American this morning. They're issuing warnings that consumer spending has pulled back sharply. Delta down more than 5% at the market open. American down more than 1%. But Matt, this is a stock now down more than 28% on the year.
I'm just looking, I'm not sure, but Joe sent me a note that, yeah, Southwest Airlines is up 12%. If you check out shares of Love, they're doing the opposite of the other airlines right now. And
well,
we used to call it Southworst.
Yeah, well, aren't they? They're ditching free checked bags, so they're theoretically going to make more money, but that's not a great experience for travelers.
No, it's not, because then everybody brings the bag into the cabin.
Yes.
You know,
yes.
And that's a problem.
That's how you get in fistfights.
I'm watching Dick's as well as Kohl's. Both Dick's and Kohl's are lower right now, delivering disappointing results. The turnaround plan for Kohl's struggling to gain traction after 3 years of declining sales, and just generally, this gives us another view on the consumers. So, with Sonali's Airlines and these, I guess, retail stores here, the consumer doesn't look great. And then tech also looks pretty bad with the Magnificent Seven stocks taking a big dive. Sonali's been noting all but Meta have fallen year to date, and even Meta's only up like 2%, or it was at yesterday's close. I don't know what Meta's stock is doing right now, but
still
someone
about
will probably
the same, 2%,
okay, still up 2% year to date. But here's the. It's a little confusing to look at this chart, isn't it?
Yeah.
I don't.
love it.
how much value that adds.
Anyway, the Magnificent Seven is in a correction. It looks like it's down a little bit today.
Yes, that's a good point.
Yeah,
to
15%
mention.
on the year altogether.
Let's bring in Mandeep Singh to talk about this from Bloomberg Intelligence, where he's the senior tech analyst. And Mandeep, I was listening to Mike Wilson on Nathan Hager's radio show this morning on Bloomberg Radio, and he was saying the CapEx story is decelerating. Do you see that as well?
Well, when you look at these Mag 7 companies, they have grown at an aggregate, the top line, mid 20% in the past 6 quarters. Now, if you look at their CapEx guide, they continue to be quite optimistic about the Gen AI investment. So what the market is saying is, look, there is a lot of fuzziness around the impact of tariffs, especially for companies like Tesla that has a high China exposure in terms of sales as well as the cost side. And that's where I feel Tesla, Apple, to an extent NVIDIA, they are more exposed than the rest of the Mag 7, which don't have as much exposure to, tariffs or China sales. But those are the 2 variables I think that are in play. And then you layer in, just the speculation and the uncertainty around interest rates and other variables. But I would attribute the kind of the pessimism around fundamentals tied to the tariffs and China sales.
Mandeep, what about a recession? When you have more people out there worrying about the potential for a recession as well as a weakening consumer, how does that fall over into big tech? There was a time when they were considered somewhat immune.
Yeah, and that's what I said, 6 quarters. I mean, we just talked about Mag 7 because of that mid 25% aggregate growth compared to the 493 other companies in S&P 500 that really didn't have earnings growth. So if you are hit with a recession, it's going to impact the likes of Alphabet and Meta because of the digital ad exposure they have. And look, these are cyclical industries. So that's where the recurring business models, the software ones, I think will be the most insulated from a slowdown. And, if you are exposed to hardware, CapEx, digital ads, I think there will be more exposure to the recession element.
All right, Mandeep, great to get your insight as we watch this sell-off just deepen. That is Mandeep Singh of Bloomberg Intelligence. And let's keep the conversation going now with Abby Yoder. She is JP Morgan Private Bank U.S. Equity Strategist. Great to see you in studio.
Good to see you.
So let's talk about where we are. You take a look at the S&P 500. We're below 5,600. Mike Wilson sent a note yesterday. We could get to 5,500. We were just talking to Sarah Malik, who said that she doesn't think we're at the bottom. Where do you think we are in this sell-off?
Well, yeah, I mean, this might not be the bottom, but we think we're, closer to the end of this sell-off than we are in the beginning. I mean, we're down 8.5% since the highs. I mean, you guys have been talking about all the data really. That kind of masks the carnage that's happening underneath the surface, right, with the Mag 7 being in correction territory and sentiment just being really bottomed out in terms of if you're looking at the AAII bearishness survey. So there's a lot going on that makes us feel like a lot of this has been flushed out from an index level.
How much of this is due to a growth scare or the expectation that these policies that are being put in place and sometimes taken out and then put back in and taken out and put back in are really frustrating businesses and consumers and going to lead to, if not a recession, at least a serious slowdown in growth?
Well, I think that's primarily what is happening, right? We've seen, and how that's being reflected in markets is through valuations, right? We went from 22.5 times, we're now around like 20.5 times for the overall index. Our view coming into the year was that we were going to see that multiple compression. We were calling for around 21 times, so we're actually calling for a little bit of expansion from where we are today. But this is really sentiment driven, and this is where we're rooted when we're thinking about re-underwriting our 6,400 for the year end, is are we seeing anything from a fundamental standpoint, both on the economic and the equity market perspective, that makes us want to reevaluate? And right now it's in the soft data, right? Like we're seeing that on the econ side. Today we got the NFIB, business sentiment that came down from where it was, right? That was what everyone was pointing to. And so that's a big change.
I want to follow up on just that point. I was watching that data. Feels like a year ago. It was just a couple hours ago. But the share of firms that raised prices increased the most since 2021, April of 2021. We have CPI tomorrow. A lot of investors now starting to worry about a potentially stagflationary impulse under the market. What are you more worried about, growth, stagflation, or inflation?
I would say we're more concerned about growth. Like that will be where stagflation doesn't really feel like the most likely scenario to us, just because we think the economic and labor market implications of what would happen if we saw an increase in prices would outweigh the inflationary impacts. So that's where our main concern would really be on the growth side, because that's really what comes through and hits fundamentals from a company standpoint as well.
So let's talk about what you like right now. I'm taking a look at your notes. You're recommending financials, tech, utilities, industrials. Financials and tech not having a great 2025. So what are some of the factors that are helping you keep the conviction right now?
Well, I think, obviously in January, there were a lot of concerns around what was happening with AI as it relates to, the tech infrastructure in the US relative to the rest of the world, and in particular China. I mean, that kind of has taken a backseat in terms of now the focus is the policy uncertainty. But, the issue coming into the year was that expectations were really, really high, and they were mostly met during earnings season for the tech companies. It's just that, again, it's all about expectations, and if we're going to have beats and raises of billions of dollars throughout the cadence of 2024, and that changes and is a little bit smaller at the margin in 2025, that's where you see confidence a little bit wane a little bit. But for us, when we look at growth expectations for tech, 18% year over year, we're pretty comfortable with that. And similarly with financials, I think, this is policy uncertainty related as well, just what's happening with deal flow. You're seeing that kind of pushed out from 1Q, but we do see that coming through, and other fundamentals within financials looks great.
What do you think about overseas, or the idea that American exceptionalism, it's too dramatic to say the end of American exceptionalism.
I would agree with that, yes.
But Shonali has been pointing out a fantastic chart today. If you just look at year-to-date performance of the U.S. versus Europe and Asia, especially Hong Kong, and then the City Call today, basically sell America and buy China. It's been a reversal of what I would have expected coming into Trump 2.0.
Well, I think consensus, that's contrary to what most consensus was, too. I think if you're going to
Here's the chart, by the way.
If you're going to make the call to, rotate proceeds from the U.S. to the rest of the world right now on a tactical basis, you're betting on valuations for the most part, right? Because that's what we've seen. We've seen a re-rating in European equities from 13 to 15 times. Similar story in terms of China, and a de-rating in the U.S., right? So you're calling for we believe in these fundamentals coming through. Right now, I think it's just the risk reward.
For the most part. But I will say, and I heard Trump say again that he loved Ronald Reagan, but he wants to do everything the opposite of what Reagan did, right? Europe is going to spend at least, $1.3 trillion, maybe more, on infrastructure and defense.
If they can get it through.
If they can get it through. True, the Greens could be problematic, as usual. But if they can do that, isn't there a fundamental case for investing in those companies?
Absolutely, absolutely. Yeah. Longer term, again, if they can get it done. And look, we're not making the case that you should not have exposure to European and Chinese assets. Obviously, international diversification is always a prudent approach in portfolios. What we're talking about right now and tactically, you're really, from a valuation perspective, it's just not that compelling.
Abby, we thank you for joining us here on set. Of course, that is Abby Yoder of JP Morgan Private Bank. Finding some sense in these crazy markets. Still crazy today.
I hope they turn around, though. Because my 401k, I'm looking at my my retirement, and I'm thinking, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and forget it.
You need to find a new target date in 2070.
Right. We need to find a new squirrel for him to chase.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, in our 70s, and
I'll take care of you, Matt. Anyways, coming up, we're going to talk about those airlines as we've been talking about. American and Delta Airlines, they're both issuing softer outlooks thanks to weaker leisure travel demand. We're going to take a look at the sector next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. A quick check on stocks. You can see the S&P 500 still feeling it right now, but we have a turnaround underway in the NASDAQ 100 with the big tech index up 0.3% following yesterday's wipeout. And the Russell 2000 still your leader, at least in today's action. The Russell 2000 up about 0.5%, but a lot can change between now and 4 p.m. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Amazon getting upgraded to a strong buy over at CFRA. The firm says that the recent pullback is a buying opportunity. Next up, we have Madison Square Garden Entertainment getting upgraded to a buy over at Wolfe Research. The firm says that its growth potential and, quote, permanent winner status are deeply undervalued. Finally, we have Capital One getting raised to a buy over at Baird. The firm also says that this is a buying opportunity. Matt Miller.
All right, Delta and American Air are issuing stark warnings for the U.S. economy as those carriers slash their outlooks in the face of weakening travel demand. Delta CEO Ed Bastian calling the first quarter, quote, a parade of horribles. Ouch. The announcements come as the companies present at J.P. Morgan's Industrials Conference. Here with more insight is Brooke Sutherland. Brooke is our Boston bureau chief. She also covers the industrials for us. And is this about a recession? Is this about a growth scare for the airlines?
I mean, I think what's interesting about this is that we've been hearing warning signs about the consumer from other parts of that side of the economy. If you look at comments from Walmart, from Target, from McDonald's. But what's been interesting is that travel demand has really held up quite well. Even as we've had all these various different scares about consumer spending, you've seen individuals keep going out and spending on leisure travel. So to see that pullback, I do think is concerning. Now, time will tell whether this is just a bit of a pause, given all of the uncertainty out there, or if it's more of a prolonged period of weakness. Keep in mind that the first quarter in general is not a big one for airline travel. So what you're really looking for is what happens over spring break. Do you see people taking the trips as they normally would? Do people continue to travel over the summer? Do they keep taking those transatlantic trips that have really been a moneymaker for the airlines over the past couple of years? But I will say what's also concerning to me is to hear the airlines talk about not just a dip in consumer travel, but also the corporate side of things, that uncertainty is really sort of leaking into businesses' willingness to spend on travel. Airlines were looking for corporates to really kind of sustain the recovery here, because remember that leisure really led us coming out of the pandemic, and the growth was really meant to come from corporates. And so to see a pullback there, I do think does raise some questions.
I'm going to take a question out of the Vibe session playbook here, because you mentioned spring break. I had already been planning my trips out into the next couple of months. It feels expensive, Brooke, and if you're feeling like it costs a lot to travel now, then how might you feel in a month from now? When you look at the Delta guidance here, they say that in the current quarter, earnings will be 30 to 50 cents a share compared with $1 of an earlier forecast. So the extent of the drop is already quite meaningful. So how does that translate when you see that kind of drop off now into what it might feel like later?
I think it's important to remember that there's also a bit of a perfect storm facing the airlines. So you do have, this consumer pullback, this corporate travel pullback like we've been talking about. You've also had the spate of safety incidents that I do think is impacting air travel to some extent. Now, the extent to which that extends, again, remains to be seen, or if it's just sort of a momentary question mark in people's minds about their willingness to get on a plane. So what's been interesting on the inflation front is that you really haven't seen the same degree of inflation in airline ticket prices as you have seen in other parts of the economy. And that's part of the reason why this had remained, a strong source of spending for the airlines. But I do think, to your point, as inflation starts to bite elsewhere, people might think twice about those airline tickets. It's sort of the ultimate of discretionary spending. And so if you do see people pulling back, that's a rather obvious bucket in which to do that.
All right, Brooke, great to get some of your insight. That is Bloomberg's Brooke Sutherland. And we do have to mention Southwest Airlines, one of your biggest gainers on a percent basis right now, currently up 8%. At one point was up the most since November 2020. So huge gains that we're talking about. Of course, Southwest ditching its free checked bag policies. Also, it cut its revenue forecast along with its peers, but it's accelerating its buyback. You add it all together, and it is a big day for Southwest, up 7.5%. Now, coming up, traders run for cover after Wall Street's latest market meltdown. That's next in our Wall Street Beat. This is Bloomberg.
Global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
And And it's time now for the Wall Street Beat, because from ditching U.S. stocks for Chinese rivals to buying the yen and the euro, strategists, money managers, they're all rewriting their playbooks, shifting towards safer options to escape the market turbulence. Bloomberg's Justina Lee joins us now. What's a good hedge in this market? What do you see traders flocking to, and how safe are those hedges, given that some of the trades that people are piling into a year ago would have looked crazy?
Yeah, I think what's been really interesting about this market sell-off is it's very U.S. specific, right? It's a complete reversal of American exceptionalism. Because if you look at what's kind of relatively doing better, it's like Chinese tech stocks and even the Chinese yuan, you know, the Swedish krona. So it's not, doesn't seem to be like a classic flight to quality play where everyone kind of goes to buy the dollar and long-end treasuries. It's about specifically unwinding those high momentum trades that have been working and suddenly are not, kind of for the past year. And so I think you raised a great question, because, you know, not too long ago, people were saying, you know, these Chinese stocks are uninvestable. But I think it just kind of shows that people kind of want to move money to kind of assets that are, you know, way cheaper right now and maybe kind of haven't benefited as much from those momentum plays over the past year.
Yeah. Saying buy China, but I want to talk a little bit specifically about the U.S. equity market. It was interesting to me that if you take a look at SPY, it's the S&P 500 ETF that's the largest right now. You take a look at volume, it was pretty contained yesterday, Justina. It seems like all in all, the narrative has been that this has been a pretty orderly sell-off so far.
Yeah, and I think, you know, we've definitely seen some, you know, hedge fund degrossing exposure. But if you kind of look at the broader picture, you're right in that there hasn't really been, you know, any intense panic, you know, not even kind of what we saw maybe in the August of last year or in the Volmageddon. And I think there are kind of two ways to look at this, right? One is that people are not panicking just yet because maybe they're not sure that we're really headed to a full-blown recession. But the other way to look at it, and I think that's sort of the question on a lot of people's minds today, is if a recession is coming, then that unwind is definitely not over. I mean, if you compare this episode to past momentum unwinds or kind of the short volatility exposures that are still out there, then we probably have, you know, kind of quite a way to go.
All right, fantastic intel, Justina. Thanks so much for joining us. Justina Lee, there out of London. You can check out her work on the terminal at Bloomberg.com. Coming up in the next hour, we're going to speak with the biggest bull on the street. John Stoltzfus joins us, Oppenheimer Asset Management Chief Investment Strategist. He has a 7,100 target on the S&P. This is Bloomberg.
First time, got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, and LA, and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Alex Steele, she is down in Houston, Texas for a second day at Sarah Week. That's the big energy conference. We're going to have lots of interviews with Alex, with some leaders from the energy industry over the next couple of hours. So stick around for that. We're also going to check in with Ira Jersey, Bloomberg Intelligence Chief Market Strategist, to see what this Federal Reserve is going to do. Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist, is also going to join us and get your sense of where we go with this market. Is it time to start buying this thing or still remain cautious on that equity market? Michael Dean, Bloomberg Intelligence Head of Global Autos Research. We'll get his thoughts on what's happening in the world of global autos. Might talk a little Tesla, might talk a little Volkswagen as this industry continues to make the switch over to EVs. It's a little bit of a bumpier road than people thought. So we got a lot coming up in the next couple hours, and we will stay on top of these markets. We got red and green on the tape. Let's go to John Tucker right now and get a Bloomberg Business Flash, John.
And this Bloomberg Business Flash being brought to you by IBKR. Will the U.S. CPI exceed 2.4% in March 2025? Trade your prediction with IBKR Forecast Trader. The yes was recently at 60%. By yes or no. Earn $1 if you're right. Go to ibkr.com/forecast. After yesterday's 3.8% plunge for the NASDAQ 100 and the 2.7% plunge for the S&P 500, right now the major averages are mixed to little change. S&P 500 down 6 points. That's a decline of 0.1%. The Dow 231 points lower. The NASDAQ 100 right now is higher, up 70 points. That is a rise of just about 0.3%. Magnificent 7 index that saw the drawdown of 20% from the recent highs. Right now, you have some of those components. NVIDIA, those shares up 2.1%. Amazon shares up 2.2%. Tesla, among the most actively traded stocks right now, after yesterday's 15% drawdown, it is up 3.2%. And Meta Platforms, that is 2%. dropping to a 4-month low for the month of February. We check the markets for you all day long right here in Bloomberg. I'm John Tucker. Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. Alex is still down in Houston, so we'll have a lot of reporting from her later in the day. Red headline crossing the tape here. Trump says he is increasing Canada steel aluminum tariffs to 50%, 50%. So there you go. Tom Keene was saying this is a market that's waiting for more news coming out of the White House, and there you go. So more higher aluminum and Canadian steels tariffs up to 50%. Coming up, Larry Sumner's Bloomberg contributor and former Treasury Secretary sits down with David Weston. I'm going to bring that to you in just a moment here. Get Mr. Summers' take on this economy and the policies coming out of Washington, D.C., maybe some of the uncertainty that's coming into the economic outlook as reflected in the financial markets. So right now, let's go to David Weston speaking with Larry Summers.
For our Bloomberg audiences worldwide, I'm David Weston, and I'm delighted to be joined by Larry Summers, former Secretary of Treasury and now at Harvard. Larry, thank you so much for being with us today. The talk of the town are the markets. I won't press you on the markets, but tell us about the economic numbers underlying this, because there are indications of a slowing economy.
David, I think we've seen a sea change in perception in the just almost 2 months since President Trump was inaugurated. At that time, the prevailing view was very strong economy, possibly inflation, risk, United States exceptionalism relative to the rest of the world, likely to manifest itself in continued U.S. outperformance. But the combination of substantial immigration restrictions, substantial layoffs in possible prospect from the federal government, the damage to U.S. competitiveness and to U.S. production done by tarification, and above all, a big increase in risk premiums have led to sharp reductions in spending on the part of both consumers and on the part of businesses, and even more sharp reductions in intended future spending. You saw that, for example, when Delta Airlines reported a soft first quarter and a very soft set of reservation requests going forward last night. So you take all that together, you take the fact that markets were starting at a very high level in terms of valuation, and I think you have to say that there's in the range of, I'd say still slightly below, a 50% chance of a recession starting this year. You know, I've watched economic forecasts for a long time, and one thing I've observed is when they start being revised in a direction, there tends to be momentum. And all the revisions are going one way at this point, which is towards less growth. So I think we've got a real uncertainty problem. I think it's going to be hard to fix that. And we're looking at a slowdown relative to what was forecast almost for sure, and a serious near 50% prospect of recession.
So taking you very literally about that close to 50% chance, for our audience, what numbers should they be looking at to determine what side of that 50% we end up on?
They should be looking at what the slope of the yield curve is and what people are expecting the Federal Reserve to do. The more people are looking for sharp cuts by the Fed, the more they're judging that a recession is likely. They should be looking at what's happening to stocks, and particularly stocks in traditionally cyclical industries. They should be looking at data that points a little bit over the horizon. Data on order books of businesses, data on consumer intentions to buy a car or to buy a house in the next several months as an indicator for judging what is going to happen. All those things taken together, I think, will tell a story. There's also information in what is happening to commodity prices. And I pay a lot of attention to the various compilations that come from investment analysts who are very close to firms, who are reporting which way the firms are revising their own forecasts of future revenue and future earnings. All of that are the sort of indicators of what's happening in the economy. I think at a different level, the thing to be looking at is, are we getting more policy certainty or are we getting more policy uncertainty? Every time there's a major vacillation, every time there's a question about commitment to law and to commitment to following the law in any sphere, you're gonna be getting more uncertainty that is ultimately a prospect for chilling investment.
So President Trump has addressed this and said we're going through what he called a transition period on the way to what he called something very big here. To try to argue his side of it, is this a necessary sort of transition to rebalance the economy, get the government out of the economy to the extent that it was, and really go forward to a better future for the economy?
No. Look, David, transition period. Doesn't it sound like a lot like the word transitory? The idea of transitory inflation, when it was put forward by the Biden administration and the Fed when things weren't going well, didn't work out very well. And I don't think the idea that this is some kind of transition period is going to work out very well at all. And why do we think that it is going to help the U.S. economy to not be able to use Mexico and Canada as a production partner, given that we are competing with Asia and Europe? I don't see what that logic is. Why is scaring people about whether they're going to get their Social Security benefits, scaring people about whether the United States is going to continue to develop new medicines at the NIH? Why are those things thought likely to increase confidence? If this was going to increase confidence and people saw it, you'd expect to see surveys of consumer confidence showing an improvement in conditions, and you don't see that at all. If this was going to increase, was just a temporary dip that was going to increase the prospects of businesses, you'd see their stock market values going upwards, not downwards. I think by far the more likely thing is that we are in the shallow end and we're walking towards the deep end, and the problems are only going to increase with the passage of time. You know, this is not the first time that a country got a new leader who gave a lot of orders and imposed a lot of tariffs. That populist policy mix is a standard around the world, particularly common in Latin America. And what the studies show is that it can go either way in terms of its impacts in the short run, but it's almost always bad over the medium to long run. So I'd expect, unless there's a reversal in policy, I would expect this situation to get more serious. And every time the president uses rhetoric that conveys steadfastness on this policy course of tarification, of economic nationalism, of greatly expanded concept of government action and vast, wide interpretation of government power, every time he recommits, pessimism increases. And so I think those explanations of downturn being temporary are actually quite counterproductive.
Larry, to play devil's advocate, I think that if somebody were here from the Trump administration, they say the transition is to a world where we have a bigger manufacturing base. We had Sean Fain from the UAW just recently say he thinks what you're doing is exactly right because we've lost so many jobs. Is there an argument that, in fact, we could be rebuilding the manufacturing base that could help the economy in the long term?
Manufacturing has trended downwards for 60 years. It has trended downwards in Germany as a share of the economy. It has even trended downwards in China as a share of the economy. There's a reason, which is that there's just lots that used to be done by people on assembly lines that can now be done by machines. And there may be blips from one year to the next, but the idea that we were going to have some kind of durable manufacturing renaissance was a chimera when Joe Biden said it, and it's an illusion when Donald Trump says it. And the much more likely thing is that the particular kinds of protection that the Trump administration is stressing are actually going to hurt manufacturing. Think, for example, of those promised aluminum and steel tariffs. 60 times as many people use businesses use aluminum and steel in their production as are in the aluminum and steel industries. So we're raising costs. This administration can't understand, or seems not to be able to understand, is that today we live in a world of supply chains, and in that world of supply chains, when you tariff things, you're increasing the price of inputs that would have gone into exports or would